and let them come into the US, that's a killer thing for our economy. But of course, immigration is a super politicized thing, and I'm not really going to get into that in this video. But my point is population growth and immigration and just pro-capitalism society, generally speaking. I mean, we're letting these ginormous mega cap companies just dominate the tech space and the semiconductor trade. It's why the U.S. is quite dominating when it comes to markets. So, it's something to think about is I don't really see right now a reason to get super long European stocks, if not other than just to have a little bit of diversification and perhaps some exposure if that, emerging market stuff changes at some point. European stocks compared to US stocks are at like a multi-decade low in terms of performance. European stocks have been terrible compared to US. And I'm not saying that to say that that's how it's always going to be. I actually think that there's probably a pretty practical thing of saying I might actually want to build some foreign stock exposure, because I don't think the US dominance is like going to just reign supreme forever, right? But right now, that is the story. Pro-US, US stock market on top, US dollar on top. It's quite dominant at this time. That being said, again, contrarian would say, don't put all your eggs in one basket. Build positions in Asian stock markets and European stock markets, maybe even South America. I have one position that I find really fun to look at, which is I'm building a position slowly in the Brazil stock market. EWZ is an ETF that tracks the Brazilian market. I have a small position, or I sold puts on this one, so I'm probably going to get assigned on this position, which would be fine. I can start a position in EWZ. So I mentioned at the top of this live stream, I've been building kind of a more diversified portfolio going into 2025, and I think that could serve me well if we do see a cool off in tech for a little bit. Anyways, guys, I mentioned this earlier. This is going to be my last time mentioning. If you guys want to try out our software, the EdgeFinder, we'll drop a link here in the chat to where you can sign up for that. And make sure you take advantage of that. We're doing half-off trials currently, so that is only happening during the month of December. So if you'd like to try our tool and you're serious about it, you want to get ready for 2025, don't miss your chance. Send us a direct message right now to get 50% off on the EdgeFinder trials that we're doing currently. With that said, we're going to take a quick break, and then Chris Pulver is taking over the show just after this. Check it out.
'Twas the night before Christmas, and all through the house not a creature was stirring. Except Chris Pulver, apparently, who just took a trade on gold. It's the middle of the night. I'm not really sure how he did that. Pulver alerts are now available at A1Trading.com. Get exclusive access to Chris Pulver's trades with A1 Trading's Pulver alerts. Watch as Chris Pulver, a seasoned trading pro, navigates the markets, manages risk, and applies a disciplined trading process. Join today to level up your skills and learn from Chris's wealth of experience. Get Pulver alerts now.
Hey everybody, what's happening? How we doing? I am just typing up a little update alert. Looking at my expirations for Friday, what's looking good? And let's go AMD. Likely loss. So right now, I'm going to post this in my Discord as well as the A1 Trading Pulver Alerts Discord. I've got some managed winners this week. I closed out Microsoft for a winner, closed out PayPal for a winner, closed out TEVA for a winner. Expirations for Friday: Google, Nvidia, GLD, META or Meta, PayPal, another position that was a further out of the money trade, Netflix, Amazon, Tesla, SVXY, all looking good for profit. That's 1, 2, 3, 4, 5, 6, 7, 8, 9 more winners that are likely on Friday, and a small loss on AMD. So I'm going to post that here. Okay, and then I'll post that in my little trading journal section. Manage trades. All right, trade management update. Okay, sending that out. All righty. Let's see where we're at. Currency strength for today. We got New Zealand and Aussie getting a little bit lower. We had a weird little flashy move on the Aussie overnight. I don't know if that was accurate. Let me spot check Aussie dollar. Did we actually see a move like that this morning? It could have been a little weird hiccup on the data feed. I definitely don't see that type of movement this morning. That was, I mean, that's showing like a 70 pip spike somewhere in the Aussie, but I'm not seeing that right around that rollover period. So unlikely accurate, but here we are, weaker Aussie, weaker New Zealand. Everything else is pretty quiet. So we are just kind of a slow little grindy melt up this morning. Fed is at 2 p.m. That's where pretty much most of the day is going to sit, is what's the Fed going to do? What are they going to say? Well, we know what they're going to do. They're going to cut rates. So the watch tool today, like 95, 96, probably even 99% today, 98.8%, they're going to cut rates. That's what the market is expecting. That is very likely what the Fed's going to do. There's probably not a surprise there. Will this be considered a neutral cut or a hawkish cut? The one thing I will be watching as an after move is going to be this 10-year yield. Let's go to the daily chart here for the 10-year yield. It is already up off of this recent CPI. Like, we had the CPI and PPI news last week. We have PCE on Friday. The yields are already higher. The Fed cut rates here. The yields are already higher. We're disinverted on the 10-year and the 3-month. We're disinverted on the 10-year and the 2-year. So I put a chart on right here at 4.51 because I am pretty concerned that if the 10-year yield breaks above 4.51, there is enough momentum here to try to break the consumer at 5%. So does it break equities? Maybe. Does it break consumer? Probably. Meaning this: house prices will probably come down over 2025. I mean, again, I'm using my area as an interesting market. More and more for sale signs are popping up in yards, and they've been there for months, which was really never the case. Talking to some of the realtors out here, I mean, it was so easy to be selling houses the last like 6 to 12 months, and just over the last 2 or 3 months, it's a little stickier. If your house is on the market, you're seeing like Zillow prices, cut by 10,000, cut by 15,000, cut by 25,000. Some of your multi-million-dollar homes are cutting by, 25 to 50K. Now, people are sitting on a ridiculous amount of household equity, and, they bought houses 4 or 5 years ago for, half of what they're charging for or asking for right now. So there's some buffer there to like say, okay, we can absorb like a, $20,000 to $25,000 discount on that price. But I still think house prices are crazy high. And the 30-year mortgage is sitting at 6.6. If this goes up to 5%, unfortunately, this 30-year mortgage is not going to be lower. I mean, at this point, it was 6.09 for a 30-year mortgage. And now, as we've gone up in the 10-year, we are now at 6.6. So if we go up to 5% on the 10-year yield, we are likely going to see this creep back up into the high sixes, maybe even get above 7%. So you're having the same story about the unaffordable housing market in the U.S. It's going to feel crappy all over again with like Main Street upset. And if we have a slowdown in housing where everybody that's coming online with new supply, but the house prices are unaffordable with rates that nobody's going to close on, it's just going to be a standstill. So that will be an interesting dynamic to the 2025 year. This is the bond market calling the Fed's bluff. If they, are noticing higher inflation. We have PCE on Friday. I still don't think that I have a forecast for year-over-year PCE on Friday. Let me go to Friday's news. There we go. So Friday, 8:30 a.m. Do I have a year-over-year? I still don't have a forecast. You sneaky turds. So the Forex Factory calendar doesn't show anything year over year. So this is what I'm watching for. I want to see these two numbers right here. So the previous year over year core PCE was 2.8. From what I'm reading on the Feds this week, they're forecasting 2.89. So that would potentially be a 2.9 print. I wonder what the trickery would be here. They forecasted, or they're not giving us a forecast. They had a previous of 2.8. We have no idea what this is going to read, but if it reads higher, then that's 3 for 3 with higher inflation reads for 3 months in a row. And yet the Fed's like, what inflation? PCE price index year over year, same thing, printed 2.3. We'll see if that's higher as well. So it's not the month over month that I really pay attention to. Obviously, if this comes in hotter with a forecasted 0.2, then that's higher month over month. But I'm really curious, like what the year over year is as things have gotten more expensive. I think I read this off yesterday. For 4 years running, we've had like prices anywhere between like 10 to 60% higher in a lot of facets of our life, ranging from just food at home, food at the grocery store, or food out to eat, your rent, your shelter, your gas, your transportation, your auto insurance, medical care, medical insurance, stuff like that. Like everything's more expensive. So we get it. It sucks. Stuff's expensive. It's been that way for 4 years. Does it get better? I don't know. Anyway, let's talk markets. Okay. So SPX, just a slow grind. I'm waiting for enough time to pass on my trade. I got a trade this morning running on SPX. And where's it at? Pfizer. Do I have anything run on Pfizer? I know I still have. I think it's out to the end of the year. Let me get my symbols up here. Pfizer is 25 by 27. Come on, man. This is next Friday. Come on, Pfizer. You can get to $27. Give me some freaking money, would you? I got my cost basis down below 24. It's like 24.70 right now. I've just been trying to work that stock, getting it called away. I still have some shares of it. I don't mind owning shares of it. I think Pfizer can still be a mid-30s stock. It's been beat up pretty badly, and it's decent dividends, probably a non-beta or a lower beta, non-correlated. But they just need to switch and make Ozempic, and then they'll probably have a big upshot. So, all right. SPX, I'll keep an eye on this one for the morning. SPX right here. Still sitting in a little bit of a drawdown, about 38 cents. I'll keep an eye on that one for the morning. Don't go too fast on me, SPX. Don't be front running the Fed now. So I'll be like Shooter McGavin and be like, listen to what I say, or you'll pay. Make things out of clay, lay by the bay. What do you say? All right, so let's take a look at where we're at. So big Fed day, right? What are we going to do? Well, we've been sitting here in a range now for since we had our recent all-time high in the SPY around 609, hasn't hit 610. I've been watching this all week, the last couple of weeks. We now are going on 3 weeks where we haven't broken a high, we haven't broken a low. It's getting a little bit narrower. It's forcing the market to make a decision. Is the Fed enough of a catalyst to make a decision? Is it more of the same with all-time highs still coming? We haven't hit the 21. We haven't hit the 50. Are we going to offer a pullback at all? Or is this like, on Fed day, off we go to all-time highs and we get through Christmas and New Year's with all-time highs? That's very possible. The market may not care about anything today. It just uses as, okay, we're at a standstill. We got the Fed. They're going to cut rates. Jerome Powell doesn't say anything negative that the market reacts to, and we end up getting back to all-time highs. It's very possible. So is the Fed going to break the market? Probably not. But, would I still like to see a pullback at some point in Q1? Of course. I'd be a much happier buyer. I'd be a much happier bull in this market if we pulled back to the 21 or the 50 moving average. Obviously, the 100 would be fantastic. Unlikely right now, and unlikely for the next 2 weeks. We're going to have a big correction because there's no major policy shift. But I would just be interested to see, I don't know what price is going to do. We'll watch and see what happens. But I wouldn't be surprised if the S&P can inch its way up to fresh all-time highs, get above the 609. I have a huge liquidity level that is growing as we speak to 610. So 610 could be a level to keep a very close eye on. Are market makers able to defend it, or is this going to be a liquidity hunt to find it, run those levels, and then start to get into Christmas and New Year's drift where there's nothing really to stop it? Maybe. So just keep an eye on it. I'll say that 610 has a pretty high probability of getting hit this week. Okay, Nasdaq. We are not quite at all-time highs, but we've obviously had better performance on the Nasdaq than we have on the S&P. We're slightly higher year to date. We've had 4 out of 6 or 4 out of 7 now. Candles have been all-time highs, with the previous one coming 2 days ago on the 16th. Are we able to also poke some all-time highs in the Nasdaq? We'll find out. The Dow, big pullback on the Dow. Very disconnected market, right? S&P's hanging on to all-time highs. Nasdaq hitting all-time highs. Equal weighted has been down. 11 days in a row. We'll see if today's red too to make 12 days in a row. One of the worst sell-offs since the 80s. The Dow, also one of the worst sell-offs since 1978 or something like that. Is this deep enough that I want to be buying the DIA? No. UnitedHealthcare is a huge major component to this, and that stock has been beat up very badly after all the news we saw with the kind of the CEO assassination. And I don't know what to make of this outside of I'm staying out of it. If I wanted to look at something on UnitedHealthcare, let me check something real quick. UNH. I mean, it does check a lot of boxes. I mean, it's just ridiculous to think that this thing fundamentally is trading 63% below fair value. And looking at price to earnings, price to sales, it's getting up there a little bit with price to earnings for an insurance company, but fair value of over $1,000, that's outrageous to think yep, this can still double. This can still go up 200%. So crazy. But peer average is 14.5 price to earnings. This is 31.2. So UnitedHealthcare or UnitedHealth Group is a bit more pricey on the price to earnings side, but it has had a decent sell-off, and I almost think if the IV is high enough, it's almost worth looking at scooping up some discounts. So let me see if I can find a trade on this one that I like. Let me see if IV is high enough. It's high enough. 93.9 is pretty good. Could I do a 111 and trap this thing? Maybe. So 400. Let me see what this looks like. It depends on the premiums here. Let me look at a trade. So if I went out, we have earnings on the 10th of January. If I went out, let's say 45 to 65 days. I mean, I don't really want to do anything crazy expensive. But if I did a 111, I would say anything below 400 would be okay. So if I did oh, come on now. That's the level. That's the level that my bid price is 0. Whatever. 410. All right, fine. So if I did a 111. Son of a B, SPY. Don't frickin' front run me. All right, I'm just watching for, I'm looking for some lack of direction here. SPX is just getting up and grinding a little bit higher. I'm going to have to sit on this trade. I don't know. We might just come back in, and here's kind of what I'm hoping for. We come back in and test. Let me just use a straight line. Test this area. There's a gap fill. If we run to this zone without stopping me out and we have a little rebalancing, that's going to be good. I'm trying to ride on this trade for maybe the next 30 minutes, but I'll make an assessment. That is definitely more directional than I want it to be. Yeah. And to Lee's point on UNH, I mean, this might be a tricky spot to even participate in because, I get it. Trump, RFK Jr., if they're going to try to clean up some healthcare, it is a mess. I mean, I'm sure everyone has their own experience and stories, but I can say over the last, 10 years, having consistent coverage and feeling confident that you can go to the doctor and not pay an arm and a leg for things, it's not the greatest. I mean, I'm still sitting on an X-ray and MRI bill for several $1,000s for 2 visits. I was like, do I not have insurance? Does my insurance not cover any of this stuff? And it's just all the same. It's and then auto insurance is higher and you can't do anything about it. Yep, good luck with your policy. It's going to be the same. So anyway, it just feels like you're mandated to have it. Employers are paying more and more for it. And so they keep tossing around different programs and they switch from provider to provider because it's more and more expensive every year. So anyway, maybe the safer trade would be just stay the heck out of it and don't worry about this. Because we are sitting at these crazy all-time highs. But what I was looking at is if I did an income trade here, I could go after a probability of around 80, probably around 85 to 90% that there's no assignment risk here. I mean, obviously there's about an 8% chance that I would get assigned the stock. Would I be able to cover the shares? Answer is yes. If I did cover the shares, what's a, $30 or 30, an at the money call is, $18 to $22. I mean, I could quickly repair the stock. That's really not the concern. but like how disruptive could you make something that just is sitting on a boatload of cash? So I don't know. I think I'm going to take the trade. I mean, I tend to be pretty like product agnostic or strategy neutral. And if I can sell premium and get paid for it, then I'm going to try. So what do I like? If I were to just put in a put, there's my 400. So I could do this. So I could do a 420 by 410 by 400. I get $100 credit, which is my income play. If I bump these all up one strike, I get $120. I get a $10 better price there. Okay, I still get $100. If I did I don't want to do a 222 because that would be $212 profit, but now I'm on the hook for owning 200 shares at $400. That's a little bit frothy. So I'll go 111. So here's what it looks like. If price doesn't go anywhere outside of sideways or even down all the way to price can come all the way down to 400, which means from recent highs. Okay, so from recent highs all the way down to 400, this stock could drop 36+%. Okay, and I still wouldn't have to take any assignment. From current price, this stock could still drop another 20% before I'd have to take any assignment. If I did take the assignment, I would do this on 1, 2, 3 accounts. 3 accounts, they've got the cash, they've got the buying power. It's not really the $100 that I'm excited about. It would be if I did take the assignment, $100 is fine. If I did take any assignment, then I would own the stock. I would have 400 assignment minus $1.03 minus 10. I'd own the shares at 388.97. And in one covered call, if I could lower the cost basis by another $20, I probably own shares at 368. So it would be very simple to repair the stock. And 368, that is a 41.5% discount on a pretty much a cash cow stock. That is one of the biggest contributors to the Dow. If you look at the DIA weighting, UnitedHealth might be one of the biggest ones. Yeah, 9.5% of the Dow. So if that stock recovers at all, then the Dow is going to recover. Now, I guess the other way to trade this is rather than getting into UNH on its own, is I just trade DIA. It is way less volatile. Yes, we've had a pullback on DIA. So is this enough of a pullback for me to say I'm going to get into it? I don't know. Probably not. I like this area better. I like that 100 period. So between the 100 and 200, I would say I'm going to trade some Dow in there. But it's going to be way less premium. I'll make way less money on the DIA than I would if I just did, something on the UNH trade. So I'll do this. Can I get? It's not really giving me a lot more credit. I'm going to take like the least amount of risk possible. So for $1.05. Let's see what I get. So I'm going to try to take this trade for $1.05, $1.05, and my bigger margin accounts will take this trade. $1.04 is not, or $1.05 is not filling. $1.04 trying, not filling. Okay, $1.03 final offer doesn't fill. I'll cancel it. Not filling. All right, fudge it. Cancel it. Never mind. Trade idea. Squash it. Dow. I like this one better. If we came down to this level, I'm probably adding some exposure on the DIA or just trade Dow futures. All right. Anyway, thought I had an idea. What else? Russell. Also, you can see the disconnect between these markets, right? SPY clinging to these highs. RSP down, 10, 11 days in a row. That's equal weighted. Nasdaq near the all-time highs, equal weighted, down. Okay, Dow, UnitedHealth is bringing it down. Go to Russell. Small cap 2000, underperforming. Top 200 growth, near all-time highs. Top 200 value, get its butt kicked. like a ridiculous amount. So it's, I mean, this looks attractive enough, but it's like, do I want to be in top 200 value? Probably not. I'd like to be in small cap growth, but unfortunately, growth isn't even pulling back. So if I'm going to trade anything, give me some decent levels on IWM, give me some decent levels on IWY, and I would consider some, some buying opportunities there. But I mean, IWM, I'm just going to keep trading this one around the 144 and the 200. I've been doing this all year. So like all of these tests of the 100, 144, and then this August 5th or that August 5th bottom we had of the 200, all these levels I was long and doing it with credit spreads and ratio spreads. So I do a credit spread a credit spread at the money, and I do out of the money ratio spread by like $5 or $10. Because I was willing to own some shares of the IWM because my trade this year, and I said this all year, is what a great trade it would be if we got back to all-time highs in the Russell. And it was a grind. You can see it was just a crazy mess. Like, it's all over the place, and it just had all these pullbacks, but ultimately it did get back to those all-time highs. So mission accomplished as far as the direction, as far as the projection. But now I look at it like I can't get the same type of trade without getting a discount. So I want that pullback. Okay, let's take a look at dollar index gold and silver. Volatility is up a little bit on the day. Actually shows volatility is down, but we had a spike up yesterday with the sell-off. So volatility up a little bit. This is VIX futures at 44. VIX back into the teens. We were off the lows at like 12. What was it? 1270 something was the low here recently. Yeah, 1270 lows. Now we're back up into the teens at 15. Is this a volatility event? Not really, not even close. If the Fed, gets this market to still surge to all-time highs, we'll see the VIX go back into the low. It'll be 13 again or 12 again. We might even drift down into like low 12s, and then I'd be looking at Q1 for some type of like just buckle up for some volatility in Q1. Dollar index, we still bounce out that 105.50 level. It's right in the middle. I said it's probably not a bad idea to be long the dollar going back to these range highs. If you're already long the dollar off that 105.50 support, I would be break even or better and just looking to see if this thing gets up before you start trailing and trapping more profit. I think we could hit this same level at 105 or the 108 level. So we could still tap 108. If we break above 108, then we're probably filling that liquidity pocket at 109. Okay. I don't think the dollar is something you want to fight. I think there's still some upside potential on the bigger picture. With the dollar coming in and sweeping this high and sweeping this high, don't be surprised if this is an accumulation area, that the dollar maintains all these bids and the dollar ends up going higher. So it wouldn't surprise me. Now, Trump is not a fan of stronger dollar. There's a little bit of pride early on, but when it comes to like higher stocks and better exports, we're going to want to see a weaker dollar. But can he strong arm the Fed? Not really. So I don't know. We'll see. How do you do? What's that question? Bullish Nvidia to 160. How do you do a spread, but also protect if it rolls the downside? That's a credit spread. If I did a trade on Nvidia and I wanted to protect, and I've got a couple of these running. So my Nvidia trade this week, if it stays above 130, then I'm going to make $257 a contract. If by next week it's up above 138, I'm making another 50 cents a contract. If I wanted just to put on a trade and I said, okay, well, I'll sell a 136 put, I'll buy a 135 put, try to collect, 50 cents on the dollar for that trade. If it goes down, I can cash in the long put, I can own the shares. So if you want to protect the downside, you're willing to own the shares, then a credit spread is the easiest way to do that. And I was kind of hoping this week, like it's an income play, but I was kind of hoping that I'd get assigned at 130 or lower, and I'd own the shares at 125, and I'd quickly work it down to 120. And another week later, maybe work it down to like 117, try to work it down towards this 200 moving average, and then expect to bounce and try to get, I was going to go after like at least $10 a share. But like I said, this week, if we're above 130, I don't get assigned to just keep the income, and it's, going to be $257 a contract. But a credit spread, you don't want to own shares. Well, then how do you protect the downside if you don't want to own shares? All you do then is take defined risk. If you're bullish and you are going to be willing to take the risk, then do a debit spread and don't take any assignment risk. So you could buy a 136 call, sell a 137 call, or if you're bullish to 160, like you said, you don't have any downside protection, right? The best thing you can do to protect your downside is take defined risk. So if you don't want to own the shares, then just do a credit spread or just do some type of vertical spread. So here's my summary. If you don't want to own shares, okay, then consider a debit spread. So you don't protect the downside, you just don't take a lot of risk. So that would be example, right? Would be I would buy the 136 call and then I'd sell the 136 call. So I have a dollar spread and maybe the broker asked me to pay like 45 cents debit. So if I'm right, I get 55 cents of profit. If I'm wrong, I lose 45 cents of profit. Or if I'm right, I get 55 cents. If I'm wrong, I lose 45 cents. Now, if you're bullish to 160, you can craft that trade if you're willing to pay for it, but now there's risk in it. Okay. And this is probably not what I would do. I don't know how long out and how bullish you want to be. Again, my personal opinion is that we're going to hit this 200 moving average before we hit all-time highs. Just my thoughts. But let's say that you wanted to be bullish out to the end of January. Just throwing a date out there. Well, if I bought a 136 call and then I sold a 160, okay, I would have to pay $6.95 for an upside potential of 36 to 160 is $24, right? So I get $24 of upside minus what I'm paying for the trade. If I can walk away with, let's say, $24 of credit minus the $6.95 debit, I mean, that's a 345% return on risk. It's a great trade, but where's my risk at? Well, if price obviously isn't going up, I don't make any money. If price in this example, if price doesn't get to 143, I don't make any money on this trade. If price falls, I'm risking the entire debit at 696. So you don't want to own the shares, but you're asking me how to protect the downside. You can't. You can't. You just take defined risk. All right, SPX. I'm going to do what I said. Okay, right now my SPX trade it's pretty darn close to getting stopped out. 440 is my stop. I got to stop in. It's still the same thing. I don't know. We'll see. I mean, I've let it drift on me this far. We have had this like quiet little melt up. Just don't get too gamma E on me. So we're almost filling that gap on the SPY from yesterday in SPX gap. Let me take a quick peek at that. So right here is my gap fill. So again, this might be wishful thinking, but if this is my gap from yesterday and we fill it, we've had, by the way, this whole morning, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 candles, 13 of them green. I mean, price is doing what it's going to do. But if this gap gets filled, if this market cares about it at all, then let's say that we go straight across. Okay, let's go straight across right here. If we fill that gap and then we come back and rebalance at all, then the trade looks a little bit better. The problem would be if the price just moves up all morning, I get stopped out of SPX. It's no big deal. I still have a trade on I've got trades running like all over the place, but I'm still looking at a trade that gets me to 6,100 or a SPY trade that gets me to 610. I'd mentioned this morning during my live session, SPY trade. It was a 610 to next week, 610. So the $1.15 we talked about this morning is now trading for $1.70. I mean, we're not hitting it yet, but it was looking like 100% return. If I want to throw the money at it, I didn't. We'll see. Whatever. We'll see what price does. If we find the gap, and we fade with any type of red candle, pull back to the opening range breakout, and that's a high probability too. If we have an opening range breakout through 10:30 a.m., usually we'll see price come back and retest it. So if it retests it, that's cool. That might help our trade out a little bit. If it just keeps going higher, then fudge it. I'll take a small loss. I'll move on. But let's see what it does. Okay, I mean, I'm still up here with my move is 60.90, but I do have a stop loss in, so I'll watch it. Let me see if we pull back towards like 60. I'll put a chart alarm here at 60.60. Okay, just see if we get a pullback. Okay, let me do some more top down. I see the request there for the CAD crosses. Mag 7, Apple's barely up in the day. Amazon's barely up in the day. Google, Meta, flat. Nvidia's up a lot. Nvidia's up 4%. I feel like SMH is up as well. Yep, it is. This is still a pattern that I think has some bearish potential. So I don't know. I keep a close eye on this one. There could be a lot of chop over here, a lot of chop on SMH. If this structure breaks, we probably head lower. I still think Nvidia wants to find that 200 moving average. I hope it does because I want to get some exposure on Nvidia at that 200 moving average. Tesla, the stock that can't stop going up. We did gap lower today, but we are pushing higher, or gapping lower, but up on the day. We're still not at recent all-time highs. I'm trying to buy some Tesla, but I'm trying to wait for some moving averages to get hit. Berkshire still. I mean, this wouldn't be a bad one either. Actually, what's the IV on Berkshire? BRK. Not the A shares, the B shares. So IV at 35.8. I mean, if this trades a little bit like the S&P, I mean, would I consider some Berkshire in the 440 to 430? Probably. Let me have a look at this one. If I go to, let's go at like 90 days here. Let's go to March. What could I do for old Berkshire? Number one is, could I get some premium? Would I be willing to own this stock around like 430? I'd say yes. If I did a ratio spread, so 430 times 2 contracts would give me 429 credit. I do like the look of that trade. And I would only own 100 shares, but my ownership price would be down into the it'd be like 420 something. So 430 is the assignment. Collect 425 credit minus the $5 on the long put. I'd own shares of Berkshire at 420, which right now 420 on Berkshire would be a 14.5% discount. Is that good enough? I don't know. Probably not. That's a big discount though. In the back of my mind, the only concern I have is like, what if Warren Buffett passes away? If that, like, and it shouldn't be any reason to like crush the stock, but I feel like it would. Like, sentiment wise, like the stock would get just demolished. But I do like that credit. That's a Q1 profit. That's a decent chunk. Take this on the margin accounts. Would I own some shares? I've got the cash to do it. How much do I like it? 200 moving average. Nothing crazy disruptive. If it goes higher, it just gets easier. I'd own the shares at 420. All right, anyway, I'm going to write that down. I'm going to come back to that trade. I might end up taking that trade. BRKB. All right, what else? Keep an eye on the 10-year yield. And let's have a look. Advanced decline line for today. U.S. stocks advancing a little bit. Total stocks volume is slightly higher. All right, I'm just taking a look at that. Now let's go into some currencies. Dollar index, gold, silver, Bitcoin. Dollar index, like I said, I wouldn't be fighting this thing. I think we get up towards 108. I wouldn't be shorting the dollar. I think the dollar still has room to run. Gold, I'm waiting for pullbacks into 2,500 and 2,400. If we get it, great. If we don't, I'm just going to stay bid on gold. I'm not doing any heavy trading in here. If we are high, low, lower, high, lower, low, I'm looking to get more exposure. If I can get the contracts out on GC, I'm going to go out with gold futures around this 25 to 2,400 zone. Otherwise, I'll stick with GLD and just add some more shares and add some more credit spreads. Silver, same thing, pretty well supported at 29.50. And I hope it stays there. 29.50 is a pretty strong support level at that 200 moving average. And just see if it kind of builds, builds a base, gets back, let's say it goes below the 200, then back above the 200. Not a bad spot to get in, stop loss below, try to build a pattern, and then get back to a measure move at 35.80. I still like silver bullish. Bitcoin, we hit symmetry. This is my measured move. We hit symmetry where we're showing a little bit of a pullback. I don't know how nasty it gets. I said my preference would be I'd add more Bitcoin if I get to 90 or 80,000. So a 90K pullback or an 80K pullback, I'd be looking to add more exposure at all-time highs and melt ups. I'm just going to enjoy the melt up like I am everything else. So I'll wait. But if there's a pullback off symmetry, so be it. If there's a run to the end of the year, cool. If there's a run into Q1, Q2 next year, I don't care. So I'm not trying to call tops on Bitcoin. I'm not trying to short Bitcoin. I'm just going to wait and see like how this all plays out. Okay, same thing for this exposure. I did close out my long calls. So this trade here, I closed this one out for, what was that? Let me check and see my history. History, BITO. So I closed out for 13 bucks. I think I had 5 contracts in this one. So $5, 5 contracts, and it would be 5 minus 13. So I made $8 a share or $8 of profit, and I had 500 shares. So $4,000 on that BITO trade on 9 accounts. That was a pretty good chunk of profit. The reason I protected that one is I still own shares of BITO, but that was a long call that time's working against me, and I've got other ways to trade it. So I took the profit. I'm going to reallocate into an IBIT, into a micro strategy, into other stuff to have that kind of peripheral. Also, I mean, yeah, you can dollar cost average in a micro strategy. You can do it all sorts of crazy stuff that you want to. But the reality on micro strategy is you can just trade the QQQ. If Bitcoin goes up, it's probably going to affect MicroStrategy, which affects the QQQ. I don't know where it's going to be as far as market cap goes. MicroStrategy market cap is still relatively small despite the crazy gains it's had this year. I mean, market cap, it's $92 billion, right? What's our market cap that moves the markets? It's the $1 trillion+ companies that are now considered the Mag 7, right? Mag 7, you throw AVGO in there for Broadcom, that's, Mag 8 if you want to throw in $1 trillion+ because that big pop it had last week. All right. Did I get filled on my 372.50 buy? The low is 372.77. You gotta be kidding me. All right, we'll see if we get filled. I'm still doing some dollar cost allocations on MicroStrategy. It's fine. Yeah, it's fine. I'm gonna let this one hang out. And also on MicroStrategy, if we go high, low, lower high, lower low after just a gargantuan move, if we correct against that at all, find the 100, find the 144, find the 200 if possible. Doesn't have to, it may not. There's clearly a nice little base going, like it's building some accumulation here, which is fine. But if we have any type of fake out below these levels, I'll take some lumps and get it back to these highs eventually if Bitcoin goes higher. Okay. Yeah, call options. I mean, look, you can do whatever you want. I mean, there's a lot of ways to trade. I'm not being crazy aggressive. It's like I've got exposure. I allocate a percentage. I stick with that percentage to get a little crafty and creative. Some of it's options, some of it's ratio spreads, some of it's debit spreads, some of it's credit spreads. But there's income plays with all my options. There's speculation and growth plays. There's leverage plays. I mean, I probably turned about a 3 to 5% allocation in Bitcoin into like a 10% gain for my entire portfolio. That's pretty good. I'll take that. I mean, if I could do that with any asset, that's pretty impressive. So we'll see. You don't think MicroStrategy? It basically is. It basically is, but it's going to be more volatile because when Bitcoin didn't break all-time highs, MicroStrategy already was. When MicroStrategy barely had a pullback, or when Bitcoin barely had a pullback, I mean, it ran, and look at what MicroStrategy did. Like there's a lot of correlation, but MicroStrategy is going to be like the higher volatility version of Bitcoin. So I'm just saying, like, be careful. There's other ways to trade Bitcoin outside of trading MicroStrategy. Period. So all right. Anyway, Coinbase, same thing. It's a proxy. Doesn't mean it's the greatest thing ever. I'd rather trade IBIT. If you just want to trade like pure Bitcoin price, stick to a BlackRock ETF that looks like a good spot in good correlation where if Bitcoin's going higher, IBIT goes higher. The only downside is Bitcoin trades 24/7 and IBIT is opening bell to closing bell because it's a stock, it's an ETF, right? So, all right, let me get some currencies here before I go. We also have some bonus sessions coming today. Do I have a guest coming on after me, or are we just doing bonus session today at 1:30 with FOMC? Still a big day. FOMC this afternoon. Markets kind of making a little front running move. We'll see what it does. Hopefully, it is going to be one of these type days where it's just up and then sideways. I mean, at least that's what I'm crossing my fingers for, because I'd like to see my SPX trade still offer me some type of profit before we go into FOMC. Maybe it does, maybe it doesn't, but I'm probably going to have to require some time left in that trade. Super move on XAU. I disagree. I mean, it's down a little bit. In the bigger picture, I don't think gold is doing anything exciting at all. I think gold is doing what I want it to do, which is high, low, lower, high. And I'm looking for this thing to either one, continue to range, or finish out this completion, high, low, lower, high, lower, low, finish out that completion. That does not mean that I'm bearish on gold. All I'm doing is I'm waiting here with open arms to say, okay, gold, come back to where I want you to. And I'm going to establish some more positions here. 2,500, 2,400. I'm establishing 12-month positions on gold. It's that simple. I don't care what happens here. If it goes higher, I make money. If it goes lower, I'm waiting for it to come to me. But, you know, I mean, super move is dependent on your time frame. I'm not a short-term trader. Okay. Rarely am I scalping Forex. Rarely am I scalping anything other than maybe some day trading in futures, which, by the way, today, let me check my 9:30 candle. Obviously, I didn't take a trade on it, but there was my 9:30 candle. So nice little breakout to the upside on SP or ES rather. So there's my 9:30 breakout candle. And here is the same thing on NQ. Yep. So like a lot more volatility on ES futures than there was on NQ. Like that looks pretty quiet. That's a much sharper move on ES futures. Interesting. And we just came right down. This is not an accident. We came right down towards that weekly VWAP. So markets kind of finding like we're right back where we started from futures overnight, kind of right back where we started, bounced off the VWAP. Is there a direction to come today? Yes, no, maybe. The level I'm watching, just write this down, 610 SPY. Write that down. 610 is a pretty good liquidity hunt, in my opinion. I think we can find a way to hit it by Friday. And then QQQ, we might hit it today, but I'm just saying, like, write that level down. And then on the QQQ, it's up there. It's noticeable. 540 on the QQQ. So 610 SPY. I'll write it down so I can talk about it too. 610 SPY and 540 QQQ. Those two levels, I wouldn't be surprised if we hit those by Friday. Now, it could be like a flashy, aggressive, like spike up to them, and then it gets faded. They are like liquidity levels, number one, and then their potential market maker hedge levels, number two. Okay, so we'll see what ultimately we get. All right, let's go to currencies. I saw Aussie CAD, New Zealand CAD earlier in the session. I still like Aussie CAD long. I'm just going to wait for a trend line to break. I'm still in it. I still have a position in it. I'm waiting for this trend line to break. I'm looking to see if this thing will carve out some lows, break this trend line. I'm still looking to get long back up towards recent highs. I like Aussie CAD long and New Zealand CAD long, not just for a little bit of positive swap, because right now both central banks, Aussie and New Zealand, are greater than the CAD, which cut 50 basis points 2 weeks ago, or last week rather, and this week's the Fed. So it's a little positive carry, which is fine. Also, I see this as just a big range trade. So we have been making higher lows for a while, higher highs for a while. If we can bottom out here and go up, I'm looking for that trade in Aussie CAD to just really fulfill this range. So try to get back up to like 93.50 to 9400, and I'm happy on that trade. And then New Zealand CAD, similar to that, big range from high to low. We're still making higher lows, higher highs, swing low, swing high. I'm looking to see if we can bottom out in here, and rally back up towards 86.50 to 87, with my target being all the way up towards like 88. But if I'm long down here and I get all the way back up to this high, that is a good enough profit target. I don't need to hold on to this thing to 88 because we could come all the way back down again, come all the way back up again, come all the way down. I mean, it could take like several more waves of this channel to chop our way up to 88. So if we get a decent entry and a good run for reward to risk, I like New Zealand CAD long. Okay, Aussie New Zealand's. I'm currently long in this one, Aussie dollar. I'm dollar cost averaging into this one. This is dropping. And I'm going to get into, looks like position 1. I'm already in. Position 2 is potentially coming. So, look, I know this is probably a trade that makes a lot of traders nervous because they're like, oh my God, this thing's good. It's 50 pips against me. I'm down like tens of thousands of dollars because, people leverage like idiots. I'm in with small dollar cost average positions. I will test this area and I want to see, does this support that goes back to 2022 or the COVID crash low, will this support level matter? Because if it does matter from this range, then I could build small and I can hold a drawdown of maybe 1 or 2%, and I can turn this thing into a 4 to 5% upside. Okay. But I have to be, patient on this area, number 1, see if I get filled on the orders that I want. And I have to be small on the trade size, number 2. So these are the orders that I'm in Aussie dollar, and I'm just going to hang out of those for a little bit longer. New Zealand dollar, same thing. It's pushing a little bit lower. I'm now in on trade number 1 and 2. So this is trade 1. This is trade 2. This is pending order for trade 3. Multi-year support. I'm looking to see if this just goes from 63 and change all the way down to 55. That's a 1,000 pip move. Okay. So can we, work our way here? Can we have some, sweeps to this low? Can we have like a little price manipulation at these lows? Can we build a support level here and then come back up? And as I said, if all this trade is entered here, and this is a break even, and then I have a winner and a winner, I'll take 2 out of 3 trades winning and be happy. Like, I'll figure it out. But I'm going to dollar cost average in these trades. Now, the other trade that's doing pretty well is dollar CAD. We're higher. We're at 43.24. I have officially been filled on every buy stop order that I've placed since 4,000. Okay. So 1, 2, 3, 4. I also added in a 42.25 and a 42.50 and a 4,300. So all of my positions have been filled. If this goes up to my profit target at 44.50 to 4,500, let me see if I can move all of these. I'm going to go see if I can move this. I'm going to go 44.80. Right up towards that symmetry spot. So this is my measured move, and it was pretty conservative, but getting up to like 4,500 I think is very doable. I'll take profit at 44.80, and that's on all my stack positions. Okay, it's never a huge loss, Jonathan. It's never a huge loss because it's all about trade size, dude. Best way to do it would be this: trade small, trade small, trade small. If the trade continues to go against me, I take a loss in this trade, and then I work another position in. Here's an example. If I'm sitting at 10 to 20-year lows on a currency pair, pretty sure there's a chance we can go higher. So if I leveled in at support, let's say this is support and the market's coming down, and I go trade 1 and it goes against me, and I add trade 2, goes against me, I add trade 3. Now, I'm not looking to add to this thing forever. I have a mental stop of around 500 pips. If I'm upside down 500 pips, there's no reason for me to be hanging on to one trade for a 500 pip drawdown. So I start small. If this was against me 500 pips, okay, then I'll take a loss in this trade and I'll cut it, and I'll hold this one. I'll hold this one. Okay. Now, if I get out of that trade for 500, I'm probably throwing in another trade, right? And if I wait for a trend line break, I'll add more positions here with confirmation. So a lot of it is trade small, and you're never taking big losses. Okay. And then if you're testing levels, have a mental cutoff. For me, it's a dollar amount and it's a percentage amount that I'd say, okay, I'll stop out. But in the Forex market, I trade so small typically, and I compound my gains with stacked up positions, that if I lose on one entry, I'm always losing less than 1%. If, worst case scenario that I saw the last few years for me in Forex was I rode the dollar yen like an idiot from 120 to 150. Okay. Now, I took 1,000 pip losses on my losing trades. I lost about 1% of my account on that 1,000 pips. Okay. And so it went up from 120 to 130. That was 1,000 pips, about 1%. 130 to 140, lost 1% roughly, about 1,000 pips. 140 to 150, I held on to it. So I didn't lose that 3%. I got the topping right around that 150 to 152. We came all the way down towards 127. So I lost 2% on the way up, and I ended up gaining about 8% on the way down. So how to result? Was it a fun trade? No. I wrote a terrible trade for 3,000 pips the wrong direction, only lost 2% risk, ended up making 8% of the downside. Trade small. Easiest way to trade the Forex market is don't use leverage. I know that sounds crazy because that's the whole point of Forex is it's leverage. Well, if you use leverage, it works for you and works against you. Okay, where I use leverage is when I'm a lot more confident in direction and I stack my orders up to make my winners a lot bigger. Otherwise, I trade really, really small, build my positions at support areas, build my positions at resistance areas, and it's never a huge loss. Okay, and that's the most important thing. If you want to make money in the markets, don't lose big, ever. So how do you do that? Trade small, trade often. That's easy. That's philosophy that keeps your emotions in check. Never have a losing trade hurt you. Never get upset about a stupid trade. Learn from your losses, learn from your winners. Keep doing what you do best, and don't lose your butt. Seriously, like if you don't lose money, it's easy to make money. So yes, I take losses. I take losses a lot. But when I lose, it's probably less than I win. And also when I lose, I tend to just shrug it off and move on to another trade. So I don't know. My win record's fine. I mean, it's like clients have made money for 10 plus years. Currencies are pretty easy to trade because I trade really small and I sit on them for a month at a time, 3-6 months at a time. And then options is the easiest asset ever to trade because time is working on your side, or you can be like dead wrong in direction but have it be defined risk. It's like just use what assets you can and use the ability to trade options because you can be risk defined. Trade Forex small and don't use the leverage unless it's working to your advantage. So anyway, just my thoughts. Okay, will memes move the DJI? No. I don't know. And like I said, for that, I like Berkshire Hathaway better than UnitedHealth Group. Now that I think about that, I'm probably going to take a trade on Berkshire Hathaway, the B shares. SPX is actually working a little bit better now. Just by the way, we're pulling back down. This should be helping out my trade a little bit more. I'm just going to spot check this one before I go. And SPX 220 at 215. Traders, if you're with me in the morning session, I think I'm just going to take a break even on this one. We tried, it ran against us. I'm going to take a break even. So let me cancel this out. And then put in a 220. Try to get a 215 maybe. Try to get just get a break even or better. Cool. All right, so I'm out of the trade. Break even, that's fine. 220 was my original fill. I rode this thing up to like 320, 330. Now it's back down to 215. I'll watch this one. This might turn into be a profit for the morning, but I'm not going to take the risk and deal with it. It's 11:14. I've been in the trade for over an hour and 40 minutes. So I'm going to throw this into Telegram for my daily profit play service. Quick update. All eyes on Fed this afternoon, but I'm not going to ride this out. All right, so that trade is now trading at $2. Okay, so price is doing what I thought, right? We came back up, tried to fill this gap, and it's right there fading hard, and we're going to get right back to kind of neutral where we have the open on the day. So open here, high, coming back halfway, and it's a toss-up to where the Fed's going to take it later on today. Nobody knows. I said watch that 610 level, okay, and watch the 600 level. If you're looking at the SPY, 610, 600, and we've been in a range now for 3 weeks. Okay, you zoom out. I've got a green candle for the weekly, red candle for the weekly, green candle for the weekly. The problem is we have lower highs right here, and we have kind of, higher lows right here. So this is, getting either narrow where like the Fed is nothing but noise today, or this is the Fed that's somehow going to let the market, go higher and drift higher through Christmas and New Year's. If we get lucky, we'll hit all-time highs by the end of the year and keep going, and maybe just squeak out those little tiny gains. But the market breadth has been so concentrated and so crappy, and it's all Mag 7, but it doesn't mean there's a top, So just saying, we'll keep an eye on it. But my outlook is if the Fed is interruptive today or just noisy today, there's really not a lot of direction to look forward to by the end of the year. If somehow the market by Friday is back up towards these all-time highs, then we have probably a Christmas and New Year's gift, which will be Santa rally does show up and we get to higher highs by the end of the year. Okay, if the market somehow doesn't like any of this and the Fed, like say Jerome Powell today, and this is unlikely, let's say he's very vocal on inflation, then who knows? But I think it's going to be a bunch of noise today. So just expect a bunch of noise. And already at $1.90, $1.85. Look at that thing. So quick to get profit. You son of a gun. There's your profit target. Crazy. And profit target even hit. There it is. So that didn't take long. Nice little reversal on the day. It wasn't fun, though. We sat through that trade all morning. But better than taking a loss, that's for sure. Okay, I'm going to let you go for today. I'll be back with the team at 1:30. So FOMC, that's really what's on the table for today. Buckle up. Last major catalyst is FOMC today and core PCE on Friday. Keep an eye on the year-over-year numbers. The market may not have any type of reaction to it, but it's data that I'm compiling. Same thing with the EdgeFinder. Look at your CPI. Look at your data between CPI, PPI, and core PCE and PCE because these are all the preferred measures of inflation by the Fed. Inflation has gone higher. I keep referencing this, right? Trueflation. And we're probably higher than we were last summer. U.S. inflation index right back above 3.1%. We go to max this thing out. In the last year, this takes us back to 3.37. We're as high as we were since August of 2023. And we are worse off than we were back in June and May and June of 2023. So that is where, if I can quote the great Shania Twain, that don't impress me much. This whole battle on inflation is not working. So is the Fed trying to break something? No. There's still that whole argument of like no landing, soft landing, but it's going to get a little bumpy at some point if the Fed doesn't figure out that inflation's running hotter and they don't be restrictive. But that's for us to find out and us to trade and us to navigate and not do anything stupid. Okay, nice, Mark. Just grab your 20% on DPP. Thumbs up, man. Good stuff. Yeah, that was a quick. It's paying out real fast. Yep, real fast. Literally, if I sat on it for 5 minutes, I would have been profitable. But whatever, man. I'll take the break even. I don't care. Roll that thing out all morning. I'll take the break even. All right, I'll let you go. Be back at 1:30 for the FOMC. Come join us. Let's have a good session this afternoon with Jerome Powell and see where the fireworks go. All right, take care, everybody. See you soon. Bye.
Attention A1 Trading Show fans. If you're interested in getting free access to the EdgeFinder or our premium trade alerts, listen up. For a limited time, our show's partnered broker 8cap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to 8cap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now, back to the A1 Trading Show.
Hello, guys. It's good to be here. Hope you're all doing well. Basically, the end of the week, almost. Just 2 more days. And then we're done. So we've got FOMC tonight. I'm sure you guys have already spoken about this on the stream. So I won't go over that too much, but I wouldn't expect anything too exciting. I think 25 basis point cut, pretty cut and dry, bog standard, expected, no biggie. Wanga, good stuff. Hello, good to see you. So I'll be honest, I've got absolutely nothing to talk about. So it's all down to you guys. What do you want to discuss? What do you want to look at? Is there anything specific? Jovan, hello. Sashi. Yeah, I'm done. Completely done. I took one trade this morning on it was on the Dow. Very small, basically non-existent profit. It was more just to see if we get a reaction off this daily level here. Let me put trade history on here. So I was looking for a mean reversion trade, but again, very, very small. Basically just looking at the bottom of the Bollinger Band, we had oversold RSI, just looking for a very natural pullback here, as we've seen. Was it 9 days consecutive selling? So more than happy to just get in, get out, secure. I think it was like $40 profit. Nothing worth talking about. It covers a coffee and a muffin next time I go to the cafe. Phantom EU. I'm still a perma-bear EU. I don't see anything that is even remotely supportive. So I'll go into that a little bit more in a second. Let me just read what else is going on here. Loke, good to see you, buddy. Why would gold fall when US is going to cut rates? That's a good question. I'll cover that in a second. Bernard, good to see you. Nick is asking, how do you manage risk with dollar cost averaging, James? Chris just did a discussion on it, and I'd loved listening. Curious to hear your thoughts since you do some DCA. Yeah, okay, cool. So my DCA is, I'll be completely honest, I could not put this in a PDF. I couldn't do a mentorship, and I couldn't do a course on it because it's very, very discretional, and I don't like saying this, but it's true. It's a lot of it is based on intuition. So, for example, I mean, we all know EU has been a very, very cut and dry trade for the past 2 months. We've had very weak Eurozone data, pretty positive US situation as well. So that was the economic factor covered in terms of the direction. So it's more a case of sell the market, but obviously manage your risk. Let me put the trade history on so you can see here. So, for example, this is a great one. This is actually the trade that was quite painful. It gave me, I think, around 4.5% drawdown, this whole move here. So started selling here, moved against me, sold again, sold again, sold again, sold again, sold again. But as price was moving up, I wanted to get in at higher prices. And this position here was in roughly, I'd say maybe 1% drawdown after all of this move. So I was thinking, if I'm very bearish on euro dollar overall, I've already got a lot of positions in drawdown. I'm going to cut the largest loss, mitigate some risk, open up some more exposure. And then we had news. I'll be honest, I don't know what news this was, but it was some sort of news move. And I was like, this is perfect. We've just had a very, very strong bullish move in an overall bearish market. I'll sell again. So this position essentially just replaced the position I cut. So that, again, there is no super strict risk management methods. It's just, if the market's moving against me, I'll cut out the largest loser over and over as long as I need to, and keep re-adding in and replacing that one with a higher entry. But the other thing is, I do sort of scale up lot size as well. So I'm not uncommon with sort of martingale. So let me try and find an example. Euro dollars, not really here. Yeah, I actually can't see a recent one. Oh, here. So euro dollar selling started at one lot. Market was moving against me, scaling again at 1.5, scaling again at 1.5, and slowly bringing my average price up. So all I need then is just a small move to the downside, and I can get out to either break even or in profit. And if we think about the very basic way the markets move, it's in waves. So typically, we're not going to have a huge move to the upside that just doesn't stop. We will have some sort of move to the downside, and that's all I need really to get out. Nick Sean approach. Yeah, Nick, I actually watched quite a lot of Nick Sean when I was trying to develop this strategy a little bit more. So yeah, that was quite useful. Anyway, let's go back to EU. So yeah, there's nothing, in my opinion, in Europe that supports the euro at all. It's very, it's essentially a failing economy at the moment, the way I see it. And again, Germany is falling apart, and it's really dragging down the rest of the Eurozone. The ECB is very dovish, and maintains that dovish tone. So there's not, we don't even have a central bank that is, looking good. So having said that, the euro's weak. We're looking for dollar strength. As I said, I've been saying it for quite some time. I'm very bullish on the dollar. We've finally broken out of 107, and we may hold above. Obviously, we do have a rate cut coming pretty soon, so maybe we'll drop back down. But so far, so good. So yeah, that's basically it on euro dollar. I still see parity coming into play pretty soon. I'd say, if we don't see any type of pickup with the Eurozone data, I think parity will be with us in possibly the end of Q1 2025, maybe even sooner. But we will see. We do have some changes coming, of course. We are starting a new year. We've got Trump coming in as well. So we'll have to see how the market reacts when Trump actually does take over. James, do you cut your positions once they come back to break even right after a drawdown? No, not typically. So that's one of the things with dollar cost averaging. You have to be quite patient, because the whole idea is you want drawdown. The drawdown is what lets you build up a position. So when I enter a position, I don't want it to go into profit straight away. I want it to move against me so I can add in and add in and add in. But then obviously that is quite a large drawdown depending on the risk you use. But either way, it's going to be drawdown. So if you're sitting through 1, 2, 3% drawdown and then you're closing at break even, what's even the point? That you've just sat through drawdown for no reason. So you need to be able to sit through that sort of drawdown and then wait for the profit to make the whole trade worth it. Hey James, when are you going to restart trading? I'll be back trading in January at some point. Whenever I start seeing the markets pick up, again, to be fair, the markets are still quite active. I've missed a little bit here and there, but to be honest, I'm just not mentally with it anymore. I've done a whole year of just trading, streaming, YouTube, other business stuff, life. I'm just quite happy to get off and just relax. So yeah, I apologize. I know that it's probably not the most riveting segment of the stream, but I quite like sitting here and talking to you guys. What about GU? GU, I'm expecting it to follow in the same footsteps as euro dollar, not as dramatically. So I'm not expecting pound dollar to just, fall off a cliff, or fall off a cliff as badly as euro dollar has. Although the dollar dominance is very clear. If you look at the daily chart on pound dollar here, it's, doesn't take a genius to work out we're in a downtrend. 200 daily moving average is above price, indicating we've got a downtrend. It looks like we're now creating a lower high on the daily. The H4, bearish candles. So yeah, generally speaking, I think it's pretty good. A pretty good trade to the downside. It's just mainly trying to find an entry. The market is quite choppy on the H4. We are moving to the downside, but trying to get an entry in this point is a little difficult unless you're using a wide stop loss. So, yeah. James, question, this is pyramiding, meaning you only add if you're in profit? No, Thomas, I do the opposite. I only add if I'm in drawdown. And again, it sounds very, it sounds like gambling. And to be honest, it kind of is if you don't approach it right, which is why I don't give signals for it. So if you, for example, if you're in my Discord, you're not going to see me saying, I'm going to start selling euro dollar, enter now, because I can't help your risk. I can't sit by you and say, I'm going to exit now because I feel like exiting now. It just feels like the right thing to do. Or I'm going to increase my risk on this entry, blah, blah, blah. Because all it takes is one person to join, say, I've never done this before. I don't know what's going on, but you've made good returns. I'm going to go full margin, and that's their account gone. So I don't actually know where I was going with that, but there you go. Any thoughts on pound Swiss? Let's see. Yeah, it's still stuck on this weekly resistance level, which isn't really giving me much confidence. It seems like we attempted to break out to the upside, failed, sellers came into the market, and now we're seeing a push back down. which again is not favorable really if you are looking to go long. I would have liked to see a complete breakout, the weekly candle close above, which could still happen. It's only Wednesday. A retest and then a continuation. In this situation, this retest would likely have to be on the H4 or H1, because obviously we're looking at the weekly. We're not going to sit here for 3 weeks waiting for a retest. Daily's bullish, H4's bullish, the hourly's bullish. I think I'm actually quite neutral on the pound, but if we can break out of this level of resistance, I think we're pretty set really to go higher up to the next highs. So this will be around the 1.163 area, something like this. When you do the DCA method, does your R&R get hit by commissions and swap fees? Yes. So I was talking about this. I made a YouTube video today, actually. Let me show you. So for anyone that doesn't know, your Sharpe ratio is basically what indicates the volatility of your portfolio. So let's say you're having huge swings in equity. Let's say you're having massive drawdown, massive profit, but your balance is, you know, doing something else. Is volatility in your portfolio, and that's what the Sharpe ratio essentially tells you. So I'm getting a really bad Sharpe rating or Sharpe ratio because obviously I want drawdown. That's what I'm looking for. So yeah, the metrics generally don't look very good. I mean, the win rate's really good, 67% out of 352 trades. But, you know, the profit factor's not the best. It would ideally be at least 1 to 1.5. Sharpe ratio is pretty terrible, to be quite honest. Expectancy of 9 pips. Again, that's really, really poor. Well, especially the $14 on a 30K account. So you can see the metrics are impacted quite a lot. And yeah, the swap fees aren't too bad. Commissions, I'm on a commission-free account. I choose standard, so that's not an issue. Do you like the gold short? Ball out, what were you saying? I was looking at gold just before I came on the stream. I remember you said something about gold yesterday or the day before. I can't remember what you said. I don't know if it was long or short, but it's still not really telling me anything. Again, there is no reason to buy or sell gold in my book. I say this all the time, but when I'm trading gold, it's normally because there's something to drive it, whether it be a, what do you call it? A catalyst, well, obviously a catalyst, but whether it be like global tensions or rate cuts, whatever it may be. And at the moment, we don't have that. So there's no reason for me to fundamentally trade gold, but there's also no technical setup. So yeah, it's, for me, there's absolutely nothing to do. Now let's see it come down a bit more, then look for buy setups on 2700s. Yeah, if we could see a nice drop, a drop that's, I suppose you could call it like a healthy pullback would be fine. But yeah, I think, yeah, I'm not even sure if I'd be happy buying the dips on gold at this point. We'll see. Okay, so you're short and then looking for longs. That makes sense. Okay. Yeah, I think, yeah, for me, I'm quite happy to just sit out, really. I mean, I've said this before, but I just don't see much in the markets that's really worth trading. So euro dollar is very extended, so there's no swing or even intraday positions. All I can do there is DCA. Euro pound, very extended. I'm still bearish. Dollar CAD, I'm still bullish, but it's very extended. The US dollar against the NOK, it's very extended. I would like to go short, but the economics don't support it right now. So yeah, there's nothing really for me to do. Even the New Zealand dollar, again, love to go short, but there's just no options here. I missed this entry. The market gapped. We've not had a pullback to where I would have liked to go in for a second entry. It's just melting. So yeah, there is nothing for me here. Any ideas on dollar yen? Currently holding a long position on it. You know what's interesting? I have been, I was super bearish on the yen. Then I turned pretty bullish. No, wait, the reverse. I was pretty bullish, then bearish, then bullish. And well, actually now, but anyway, whatever. So we are currently in euro yen shorts. And if any of you guys have watched Nick's recent video on the yen, you might understand why. I mean, that's only a small factor, but obviously the euro isn't great. I won't repeat myself again. But yeah, I wouldn't be surprised if we do start seeing the yen start to take some dominance back from the dollar. Now, I'm saying that, but to be honest, I'm not 100% confident in that idea, just because the dollar is doing super well as well. So it's more a case of if I was going short, if I was looking to do that, it'd be something similar to this. But I'm not looking to sell the dollar. So yeah, to be honest, that's probably the most unhelpful analysis you've ever had. But yeah, in my opinion, this market's kind of a no-go zone. Euro yen, I'd use one of the other yen crosses, so euro yen, Australian dollar yen. In fact, the Australian dollar yen might be quite good. The Australian dollar's taken a real hit recently. If we are looking for some potential yen strength, you could have quite a nice position there. If dollar stays strong and tomorrow is JPY policy, any suggestion on JPY pairs? I don't think we're going to get any sort of hike from the Bank of Japan tomorrow. I think we're going to get a hold, which I think is actually kind of priced in now. I don't think it's going to be a huge shock if we do start seeing... I don't think it'll be a huge shock if we do see them hold rates. So I don't think we'll see much of an impact. If they do hike, obviously we'll start seeing the yen start to take some strength and pull in some buyers. But I think it'll be relatively neutral. What you've got to understand about rate decisions, so like, for example, tonight's FOMC or the Bank of Japan statement, normally they're not huge market movers unless the decision is outside of what people are expecting. So, for example, if the Fed decides to cut 50 basis points tonight, that would be pretty drastic, and that would cause some really strong movements. If they held their rates, I would also expect bullish movements, but because it's really... again, it's expected as a 25 cut. No one's really going to be too bothered. And obviously, that's a very face value way of explaining it. There are outliers in certain situations and things, but there you go. I just went short Australian dollar yen with small size, China weakness, JPY cut data, and EF reading. Yeah, Nick, that sounds like a good position, actually. Yeah. It's in a pretty good spot really to go short, especially the daily area chart looks quite strong. We could go short here, stop loss just at these previous highs. Daily 200 moving average here is above price, and the support level down here at sort of 80, actually a little bit higher, I'd say 88.1. That's pretty spicy, I would say. That's possibly a good Christmas present from the markets. All right, notes, thanks. Will be break even plus my position and wait for any sign of USD weak or strong for further ideas. Good stuff, Adam. Nick, it's like we share a brain. Yeah, good stuff. At least me and Nick are on the same page. I know I'm doing something right in that case. So, yeah, I think the dollar, again, it might take a small hit today as we do get a rate cut, but I would doubt it. Generally speaking, I'm still quite happy to target this 110 level for now. It's relatively unchanged in my view. Fundamentally, Aussie is getting weaker. Why are you long in Aussie? No, we're talking about shorting the Aussie. So if you're going short on the Australian dollar yen, you're selling the Australian dollar and going long on the yen. Yeah, we could be wrong together. You'll see an upset Nick and James on the next stream. So yeah, the reason for the euro yen short is essentially this. I mean, I've already covered the yen. Sorry, I've already covered the euro, but the yen, it's the same idea. It's more a case of going long on the yen. Well, actually, I would say it's an idea of going long yen, short euro, but that's obvious. But yeah, it's same with the Australian dollar yen. It's pretty cut and dry, really. There isn't any real hard supporting factors for these markets. The euro, I mean, look at China, Australia. The Australian economy is taking a hit. The currency's taking a hit. Eurozone's taking a hit. The euro's taking a hit. So yeah, the yen could be quite a nice play. The Magic 8 Ball says it so. Sean, amazing. I'm glad your 8 Ball is here to assist us with trading. Which will benefit when geopolitical situation, USD or JPY? Adam, that's another good point. They both generally do quite well. The US dollar and the yen both benefit from war primarily. Obviously, the yen is a safe haven, so that generally benefits regardless if there is a risk-off movement. The dollar, the way I see the dollar is normally if there is some sort of war, like the Middle East or Russia-Ukraine, we'll see dollar strength as well, which is another little downside for dollar yen, because, yeah, it's just not my favorite. Wait till I bust out the magic 3-sided coin toss. How does that work? Oil, my position on oil hasn't changed drastically. I'm not really sure what's going on with the oil market. I'll be completely honest. But again, as I was saying yesterday, I think it was yesterday, man, these streams all seem to merge into one. But I was saying previously, from everything I've read on oil, it doesn't sound that positive. We do have OPEC plus cuts that have been extended, but it seems like the larger perspective from the institutions is more looking towards renewable energy, which they are expecting to obviously have a little bit of an effect on the oil market. So again, this is just from what I've read, the crude oil is around 70% of the energy the energy markets. And they're expecting renewable to start replacing this. Obviously not straight away. It's not going to be a case of oil just goes to zero and everyone moves to electric, but slowly up until sort of 2050, we will start seeing oil start to take a backseat to renewable energies. So obviously I'm not going to start shorting oil with the hope of 2050 I'm profiting, but it's just something to keep in mind. Do you think SPY calls are a good idea? Daryl, I'm going to be completely honest with you. I have no idea. I don't really know what to call, actually. I think if you're buying a call, you're essentially buying the S&P, I think. Again, I'm just a G10 CFD degenerate trader. I don't trade futures or options or anything like that, so I'm very uneducated in that area. But to be honest, I think it's probably the best place you're going to get to buy, unless we do see some sort of strong downturn, which I wouldn't say is super likely. But yeah, I think it's pretty standard entry, really. Looking for next year, when would you expect the dollar to start to weaken? I don't see anything on the table right now for dollar weakness. I think something I'm cautious of is if we look back to 2016 here. Now, I've mentioned this before, and it's not a huge deal. It's just, again, something I'm just sort of paying attention to. November here. So this was when Trump was elected, roughly. I think the date might be slightly wrong, but it was November 2016. What we saw was, if we get the price range, so we saw a move to the upside of around 8.2%. Then what followed that was, let me go here, a move of almost 15% to the downside. So, could we be having the same thing where we've had the election? So where was that? October. So here we've had almost half of the move we had in 2016. But if we go up to 110, we'll be approaching it. And again, it's not based on fact. This is more, again, using the previous Trump election as a reference point. But could we then go and see a huge decline on the dollar? Don't know. But it's something worth just keeping an eye on. You don't want to be caught in a negative 15% move on the dollar. That would be quite a nasty trip for the bulls. But yeah, to answer your question straightforwards, I don't really have anything in mind that's going to be a huge detriment to the dollar at the moment. Obviously, my outlook might change as we see more data, and as we hear Jay Powell start to yap tonight. JPY is not related to gold. It's all about Fed right now. After Fed show, we'll know where the market's heading. Yeah, okay. The second and third year of a second term of a president is something to look at for bearishness, though first term and second term be separated by another president that only occurred once prior. Interesting. Yeah. I need to look more into the statistics, really. Because it's not really well, I guess it is seasonality, but no seasonality tools, as far as I know, have that level of detail. So I think it's something you probably have to go and do manually, but I'll be honest, I can't be bothered to do that. So that might be on the to-do list for James in 2025. Be careful for JPY policy. Yes, Roop, I think it's pretty expected. We're just going to have a hold. I mean, I could be wrong. We might see a small hike, but even so, I wouldn't, nothing too crazy. Random stats for 300 Alex. I've got no idea what that means, Sean. So what else have we got? Bitcoin. It's taken a little bit of a dive today, actually, or a little hit. Nothing too major. Weekly candle is looking slightly weak. No pun intended. Quite a strong wick to the upside, although we have seen that before. It doesn't really mean much. But could this be where we start seeing a reversal? I don't know. Maybe all the McDonald's crypto bros need to start withdrawing to pay for Christmas presents. Did you already cover dollar Swiss? I haven't covered dollar Swiss, actually. Yeah, I'm still a bit cautious about the long term, but I think generally speaking, you're not going to go wrong buying the dollar at the moment. I mean, look at dollar CAD, euro dollar, pound dollar. All of the dollar pairs are holding up, apart from dollar yen. Actually, that's kind of the only sort of stagnant pair. I wouldn't be buying now if you are looking to buy. It'd be more a case of just waiting for the next pullback, see if we can get some sort of touch here on our 200 moving average, wait for the RSI to become oversold, and then look for an entry possibly somewhere around here would be good. It's a Jeopardy reference, old school game show. Hate to say it, Sean, but I think that might be a bit before my time. Anthony, okay, you agree with Sean. Maybe I do need to have a look into this then. Maybe I might be missing a trick. Will crypto go up during FOMC? I'll be perfectly honest, I have no clue. I don't really know what drives Bitcoin in which way. And that might be a little bit naive. But I've been saying I wouldn't expect anything from FOMC in terms of market movements, major market movements. You might see some, a couple of ticks movement here and there, maybe even a small spike, but I wouldn't expect any huge market moving, noteworthy movements come from it. Obviously, unless we get some, some decision that no one's expecting, which is highly doubtful. New Zealand yen and Dow Jones. Yeah, I'll do Dow Jones because I was already looking at it. So Dow is in a tricky spot for me because I don't mind where it is right now, actually, for a long position. So if we look at the daily and we're looking this would be more of a mean reversion approach. So I was long. Again, I'm not really looking to hold anything. It was a very small short-term trade. I got, I think, around $40, so not much. But we're down at the bottom of our Bollinger Band. Again, it's not a huge deal, but it is a sign that we could be popping back to the upside. The RSI is oversold. So if we look typically, Dow oversold here, bottom of the Bollinger Band, RSI oversold. Same thing here at the bottom of our Bollinger Band, oversold RSI. Same thing here, or actually almost the same thing here. So just looking at the way the Dow behaves, it wouldn't surprise me if we do continue up from here, or at least have some sort of pullback. But that's obviously just technicals. In terms of what's actually moving the Dow, again, not a clue at the moment. I have no idea what's driven the Dow movements. It could have been general profit taking before the end of the year. You know, again, that wouldn't be a huge surprise to me. I was saying last week that one of the reasons I'm not really too active in the markets towards the end of the year is because we often see profit taking moves and then a serious slowdown of liquidity, which obviously means you're just stuck in trades, really. Okay, someone also asked for New Zealand yen. I think this could also be a good one. Similar reasons for the Australian dollar yen. We've got pretty weak China situation. And yen, the Bank of Japan are going to hike rates at some point. So if it's not now, or if it's not the December meeting, then likely it will be the next one. But obviously trying to hold for that long might be a little bit difficult. But either way, with the weaker situation over there with Australia, China, and New Zealand, I think going short's probably quite a good call. The tricky thing is trying to find a take profit level. So I guess you've got here, so our double bottom down here, or you've got this sort of previous low, and trying to gauge where you'd actually want to take profit here is a little bit tricky as far as I'm concerned. So what we could do, or what I sometimes do in this situation where I've got a large area of support, you can actually look for the 50% level of this. So you just draw a fib, look for where's the 50% move. It would be here. So this is half the size of the support, or sorry, halfway down into support. Rate result or Powell speech is more important. Adam, I'd say it's the Powell speech, to be honest. Again, the rate cut's not going to be, or highly likely won't be anything too crazy. It's probably just going to be a 25 basis point cut. So yeah, the speech will be more important because that will give us some signals on what the Fed wants to do next, or, you know, or it could just be a yap fest. It could just be, oh, we're taking it on a data perspective, blah, 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 blah. So, yeah. But still, I'd say the speech is more important. No, Fashish, I won't be buying anything. I'm completely done for the year. I have one position on Euro Yen, and that's it. Hey, James, what do you think about silver? I don't know, to be honest. I think it looks better than gold in terms of just general structure and price action. We're coming down into a really strong support here on the H4. So if you are looking to buy, I would say this is kind of the only level in my book, the only level I pay attention to, really. I think it'd be a bit overly optimistic to target these previous highs up at 34. So I'd more look just for a correction of the previous high around here. In that case, you'd need a relatively tight stop somewhere around there. I think this is possibly a play, but again, for me, there isn't really enough to drive this trade. There's not enough for me to be convinced to get in. United Healthcare. That's true, Bryce. I completely forgot United Healthcare situation was going on, actually. I know their stock's not doing well. Hold on. I don't even know what the ticker is. Okay, so UNH. It seems to be recovering now, actually. To be honest, if the, again, this is hypothetical, I actually don't know, but if you are looking to buy this market, now is probably quite a good opportunity too. Probably the largest pullback we've seen in quite a while. Kind of the definition of buying low. Obviously, it's a little bit risky because I don't know anything about the company, so don't now go out and buy the stock. But I'm just saying that on the face value, maybe not a bad area. If the rate cute by 25 basis points, what does that mean for USD? Is it stronger or weaker? Myron, it's pretty neutral. Overall, rate cuts are pretty bearish for the currency, but it's already been priced in, so nothing crazy. Any suggestions on pound yen? I'd more be looking to go short on pound yen. And again, this is just because we've seen quite a large increase in longs on the yen. Let's have a look here. Actually, cut history is probably a bit better to display this. Let's do JPY. So I know Nick did a video about this, so I won't go over it too much, but just to visualize it, we've had net change went for a period of being bearish here, and the net positioning also went through a period of being bearish. But what we've seen is a COT flip is what it's known as, or what I've learned as. Essentially what a COT flip is, when we go from a net positioning of bearish or bullish and we flip into the other side. So in this situation, we've gone from a bearish positioning into bullish, and that's now just increased even more. So what we've got is on the 22nd November, we had a 3,000 short contracts reduced or removed, 15,000 long contracts added, another decrease in shorts, addition to longs, decrease in shorts, addition to longs, and again on the 13th of December, reduction in shorts and addition to longs. So to me, something is building up, and I'm not to sound like a broken record, but I think Nick is pretty on the mark really when he says we saw it again. Saw it the first time during this period in July when we saw the market flash crash. Now, I'm not saying we're going to get a huge flash crash again where we see the Nikkei drop, was it 40% or whatever it was? But, with the hikes pretty much around the corner, and a possibility of an intervention, I think going long on the yen and short basically everything else is pretty solid, but that excludes the US dollar. So if I was going short, it possibly just be very simple like this, stop above the high. Yeah, very simple stuff. Although it looks a little bit dodgy to enter this right now. So obviously do your own research as always. What do you look for when the speech is on? More rate cut or less rate cut, which is bullish for the US dollar? That's a good question. When you're listening to the speech, you basically just need to listen to everything, because small things can have meaning. So yeah, pay attention to what's going on. Also, get a copy of the speech if you can, see what's being redacted. That's always quite good to actually have a copy of it so you can reread it. But yeah, less rate cuts will be a good sign for the dollar. Amir, we've already looked at gold, but I'll look again, but there's nothing to do, to be honest, buddy. It's just a case of more sideways movements. We're having a slight move to the downside, but we're still pretty much stuck in this range. There isn't anything for me to do here. Why do they price the expected rate cut in before it's been released? Bryce, that's quite a cool idea. Quite a cool question. So let me think. I'm trying to think of an analogy for this. So it's probably a really bad analogy, but it's all I can think of off the top of my head. Let's say you're wanting food, and I say that, hold on, let me just try and make sure I'm actually going to make sense when I say this. That's, yeah, not a good analogy. So basically what it is profiting off the move. So if you're short, let's just take this chart for example purposes. Let's say we're here and the Fed comes out sounding dovish. They're not happy with the labor market. They're not happy with inflation, blah, 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 whatever else it may be. We start saying, okay, what is the result of what they've just said? What is the current data behind the labor market? What's going on? If we know, or we have a team of analysts, obviously we're talking about the large market movers. If they have a team of analysts saying, okay, Fed's just said this is going on the economy, we think this is going to happen, the Fed likely is going to cut. Why would you carry on buying if you think they're going to cut? So people start selling, then more people start selling, then retail comes in and starts selling. And this eventually is what drives the downside move. So when that rate cut actually happens, everyone's already in the market. It's already expected. There's no rush to go and buy or sell because, again, they're already in the positions for that result, which is why if the result or if the decision is different for what people are expecting, that's when we start getting large fluctuations. People get out of positions very quickly. They add into new positions very quickly. And that's what causes these large volatility in the markets. I hope that made sense. I couldn't think of a good analogy for that one. As I said, my brain's pretty checked out for the year, so apologies. The yen is actually not doing too hot today. Euro's continuing its decline. Actually, it's quite a major level that we're at now. Let me get rid of these here. To be honest, if the euro can't stay at the current level, I would imagine this to basically just be a waterfall. There is no structure. Obviously, from a technical aspect, there is no structure here really to support the price or to induce any buyers. And again, if we've got weak economics, it could be a little bit of trouble. So we shall see. But I think, yeah, Euro's in some serious problems at the moment. When is the FOMC press conference? It's at 7 p.m. my time. It's currently 5, so we've got 2 hours. So it's a little while away now. Actually, let me just check. I got rid of my EdgeFinder. That's annoying. What's the date? 18th. Okay, cool. I think I've got about 10 minutes left, and then Kenzo's coming to take over. So if there's any final questions, let me know. If not, we can just have a look through the EdgeFinder and see if we can find anything interesting going on. So a 50 basis point cut would be good for movement, bullish or bearish short term. If we got a 50 basis point cut, that would likely be very bearish for the dollar. I can't imagine that being a good situation at all. Noted, this week should be the last week to continue trading before volume goes down. And when does volume go back up? Yeah, I'd say, to be honest, after Friday, in my opinion, the trading markets are basically done until I'd say the second week of January, really. So the first week is okay, but it's not the best because we've just come out of New Year. There's people still on holidays. It's just not the best period. So yeah, basically from now until mid-January is basically no-go trading for me. Are rate cuts bullish or bearish sentiment for indices? Good question. So a rate cut is good for companies. We'll use the Russell because the Russell reacts really well to rate cuts and hikes. So when we have rate hikes, now this might not be, no, this wasn't a rate hike. But yeah, either way, anyway, besides the point, what we see is indices typically do well in an easing cycle or rate cutting and do poorly in rate hikes. Now, why would that be? Well, let's say you have a company, it's a small business or a large business, it doesn't really matter too much. But let's say you want to buy, let's say you want to expand and you want to open a new office in somewhere else, you obviously need a loan for that, generally speaking. But for that loan, if the rates are high, then you're going to be paying more on that. So you'll be paying more interest on that loan, which is obviously quite damaging. It's the same for mortgages. It's the same for the general population will be paying more when they borrow money. So that generally is quite a negative outlook for the indices, which is obviously made up of businesses or companies. So if they want to wait until rates are lower, they will be paying lower interest rates on that loan. So that's generally pretty positive. Again, that was a very basic way of explaining it, but that's the general idea. Hamed, I think you're probably the 50th person to ask me this week about gold. There is absolutely nothing going on. I don't think the Fed decision will do anything to gold. We might see, again, we might see some small movements, but I don't think it's going to really be enough to break out of the what we in like a 14-day range, something like that. Let's see, actually. Date range, we started here, still going on 22 days of basically just range. Obviously, we did have a pop out here, but we've just returned right back into it. So I'm going to call it a 23-day range. You're right. This is not a good time to trade until after the holidays. Yes, Faith, I agree. Rate cuts decrease the cost of borrowing. Yeah, Wonga, that was a much better way of explaining it than I did, I think. But yeah, basically you can borrow money for less money. And that's actually where the idea that indices and the dollar are negatively correlated, which isn't completely true. I mean, we're seeing that now. I mean, yes, well, actually not the S&P, but the Nasdaq moving higher, dollar moving higher. So they're not completely inversed. But when we have a pretty aggressive rate cutting cycle, we'll see the indices do well, and typically we'll see the dollar do pretty poorly. So that's where the idea of the inverse correlation comes in, which is a little bit of a misconception sometimes. Okay. Cool. All right. So is there anything else you guys want to discuss before I head off? Euro pound is giving me a little bit of FOMO, to be honest. So I was in some shorts here. Where is Euro pound here? Trade history there. So I was in the shorts here, and the drawdown was not too bad, but it definitely wasn't ideal. And it got to the point where, obviously, like I said, I've been closing out positions for Christmas. So I just got out at this, as soon as I could, which was break even in this situation. Whereas if I just held, this would have been pretty large, probably would have been a 7 to 8% return, which it would have been lovely. But, you know, hindsight is a killer sometimes. Natural gas. It's interesting. We've had a couple of people ask about natural gas recently. There we go. I called the market. I did it. I think it was, again, yesterday or the day before. I can't remember. Said that this support looks pretty good to go and buy. So there you go. Ignore the arrow to the downside. Obviously, I didn't call either bullish or bearish. I definitely said the market's going to the upside. No, I'm joking, obviously. But yeah, it's reacted off support level quite nicely. In terms of the drivers, I honestly could not tell you what's actually going on with natural gas. But the way that we've seen this rejection is quite hopeful to me. It's a little bit late to go in for a buy now, to be honest. First level of resistance is here. If we manage to break above, I'd be quite happy to target previous highs. Something along these lines, maybe try and get a 1 to 2 at least. Yeah, something along like that would be okay. Pound dollar go to last top. I'm not sure what you mean. Do you mean we're going to have a double top? But yeah, I'm not sure. We might see, some relatively, well, I'm going to say strange, but maybe not strange, as we sort of movements as we come into FOMC. I wouldn't expect any any significant moves until after FOMC now. I think we're pretty much just going to be pre-news ranging. Nat gas used for AI for power it up as clean energy. Yeah, I think natural gas could be quite a nice buy, but again, I've not really done any research into natural gas, especially recently. So yeah, just seeing if there's anything I've missed here. Yeah, I think dollar CAD, I spoke about this one the other day as well. It seems basically set to go. Yeah, I've been saying this for a while actually, but I might, and this is a strong might. It's definitely not an I will. I might go short when we get to this previous high, and just see if we can get some sort of mean reversion, because. And it looks like we will get it. But if we look at the way that this is formed, this was 2016. Then we've got 2020. Now it's 2024. And it's very likely we'll get to this resistance before the end of the year. I'm pretty confident so we will. So that's a 4-year cycle. And the past 2 times we've come here, we've had a pretty strong rejection to the downside. And again, this is just basic technicals. There's no fundamentals to back up a bearish market here yet, but it might be, if you could manage to do this, it would be a very, very profitable trade. So we'll see. Ball out, we've got a similar idea on that one. Jason Shapiro. I've got no idea who that is. I know Larry Williams. They're long on natural gas. Interesting. US 30. Yeah, we've already covered US 30, but I think we're at a pretty critical point now as far as I'm concerned. So we've got this daily Bollinger Band, oversold RSI. So from a mean reversion perspective, it seems quite realistic to say we're going to have at least some sort of pullback, if not continue higher. If we continue to the downside, I think it could get quite nasty. I think we would be in a short-term bear market then. And when I say short-term, I'm saying short-term because I don't think we're just going to start plunging to the downside, but we might start taking out some of the recent higher lows. But we do also have, as someone said earlier, we've got the UnitedHealth group or whatever they're called, the American health insurance people, the guy that got not doing too well these days. That stock was dragging down the Dow, and it seems like we might be having a bit of a correction now. So we'll see. So yeah, as for US 30, I think if you're going to buy, I think now would be the time. And if you're taking out, then stay out because it's likely we're going to continue to the downside a bit further. Nasdaq, I think we're pretty, what is there to say about Nasdaq? It's just going higher and higher and higher. It's more a case of when's the next pullback and how can I buy it, rather than is it going to go up or is it going to go down? Now, obviously, that won't work forever. Eventually, we'll have a pretty strong downside move. It's just I don't really see that as a situation that we're going to have pretty soon. So I'd be looking, mainly for some sort of pullback within this area, just to go higher. It'd also be nice to see price come and meet this 200 moving average. We enter here. That would be pretty smooth, pretty stable. TR. Please rewind a little bit. I really can't do gold again. I'm going to get sick of saying there is nothing to do here and it's in a range. Okay, cool. Euro pound continuing its drop. Euro dollar's continuing to move down, actually. We're still holding on to our level of support, however. Similar thing, actually, as I was saying on the Euro index, I think once we break this level of support, which is very strong, this is the daily time frame. When I'm gonna say when, because I'm very confident that we will. When we break here, I just don't see any sort of, again, no fundamentals, but there's also not really any structure here to help support price. So I think we might have quite a nice waterfall to the downside on euro dollar once this support is breached. Is it all right to go over AUD CAD? I can give you a technical outlook just because I'm a little bit over my time here, I think. I'm not sure the next guest is here, so I don't want to run into their time. But AUD CAD, downside makes sense. The Australian dollar has been impacted by China quite heavily. Canadian dollar is not my favorite, although oil seems to be performing quite well recently. It's just not something I would really want to get too heavy on longs. But I think, generally speaking, a short does make more sense, to be honest. So I'd go short here, stop loss above previous highs, and a take profit possibly just at the next low down here. Now, this isn't the best trade, and it's probably not what, well, it's actually not what I would do. But that's my very brief outlook for you. Okay, cool. Yeah, TR Journal. Sorry, it's not. I'm not trying to be rude. It's just I've been asked to cover gold so many times. I just don't like. I don't want to sit here and repeat myself over and over. Gets a bit boring for you guys and for me as well. XRP. I can tell you a little bit in terms of the technicals, but again, you know, I say this every time. I'm probably the last person you want to ask about crypto. So what do we have here? I'm going to be honest, and it might be a little bit contrarian. I don't really know what the sentiment is within the retail space for XRP, but it wouldn't surprise me if this move we've had here is basically a repeat of what we had last time here. Is very extended, so a natural pullback, mean reversion would make sense. This is also in line with previous resistance, or slightly. So yeah, just from a technical standpoint, I wouldn't want to buy it right now. I would need to see some type of move to the downside before looking to buy. Once EJ starts selling, where do you see it dropping to? I've actually marked up all my levels on EJ. So it's all these. It's basically just the next low. So I'll probably look to take profits at either the first low or the second low, which would be 156.9 or 156.0. I think if the yen does strengthen and it maintains its strength, I'd be quite happy to say we're actually going possibly even lower, maybe down to 140. And again, this is more assuming that the euro data isn't going to start improving quite quickly, which I don't think it will really. I'd be quite happy to say 140 long term might be in play. What do you think about pound Swiss? We've already covered pound Swiss, but I'll do it again just while we wait for Kenzo to arrive. Basically, I don't like the resistance that we're on this weekly. We have seen price briefly break above. Oh, it's a horrible circle. Price briefly broke above our level of resistance, and sellers quickly came in and pushed the candle back down. Really, for me to be interested in this market, I'd need to see the weekly candle close above, and I'd need to see sort of an H4 Some candles on the H4 time frame come back, retest this resistance, and then I might start looking to buy. But yeah, there's nothing specific on this chart that jumps out at me. I wouldn't want to start selling, but I think it's a little bit too early to start buying, in my opinion. Okay. Sorry, I was reading a message. So let's just have a quick look at the CME thing here. It's not changed, actually. It's slightly increased. So it's basically, it's pretty much 100% that we're going to get a rate cut here. 1.4% that we have a hold. If we do get a hold, I'd expect the dollar to be pretty aggressive to the upside. But other than that, I wouldn't expect anything too memorable, really, in terms of price movements for the dollar today. What do we have for the rest of the week? Let's see. So we've got Bank of Japan rate decision tomorrow. We've got GDP for the US. Policy statement for the pound. Unemployment claims for the US. That's about it, really. We've got retail sales for the pound on Friday, but yeah, pretty flat, really. Nothing too interesting going on. Should I buy some Bitcoin before Jerome Powell starts talking? Swift, what you need to do, get your mum's credit card, max out her overdraft, get a loan, take a mortgage on your house, sell your car, sell your dog, buy some Bitcoin. That's that's not financial advice. No, I'm joking, of course. I've got no idea. Crypto's out of my realm. And even if it was, I wouldn't sit here and tell you what to do with your own money. How about GBP JPY? Is it a wise setup to sell from 197? James. Hello, James.
Hey, James. How you doing?
Hey, how are you?
Hey, thanks for taking over the string for so long here. We haven't heard from Kenzo, so I'm going to go ahead and step in and relieve you of your duties. Appreciate you for streaming with us today.
All good. Thank you for having me.
Guys, we just dropped James's link here in the chat, so you can go subscribe to James if you enjoyed his commentary today. He's one of our regulars. He's usually on 2 to 3 times a week, so if you are interested in James, you can go check out his channel, and you can always find him here on the stream. But yeah, James, thanks for coming on today.
Cool. Thank you for having me. See you later, guys. Have a good day.
All right, guys, we are going to do something a little bit different now. We are going to transition just a bit here, and we are going to do some trivia. All right, if I'm on stream, we're about to do some trivia. So here's what's going to happen. We've got about an hour and a half until FOMC. Nick will be back on here in a little bit, but until then, we can hang out, we can do some trivia, and somebody is going to be going home with either the EdgeFinder or the stock box. So let me get my wheel pulled up here. I don't have the 2 monitors that I normally have. If you can't tell by this very different looking setup, we're working from home at the moment, but everything is still going to work the same. I've got the wheel pulled up. I can show you that right here. Here's the wheel. So I've got the wheel ready to go. Back to trivia. All right. So if you're unfamiliar, this is how it's going to work. I've shortened it just a little bit. In the past, we did 12 questions. Today, we're only doing 10. So 10 questions. I have the chat pulled up right in front of me. Everybody give me a yes. Everybody tell me that you're ready to go if you're ready for trivia, so I can see who's playing. I've got the chat pulled up right in front of me. And these are the rules. Number 1, you have to type out the entire answer. Okay? We've done it a few ways in the past. This is definitely the best way to go. This way, whoever was the quickest really is the winner, and we don't have people spamming A, B, C, D, whatever. Most of these are multiple choice. I think towards the end, I included some that aren't multiple choice. So for that one, you're going to have to just give the correct answer, and I'll go off my best judgment for who gave the correct answer. But when you see A, B, C, or D, do not just type A, B, C, or D. You don't have to include the A, B, C, or D. I just need the answer in its entirety. Okay? So yeah, number 2, you don't have to include the letter associated with the correct answer. Just whatever you see, whatever you recognize as the correct answer, type that out. I've got the chat pulled up here. And you can only get your name on the wheel one time. I know some people have faster connections or are closer to whatever, and so their name just kind of appears at the top more often. To eliminate that and to try and make it fair for everybody, you get your name on the wheel just one time. Okay? So, with that being said, let's go ahead and get started with our first Forex category. Everybody ready? Everybody get ready. Luca, that's not going to work. Spamming A, B, C, and D is not going to work. And again, like I have the chat pulled up in front of me. I can only go off of what I see. If it says something different on your screen, I'm sorry, but that's just the way it goes. All right, here we go. Question number 1. Before adopting the euro, what was the currency of France? Was it A, the dollar, B, the pound, C, the franc, or D, the sterling? France now uses the euro along with many other companies, but before then, what was their currency? I see some people just typing letters. Luca, you can't type letters. You need to type out the full answer. Annie, you got to type out the full answer, guys. But with that being said, C is the correct answer, the franc. And the first person to type it out was William. Congratulations, William. I am putting your name on the board. Mr. What was it? Mr. William Black. All right, your name is on the wheel. You just got to believe me. I put it there. I'll show you the wheel at the end of it. You'll see that your name is on there. Oh, and also stick around because once I spin the wheel, if you're not here to claim your prize, we'll just spin it again because we want to make sure that somebody claims their prize, either the EdgeFinder or the stock box. You get your choice of either. Or Discord. We had somebody ask if they could get the Discord services the last time that we did this. And we said, yeah, sure, why not? So your choice, Discord service, Pulver alerts, EdgeFinder, stock box, something out of our store you can have for free. Okay. Congratulations, William. We are moving on to question number 2. How many countries can you spend euros in? How many countries in Europe use the euro? Is it 19, 20, 21, or 22? How many countries use the euro? I see a lot of mixed answers here. Some people saying 19, some people saying 21, 20, 22. This one was a little up in the air. The correct answer, however, is 20. There are 20 different countries. And in fact, I always try and put the background of the answer as something that relates. So you can actually see, I know it's faint, but you can see the map here of countries that all use the euro. You've got Germany, France, Ireland, Italy, Austria, Romania, the Czech Republic, Hungary, Croatia, basically all of Eastern Europe over here, Sweden, Finland, like pretty much most of Eastern Europe uses the euro, and then the UK is in red because famously they left the European Union not too long ago. Okay, so the correct answer was 20. Let me scroll back up to the top here. And the first person that typed out 20 was Alex. Congratulations, Alex. Alex Mania. Alex Mania. How did you spell that? Let me see. M-A-I-N-A. M-A-I-N-A. Okay, yep, got that. Alex, your name is on the wheel. Congratulations. Remember, I can only go off of what I see on my own computer screen. If yours says something else, I apologize, but I don't have your eyeballs. All right, moving on to question number 3. What is the U.S. inflation event known as? Is that A, CPI, B, NFP, C, FOMC, or D, PCE? A lot of letters, a lot of letters there. All right, yep, FBI. Lucas said FBI. Just about everybody got that right. Pretty much everybody got that right. I've scrolled up to the top. I see the first person to say the correct answer, which of course was CPI. CPI is the event that happens once a month where the U.S. Releases the current inflation rate. And OLAS was the first to get that one. Congratulations. Your name is back up on the wheel. James, can you share your screen looking at the chat? Is me reading your comment showing you that I'm looking at the chat enough evidence that I'm looking at the chat? I think so. All right. Moving right along. Question number 4. The FOMC event happening later today, we're about an hour and a half or so away from that, has to deal with what? Is it A, inflation, B, interest rates, C, employment data, or D, gross domestic product? You can narrow one of those answers out. We kind of just had that question right before this. So you can narrow something out. Inflation, interest rates, employment data, gross domestic product. Correct answer, of course, is interest rates. We are going to get the new interest rate decision. Most likely, with almost all certainty, we are going to have a 25 basis point rate cut. Let's see who said interest rates first. And congratulations, Revo, you are number 1. Revo, your name has been added to the wheel. I'll show off the wheel. Here is what we have so far. 4 names added to the wheel so far. We have 6 more to go. 6 more to go. Remember, you need to stick around towards the end of the game so that you can claim your prize. I like how you guys are arguing over you're not even saying I was first. You're saying that other people was first. You guys are fighting for each other, which is good. That's a good thing. Our community backs each other. You guys are back. You guys have each other's backs, and I like that. All right, question number 5 before we start to switch things up a little bit. Question number 5 is, if someone says they are short the dollar, that means they are A, buying, B, bullish, C, uninterested, or D, selling. If someone tells you that they are short the dollar, which of these 4 options most accurately describes what they're doing? Well, really, there's only which of these describes what they're doing? I see the chats flowing in. I see Reb letting me know who was first on his screen. And he was correct. Fan favorite in the chat, a all-time regular chat member, did in fact get it correct. It is in fact selling. Congratulations, H Ball Out. You got it first. H Ball Out, name going up on the wheel. H Ball Out 88. Name is up on the wheel. And that means that we are halfway through the game. Bro, waiting for Powell, uncle. He will roar. Oh. All right. Zorro selling. I am late today. Zorro's usually one of the quicker ones when we do this type of thing. Zorro, we still have 5 questions left. You still got your chance to get your name up on the wheel. All right. All right. So that was question 5, which means we are going to change it up a little bit. I think I have a little buffer screen here. Yep. Okay. So we are moving away from Forex trivia. We are going into more general world trivia because there's only so much Forex trivia that I can find. And I'm also trying to keep it fresh each time without repeating answers. But eventually here, we're definitely going to have to start repeating questions, whatnot. But until then, we are moving on to world trivia, general world trivia. So here's question number 6. What 2 countries share the longest international border? This is where it starts. We start moving away from multiple choice. So I'm going to use my best judgment here, but you just have to give me the 2 countries that share the longest international border. Okay, nice. I see people are saying mostly 2 different things, either Russia and China or USA and Canada. I see a lot of Russia, China. I see USA, Mexico, Alaska, Antarctica, France. It is, in fact, Russia and China or the US and Canada. It is one of those two. China and India. The correct answer is the United States and Canada. So if you said any variation of the United States and Canada, you are correct. I've scrolled to the top and I see Bradley Quintet. Bradley Quintet, congratulations. Canada and USA, that is absolutely correct. Bradley Quintet. Congratulations, you've got your name up on the wheel. All right. So again, moving on from here, you still need to type out, the answer to the best of your ability, but not all of them are multiple choice, similar to this one. But they all should be simple, have a very clear-cut answer. So I'm going to be using my best judgment from here on out. Here we go. Question number 7. Who painted the Mona Lisa? This one is multiple choice. Who painted the Mona Lisa? Was that Michelangelo, Leonardo, Raphael, or Donatello? I did not include last names because it's funnier this way. And if you know why it's funnier, I may or may not give you a bonus point. I probably won't, but I will appreciate the effort. Painted by a turtle. Yes, that is correct. Painted by a turtle. The correct answer is Leonardo da Vinci. There he is right there holding the pizza box. He painted the Mona Lisa. Let's see. Who said Leonardo first? I got to give it to this guy because somehow, again, I'm using my best judgment. This is supposed to be a fun game. This guy was clearly going for Leonardo and got it out first, even with all of those extra letters. Leondario. He added so many extra letters and still got it out first. Alexis, congratulations. Please do not get on to me for the fact that he spelled it incorrectly. I can clearly tell that he knew that it was Leonardo. That's clearly not Raphael, Michelangelo, or Donatello. So let's not be too crazy here. Alexis Moldovan, your name is on the wheel. Congratulations. Have any of you seen the Mona Lisa? I've seen it. It was cool, I guess, in the sense that it's like the most famous painting ever, but then also you kind of look at it and it's like it's a painting. But maybe I'm just not cultured enough. What? Anyway. All right, moving right along. Question number 8. We have 3 more to go. 8, 9, and 10. 3 more chances to get your name up on the wheel. 3 more chances to get your name up on the wheel. Question number 8. What is the capital of Japan? Is it A, Tokyo, B, Kyoto, C, Osaka, or D, Yokohama? What is the capital of Japan? And while you're doing that, I'm going to grab something. He was just sitting there on the couch and he looked way too comfortable. Way too comfortable. Oh, buddy. You don't like to be on camera? He's going to jump out of my lap the second he gets the chance. The correct answer is, yep, there he goes. Correct answer is, of course, Tokyo. Hey. Oh, he's angry now. Scrolling to the top, the first person that said Tokyo was you. I'm not even gonna. Okay, you got it. You got it. You 543. That was all you. Congratulations. Geography. Can we do advanced calculus trivia instead? Luca, you're a goofy guy. How many cats do I have? Just the one. I wish that I had another one, but my roommate is not particularly a big fan of cats, and we also live in a very, very tiny apartment. So if I had my own space, or perhaps a bigger space, then I would. But for now, little buddy is on his own with me. Okay. Congratulations, you. I'm going to call you you. Moving on. Question number 9. What year did World War II end? What year did World War II end? I've been playing a lot of the brand new Indiana Jones video game, which takes place around this time, as well as the movies. Since I've been playing the game, I've watched all 3 of the original movies. Let me know, guys, if you're Indiana Jones fans in the chat. One of my earliest childhood memories is watching Indiana Jones and the Temple of Doom with my dad. It's a core memory that I have, because I remember him showing me the first movie and I thought it was so cool. And I'm a little kid. Remember, I'm like 7, 8 years old. And then the second movie, when he showed me the second movie, all the it starts with like a musical number. A lot of women come down and they're like dancing in this they're in China. And so they're in this fancy club and they're doing like this musical number and they're dancing on these stairs. And again, I'm like a 7-year-old boy and I was like, this is the worst thing I've ever seen. But I love that movie now. Anyway, what year did World War II end? Correct answer, 1945. 1945. I'm old, so yeah, Indiana Jones. We got one Indiana Jones fan in the chat. I thought I had more not multiple choice questions in here, but maybe it was just the one. Maybe it was just the one. All right, so I've scrolled to the top. The first person that said 1945 was Olas. Was your name already? Your name is already on the wheel. Okay, I thought that looked familiar. Olas, your name is already on the wheel. Check this out. I'm going to go right down the order so you can see exactly what I see. Olas was number 1, already on the wheel. Doesn't count. Number 2 was U543, already on the wheel. Doesn't count. Then we had Jovan, apologize to your, I remember Steph Curry, I asked you about that. It's incorrect. Texacoat Ltd, incorrect. But Wonga, 1945, that is in fact correct. Wonga, name up on the wheel. Here's what we have with just one question left to go. One question left to go. If you're one of the people that got your name on the wheel in the beginning and you've had to stick around through all of this, it is almost over. Thank you for your patience. We are almost done. One question left. One spot on the wheel left. And I was wondering if you can't see all replies after Ola. That's very strange. Any long. Annie, I do see your 1945 here. However, with so many comments coming in so quickly, it's going to look different on different people's screens. Because on your screen, as soon as you hit send, it's going to show up. But then it has to travel through space and time and satellites and whatnot to end up in different places. So it's going to look different on other people's screens. But I see you. I've got you. I promise I'm doing this as fairly as I can do it. As fairly as I can do it. Last question. Cat is begging for more food. He's a hungry boy, but he's already had his lunch. He'll get fed again later. Anyway, next question. Last question. What country produces the most amount of coffee? Nick was talking about coffee earlier. He said all YouTube donations go to the Coffee and LaCroix Fund, which is our personal A1 trading charity that we donate all of that to Costco, and they give us coffee and LaCroix for the office. And it's a wonderful foundation. Truly. What country produces the most amount of coffee? A, Vietnam, B, India, C, Colombia, or D, Brazil? Which of these countries produces the most amount of coffee? I am seeing a lot of mixed answers. I'm seeing Vietnam. I'm seeing Colombia. I'm seeing Brazil. Vietnam, Brazil, India. This is me scrolling to the top, by the way. Colombia, Brazil, Vietnam, Brazil, India, Colombia, Brazil. All right. So I have scrolled to the top, and the correct answer is Brazil. Brazil produces the most coffee in the world. I have never been to Brazil, but I have been to Costa Rica, which is in South America, and the coffee there was phenomenal. Costa Rican coffee was phenomenal. All right, so I have scrolled to the top. The first person that I see that said Brazil was Sashi Kumar. Congratulations. I'll type out the full name, Yadav. And that is going to do it for our questions. Thank you to everybody that played. Thank you to everyone that stuck around if your name is up on the wheel. We do this every once in a while. We did it a little bit more last month because we had some stuff going on. This is probably going to be the last one for the year, but we do these every other week or once a month or so. So if you're watching the streams, especially if you know that we're doing a long stream, let me show you guys this. So if you go to our website, and this is not, well, if you go to our website, you can enter the giveaway for a chance to win an EdgeFinder, by the way. Go check that out. But also, if you go to the live stream schedule, it will actually show you who and when and what we're streaming for. All of these times are Eastern time. And so if you see a day like today where we're streaming for a long time, there's a chance that there may be some trivia thrown in there. So keep your eye out on the live stream schedule, and you can keep up with all of your favorite streamers. But with that, let's go ahead and spin the wheel. Nick, do you want to hop in here now or hop in after? Nick's going to hop in here now. So we're going to add Nick to the stream. What's going on, Nick?
What's up, James? That was fun trivia. Good job, everybody.
Did you know most of those questions? Were you playing along?
I didn't know that Brazil was the coffee manufacturer. That's kind of awesome. I remember we did an office trivia, guys. Last week we had our company Christmas party, and one of my trivia we did play trivia for a little bit, and one of my trivia questions was who produces the most tea in the world, and it actually was China. So I like that question.
Yeah, that gave me a little inspiration. But let's go ahead and spin the wheel so that we can get our winner of the giveaway. 10 names up on the wheel. We're going to spin it one time. That person hopefully is still watching. If you are the winner, let us know in the chat so that we can hook you up with your choice of prize. And it is OLAS. O-L-A.
All right.
O-L-A-S. OLAS. Congratulations. Let us know you're here in the chat. And guys, we are going to double and triple check to make sure that we give the right person their prize. So don't try and pull any funny business. There he is. OLAS. Congratulations.
Nice.
Congratulations to OLAS. We have dropped the email here in the chat, support@a1trading.com. You can email them. And again, we are going to double check to make sure OLAS gets his prize and nobody else does. So please keep it easy for us, everybody. I know you will.
Yeah,
you
congrats, OLAS.
You guys are great.
Like James said, send that email. Just send a message to support@a1trading.com, and we'll get you set up with your either EdgeFinder or Stockbox or Discord, just anything you want from our store. One item, it's all yours. And shout out everybody for playing, and thanks, James, for putting together another awesome trivia.
Yep, no problem. I always enjoy hanging out with everybody and playing trivia.
Good stuff, guys. Okay, well, James, we'll let you go. We'll relieve you of your trivia duties. Thanks for doing that, and we'll see you on the next trivia round.
Yep, see you, everybody.
See ya. All right, guys, and also something to note, if you didn't win, you saw it there on the screen for a second. This is an easy way to do it. If you go to a1trading.com, it should pop up on your screen. We're running a giveaway this month. We're going to be giving away a copy of the EdgeFinder. There it is. We got that set up. Julie set that up on our website so that you guys can enter for a chance to win an EdgeFinder on Christmas Day, or a stock box for that matter. It's we have 2 giveaways running. So if you want to join the giveaway, you can either go to a1trading.com and wait for the pop-up and then just enter your email into the raffle for a chance to win. Or you can also, maybe we could drop the link in the chat for people watching on YouTube right now. That might be easier for you. You can click that link, fill out the form, and then come right back to the show, because guys, it's Power Hour. We got 1 hour to go before we get into the FOMC stuff. We need like, you know what we need, Chandler and James, a sound effect or something, like a power hour. You know, in hockey, they call it like power play when you've got like a man gets kicked out of the arena or whatever. We need some sort of like sound effect because this power hour theme happens pretty much every Fed day. There's like this 1 hour leading up to the event where basically we're going to run through some charts. We're going to get prepped here because the Fed meeting is coming in hot. So let's talk about some charts. We've got, like I said, about an hour. I want to talk about some dollar cost averaging that I'm doing. That was a theme today, man. We had Chris Pulver and Forex James back to back talking about dollar cost averaging. So I wanted to weigh in because I love that topic, especially in the Forex market. The Forex market specifically is unlike other markets in a unique way. One thing about the Forex market is that the Forex market does this. It just is a big, wonky, sideways moving market for the most part over the long term. Let's look at like an example. Let's look at, okay, so if you're looking at the S&P 500, over the long term, the S&P 500 goes up. There are periods of crashes where, you know, big sell-offs happen. In fact, there are also really big crashes that come along in the stock market, but the very long-term trajectory of the stock market is to the upside, right? We know that if you, even right now at these levels, if you bought the S&P 500, you might have to wait 10 years, but it's very likely that 10 plus years from now, the stock market will be positive. In fact, I believe that, and I could be wrong in this, but I'm pretty sure this is correct for US stocks specifically. There has never been a 20-year period in the stock market where if you had held through that 20 years total, you didn't come out with a positive gain at the end. Now, 20 years could be no fun to sit through, right? 20 years of no return if the market went sideways. But my point is, the market, the stock market has a positive drift. That's why I don't like to short it very much. It's a really difficult thing to short. But when you talk about currencies, it's different. Now, gold, same thing. Gold over the long term has a positive drift. Bitcoin arguably has a positive drift in its relatively short lifespan history. Could crash to zero tomorrow, but the point is it has a positive drift. So what about currencies? Well, look at the dollar index. The dollar index does not have that same effect. It has a sideways trajectory over the very long term. Now, that being said, that does not mean that currencies just never trend. In fact, these are some pretty nasty trends if you were to fight them, right? Look at the dollar in the 80s, just went straight up and to the right, and then straight down and to the right during the second half of the 80s. So my point is, however, though, the long term for currencies is like unbound. It can go sideways, it can go up, it can go down for many, many years. There's not that same long-term trajectory of it goes up. So the reason I say that is for currencies, mean reversion strategies can be quite good. And one of the reasons that I like that is that, I have a short position on the Australian dollar against the Japanese yen. This is a bit of a hedge in my overall portfolio in one respect, because this has some correlation to the stock market, but not fully, right? Take a look at Aussie yen. You can see it does not have that upward drift to the stock market. So it's not a perfect correlation. But I picked up a short position on the Australian dollar against the Japanese yen today. I shared this trade inside of our Discord channel. If you're not in the Discord channel, I highly recommend you join us. We'll drop if we could drop the link to the free Discord. If you guys would like to apply to join the free Discord, highly recommended you do that. We'll drop the link to that in the chat as we speak. Come join us in there. Take a second, come back to the stream just after. Don't worry, we'll still be here. Apply for the Discord if you'd like. The link is in the chat right now if you'd like to join us there. So I took a short position, an opening short position. You can see I typed up initial sell position. And I mentioned that I'm willing to add at two specific spots on the Australian dollar against the Japanese yen. Now, what I'm doing here is dollar cost averaging. And this has been a theme over the duration of the live stream. And I can already hear people say, well, Nick, why not just short it with a stop loss? And then just say, oh, I'm wrong, I'm getting out of there. Well, there's a couple different types of trading styles that I do. Well, really, there's just two. There's one that is trend following. I call it the TTF strategy. I call it true trend following because with true trend following, what I'm looking to do is, let's just say that I shorted the Aussie yen right here and I put a stop loss here. In that case, what I'm doing is I'm going to employ a little bit of leverage and I'm going to basically make a directional call that I think the Aussie yen is moving lower quickly in the short run. And if that works out, I'm going to move that stop loss behind price until I get trailed out, right? Now, in that case, if I have a directional short-term bias, I think the Australian dollar is going to go down today. If that's my bias, if that's the way I want to structure the trade, then I will put a stop loss on that trade. I will manage that risk real tight because my position size is going to be slightly bigger in that scenario. I don't want to take a big position with no stop loss. That is just foolishness. However, there are other times like right now where I am not necessarily saying I think the Aussie yen is going to immediately go down right now. I'm saying I think I lean bearish, but I'm not like super timing specific. I think the yen could strengthen in the next few months. And if I'm wrong about that, then my plan here is I take a very small position on the short side here. And if it goes up, right, then I'm willing to add another very small position. And if it goes up further, I'm willing to add a third very small short position. And if that doesn't work out, I will look to close out of the position. The reason I do it this way is because this is less timing sensitive, and I'm not really being short-term in nature with this trade idea. So I took a dollar cost averaging short position on the Australian dollar against the Japanese yen. And I want to talk a little bit about why I did that. By the way, like I said, that trade alert was shared to members inside of our Discord channel. If you would like to join that, we dropped the link just a moment ago. You can join it right here. We have a free version of our Discord and the paid version as well, where you can see everything. Okay, so the Australian dollar against the Japanese yen. There was something that I've been talking about a lot here. It's this idea here on the Japanese yen accumulation that seems to be going on amongst institutional traders. Institutional seems to be applying or add more long positions each week to the Japanese yen futures. They're also closing shorts. Now, this is something that they're doing gradually. This is why I want to use kind of a dollar cost average approach, because the Australian dollar against Japanese yen could go up for a few weeks before maybe we do see this idea of accumulating sell positions on things like Aussie yen actually makes sense. So they're buying the Japanese yen, which when we look at the Aussie yen would suggest they're buying yen and potentially selling things like the Australian dollar, the Canadian dollar, the US dollar, the pound dollar against the yen. So again, I took a starter position on the short side of the Australian dollar against the Japanese yen. What I also like about this, guys, is that this is a setup that came out of the EdgeFinder's top setups page. Take a look right here. You can see we've got a -5 score for the Australian dollar against the Japanese yen. So I've got all the things, all the tools here that I need to make the decision to pull the trigger on a short position on the Australian dollar against Japanese yen. Now, again, I want to clarify something. When I'm taking this position on the short side, I am not going heavy on the short side. I have a really small position on the short side. And I heard James say this earlier about dollar cost averaging. When you're dollar cost averaging, you actually are okay with drawdown. James mentioned he even likes drawdown because drawdown means he can get a full-sized position built as price goes against him. For me, if drawdown, if the market just wants to move lower and give me a profit, great, I'll just take that profit. But if the market starts to rip higher, then yes, the cool thing is I would have the ability to potentially add a secondary position to my Aussie yen short idea, and maybe even add a third position if we see a significant rise in the Australian dollar against the Japanese yen, as long as conditions still look favorable on that data that I just pulled up from the EdgeFinder. So I just wanted to share that idea with you guys. That's a trade idea that I have currently. If it goes against me, then I will look to build that full position that I want to. And if it goes in my direction, I'm looking to potentially target a move back down to these lows on the Aussie yen, specifically around 94 to 95. Hopefully that makes sense. But that's something I'm watching for. Will this pair be impacted by the FOMC stuff that's happening in 50 minutes? Probably so, yes. The Japanese yen will either strengthen or weaken based on what happens with the Fed meeting. Even though it's not the dollar or US currency, it still very much impacts the rest of the currency market. What's your take on US 30 or NAS 100? Let's take a look at some of those. I'll take a look at NAS. I do think it's a little extended. I've been mentioning this here. If we take a look at just some simple moving averages, right? We've moved away from every key moving average that I watch. So I really do think that we are due for a correction in the Nasdaq. That being said, the Nasdaq is something that is one of the hardest things I know to really short, right? To bet against. This thing just goes up, up and away during risk on markets, which is what we're in right now. That being said, it gets crushed in bear markets, right? In bear markets, the Nasdaq gets absolutely hammered. So, we're in a bull market right now. So the easier trade, in my view, is the long side. However, I need pullbacks in order to play game, right? So if I'm looking at, this every single moving average that I've got, the 20, the 50, the 100, and the 200-day moving averages are all extended, prices extended from them. So I think it's really likely that at some point we're going to pull back and test some of these levels, right? You always do. You always get something that comes along and changes that dynamic. I'm sorry, guys, my cats are fighting. I might need to separate them in a second. Okay, hold on. One second, guys. Hey. Cat appearance. That was Blaze. He's they fight over one spot in their cat tree that they both like, and one doesn't want to give up the spot, and the other wants to take it. So they fight. It's not really vicious fighting. It's more like play fighting, but sometimes it turns into actual fighting. So anyways, I'll continue my rant about the Nasdaq. We're pretty much overextended on all moving averages. Look how far we are from the 200. The 200-day moving average is very healthy for stocks to go back and retest. It happens very often. Look, even in this incredible bull market that we've had, you still see the S&P 500, the Nasdaq, they pull back to these key moving averages. The 100 getting pulled back to, here was the 200-day moving average getting pulled back to 200-day. Look how far we got from that in 2019 and how quickly we dropped in the 2020 correction. But you can just see the 200-day moving average gets pulled back to. It's very normal, very healthy for price to go back and find its way to the 200. And I'll tell you what, a move back to the 200-day moving average can be pretty vicious. I mean, you're talking about if we were to drop immediately to the 200-day moving average, it would be a 12% drop in the Nasdaq, which is not that big. So I think it's really possible that you do get some sort of correction event, that you get some sort of consolidation in this market, but it just doesn't feel like that until it starts to happen. So my opinion is yes. I think that the Nasdaq is really a bullish story. Trust me, I've been bullish on the Nas, bullish on the S&P for the last few years. I'm not somebody who thinks that this thing needs to crash to zero and that technology is all a sham and all that. That's not my persona on YouTube. But I would consider myself, I always use this phrase, cautious bull on the stock market. You have to be really careful that you don't get caught up in the hype, but you also have to remain optimistic to a degree in the stock market. The stock market does not reward pessimism very much. Now, if you're a bond investor, pessimism can actually take you far. If you're a currency trader, pessimism can take you far. But if you're a pessimist trying to trade the stock market, it's really difficult because the stock market goes up over time. It just has done that for hundreds of years. And so that being said, I am a cautious bull, which means at these levels, I can't justify adding a bunch of long positions, because if we get that corrective pullback, now again, you might add today and this thing might rip higher for another couple weeks. My point though is that when we get extended like this, this keeps me out of the game because I need to wait for that corrective kind of pullback in the market before getting involved myself. So something to think about is very quickly and very healthily, I think we could see a 5 to 10% pullback in the Nasdaq. Same thing for the S&P 500. You can see we're not as extended on the S&P 500. That really the Nasdaq has been the one that's just been very stretched. But I still could see corrections, pullbacks to go test like we did over here, the 100-day moving average. We haven't even tested the 50 in quite some time, which these are moving averages that get tested very frequently. So, we'll see. What's going to happen with the news on the Nasdaq? Well, it depends what happens with the news. We don't know what the Fed's going to say. If the Fed gives us an outline for less rate cuts next year, it could cause the Nas and S&P 500 to have a bit of a pullback. 1 second, guys. I have to just open the door. All right, boys. See you. Okay. Cat has been let free. Let's talk a little bit about the Dow Jones as well. So Dow Jones looks a lot healthier of a chart. Testing the 50 looks, in my view, like we could see a test of the 100 and a test of the 200 if you get a broader pullback. So the thing is, right now, you're getting pullbacks. In fact, you're getting some pretty sharp pullbacks in a lot of sectors that I've talked about a lot. Let's do some sector checks just really quick. We've got time here. Why not? So sectors, right? You've got semiconductors. This is an industry, but I like to watch it as a key ETF. Really kind of mixed, kind of sideways. You've got consumer discretionary. Oh my goodness, this thing very, very stretched. What is leading to this stretched behavior? Tell you what, it's Tesla. Tesla makes up a big component of this ETF, XLY. Take a look at Tesla. Tesla looks incredibly stretched, right? So there's Tesla. But then you've got other sectors that are pulling back quite a bit. Here's XLV, which has gone beyond testing its 200-day. It, in fact, has crashed below its 200-day moving average. You've got utilities. This is a position that I have. I might stop out on this one if it keeps going lower. I have a long position here. XLK, you can see there's technology doing very, very well. Financials have done incredibly well, but now starting to see a pullback. So again, I think we could see these 100-day moving averages come into play. Here's consumer staples. So there's your, stable companies, Walmarts and Coca-Cola's, things like that. Industrials have seen a pullback here. So you're starting to get some attractive pullbacks, in my view, on some things. Then you have energy. Energy's gotten absolutely crushed recently off the idea that, Trump's going to drill a ton of oil. Energy did really poorly under Trump last time around in terms of stock performance for energy companies. Real estate's also seen a big sell-off. Here's regional banks seeing a bit of a sell-off. So it's interesting. It's a very, very diverging market right now. You have technology and you have software companies doing quite well, and then comm services doing exceptionally well. These are Verizon, Google, Meta, companies like that doing really well. Here's software. Software's been a beast recently. Software companies out there really killing it. So I think that the long story short is I think that tech is really for of a pullback kind of match up to the other ones that are seeing pretty steep sell-offs. So I know I did a lot of stocks there, but I'm an index trader, so I apologize. That's the primary thing that I watch is indices, though it's been a little bit tricky for me to catch some entries on tech stuff. There's other markets that I'm interested in that we're actually getting some pullbacks on. So interesting to see. Anyways, dollar index here will be volatile to say the least during this upcoming Fed meeting event. If you get expectations from Powell of more rate cuts next year, the dollar index would likely weaken. And if you get expectations from Powell, but also we'll get the dot plot today, expectations from the rest of the Fed committee that matter also because they also make the decisions. That committee's forecast for interest rates dropped today. If there's little to no rate cuts for 2025, if that's the consensus, then get ready because the market is not expecting that. The market is expecting a couple rate cuts next year. In fact, let's look at that. We've got time. Why not prep here so that we know what we're looking at? Yields have been rising recently. Before we even look at the Fed Watch tool, we can really get the same idea just by pulling up the 10-year yield chart. This is the yield that you get on lending money to the government. So if you basically lent the government money for 10 years, your return per year is this number right here, 4.4%, let's call it. So you give them your money to the government, they pay you 4.4% per year. And at the end of that 10-year period, you also get your money back. That's how bonds kind of work. When this number is rising, it's the bond market saying, we think the US economy is strong enough to administer those loans, to pay back those loans, and it means that the bond market is saying, look, inflation is high. Inflation is going to erode the earnings that we get on these bonds. Let me map that out for you. Let's say that you're talking about getting a 4.4% inflation. Return, but then on your money that you get, you're going to lose, let's say, 2.4% of it to inflation. You come out with a positive 2% gain net of inflation. And these do have some tax benefits from doing government bonds. I believe that I could be wrong, but I believe they're mostly, there's some tax advantages. I'm not a tax attorney. I'm not, that guy. So go look this up yourself. But I believe that there is some tax advantages to lending money to the US government. They don't charge as much tax on it, something like that. Go look it up. Not the guy for that. Here's the thing. 2% may not sound like a lot, but for people who are like in retirement, who just want no risk return on capital, a 2% return might be okay. But what if, guys, let's say you lent the government money, you want to lend the government money, but inflation is not forecasted. This is a forecast. We don't know what the number is going to be over the next 10 years. But let's just say that the actual number changes, the forecast for the next 10 years of inflation bumps up to 3.4%. Think about it from your own perspective. Let's say you inherit $1 million. And with that $1 million, you say, I need to just put this away and park it safely. I don't need to, maybe a lot of us would try to invest it a little bit differently. But let's just say, as contingency to your inheritance, you have to put it in the bond market as a low risk, quote unquote, way to invest the money. Well, look, if 2.4% is the forecast for inflation over the next 10 years, and these are very, very hard numbers to predict, but let's just say it's 2.4%. You're going to get 2% after inflation. So this is inflation numbers. 10 years. Inflation over the next 10 years is going to be 2.4% per year. You're going to collect 4.4% from the bond. So you net 2% gains. But what if we change a variable in this? And trust me, if you're like, Nick, what does this have to do? I'm a gold trading junkie. Just get back to the 10-second chart so I can trade it. Then wrong stream. We're here to talk fundamentals. So let me finish this point. If now the expectations for inflation go up to 3.4%, well, your return just got much worse. Now your return went from 2% to just 1%. So you might say, nah, that's not worth it. I wanted 2%. Now I'm only going to get 1%. So what does the bond market do? The bond market bids prices higher to 5.4% in order to account for the higher expectations in inflation to maintain about a 2% target. Now, this number is not set. It's not always 2% post-inflation. This number changes too. But my point is, the bond market trades based on inflation expectations, as well as interest rate expectations, as well as economic outlook expectations. In my opinion, the bond market is the smartest market. The bond market is intelligent AF. It looks at the economy. It looks at inflation forecasts, inflation models, interest rate models. This is why it makes me laugh when you just see people who are like, trading is easy to make 10% per month. Meanwhile, you've got literal mathematician geniuses who map this stuff out. They're brilliant at it, and they wouldn't go nearly for 10% per month, because on a risk adjusted, going for that kind of return means taking massive risk, which is unsustainable in the long term. If you're overwhelmed by this topic, then good. If this topic is like, Nick, this is a lot, this is heavy, then good. Because the sooner you kind of humble yourself in terms of market knowledge. Look, I've been doing this for a long, long time, and I still have so much to learn. The markets are so incredibly fascinating, but complicated. So my point is, if you hear this and you're like, whoa, this is like really heavy stuff, is this really what the top traders in the world are doing? And the answer is yes. If you listen, and I'm not guessing, if you listen to interviews with massive hedge fund managers, portfolio managers that manage tons of money, this is the stuff that they talk about and they look at, right? There's so much to learn in the markets. And the sooner you accept that, oh, I'm not going to be able to roll up and make 10% per month easily from, the comfort of my bed or the beach, the sooner you accept that and give the markets the respect that they actually deserve, the more likely you're actually going to become profitable. So it's really important to just bring your expectations down in terms of markets, because there's a lot to it and it's certainly not easy. So let's get back to this concept. The bond market recently has been saying what? The US economy has been looking strong and inflation doesn't seem to be going away. So what does the bond market do in reaction? It says, well, inflation's going to erode away some of my return on my bonds, and the US government is likely to be able to, pay back these bonds. But that's a huge national debt, so that weighs on it. Well, the point is the bond market has been bidding yields higher. Remember, that means bond prices are coming down and yields, the offerings on those bonds, are rising. And that rise, if it gets too high, can be a little bit difficult, because what this is the cost of borrowing money. Now, if you lend the government money, you benefit from higher yields, because what? If you're lending this money and you get 4.4 and it goes to, let's say it goes to 4.8, if you lend money at 4.8, you make a lot more return. But what if you need to borrow money? a lot of people are borrowers, right? Companies borrow money, individual consumers borrow money. If borrowing costs, which is what this chart is showing us, if they continue to rise, it puts pressure on the consumer, businesses, and the overall economy. So this rise in the 10-year is something to watch out for. When we had some real big scary issues going on in 2022, yields were flying higher, right? Because inflation expectations were going crazy. So the bond market was like, we need higher rates in order to pay, in order to make bonds worthwhile taking the risk on them. We saw them drop for a little bit, but not so much anymore. Bond yields have started to rise once more. And this is telling us that the bond market thinks inflation is not going away right now. So we've got the Fed meeting, all that to say, the Fed meeting's right around the corner. Press conference is at 2:30, so 1 hour from now. And so you've got all that to say. What is the Fed going to say for 2025? If the Fed says, look, we think it's appropriate to cut rates a couple times next year, if that's the case, then bond yields could likely come down. But I'll tell you what, I lean a certain way. I don't think, and I could be right or wrong about this, but my tendency is to think that this uptrend in the 10-year yield is not done. I think we could see yields continue to take out highs and perhaps make bigger moves higher. And if that happens, that could be your catalyst for a corrective pullback in the Nasdaq, which I started with earlier in the stream. Could be cause for concern for things like cryptocurrencies and high-risk assets that have been flying high. So my point with the 10-year yield is just be careful. As this thing rises, this, by the way, very strong correlation to the dollar. Rising yields means a stronger dollar most of the time. Again, rising inflation, stronger economic data, both of those impact positively yields and the dollar. So there is some positive correlation there. It's part of the reason why I have been pretty bullish on dollars. Had a really good run in the last few months. We'll see if it can take out those highs and continue or not. Just depends what we, in terms of the dot plot forecasts from the Fed as to how many rate cuts they see next year. We get that number today. It's going to be really interesting to see what drops for that dot plot today. Okay, two things for you. Number one, we're going to drop the link here in the chat. By the way, if you don't have our software, I just mentioned how complex and how much there is to the markets. If you want our tools that we have built specifically to help traders approach fundamental analysis a little bit more clearly, with more insights and a little bit easier, we're doing a giveaway right now on the EdgeFinder that you can join for free. So we've got 740 people here. We're announcing a free giveaway winner to the EdgeFinder on Christmas Day. So it's our Christmas present to the audience here. If you'd like to enter, it is completely free to join the EdgeFinder giveaway. It just got dropped here in the chat. Join that, throw your name in the hat, and maybe you'll wake up on Christmas Day to a free EdgeFinder. And if you don't, either ways, we appreciate you watching, supporting, and just make sure you join our giveaway for a chance to win. It might be you, who knows? Anyways, the second thing I have for you is we're gonna take just a quick break. We're gonna set up the stream because we got Chris Pulver joining for the countdown to FOMC. We got about 25 minutes to go. Stay tuned. We'll be right back with Chris just after this.
If you're someone watching the show right now and you're outside of the US looking for a better brokerage, listen up. I wanted to take a moment to mention today's live stream supporter, Vantage. Vantage allows traders outside of the United States to trade CFDs. You can trade everything from commodities like gold, you can trade US indices or global indices, and you can even trade FX all under one brokerage, and you can connect to MetaTrader 4 and trade directly on tradingview.com. Not to mention, they also have a really good sign-up bonus going on right now. So we'll drop the link to that down below in the chat as well as in the description of this live stream. Check out Vantage. Now back to the show.
Part two to the stream today.
Hey, Nick, how are you, man? The stream
good,
is
I'm
coming
good.
in. It's a little disconnected on your end or some choppiness. So we'll just we'll power through it. We'll pause between each other's exchanges.
Yeah, very, very possible. It is probably me. Chris, I moved out to, I'm not in the country, but I'm kind of on the edge of the countryside here in Georgia.
Okay.
So anyways, my internet speed is not quite as good. I actually just ordered a Starlink. So we'll see how that comes in. My parents have a place out in the mountains. So they said their Starlink works great. So I'm going to try that as well to see if I can get a little faster net. But anyways, Chris, what are you watching? I just did a full kind of rotation through stuff. I have some yen long positions today, which is kind of interesting. Got some. I'm watching indices. Everything's a little extended. I know we've talked about that at length. But what are you watching closest here as we count down to the Fed meeting?
Yep. So I'll give a recap. I've got expirations out to Friday on Google, Nvidia, GLD, Meta, PayPal, Netflix, Amazon, Tesla, and SVXY. Those are all looking pretty good for full expirations. Those were pre-election trades that I had expirations out for 12/20 and 12/27 for end of year income. I'm thinking about this right now. Nvidia, the premiums are so good on this, Nick, that I'd like to just kind of buy the shares and take like an in the money call to make a couple of bucks. But I think I'm going to exercise some patience and restraint because I still think that there might be a chance to come down to the 200 moving average before maybe January of next year, or into January of next year. I'm not looking to like buy a ton of Nvidia. I think that we maybe make this like slow grind to the downside until we find this like 120 or 110 area, and then we look to see if we can mount a comeback to that 150. So I have some potential exposure on Nvidia that I don't need to buy more shares. I was tempted to do it for this trade. If I bought the shares right now at 136.26, I could buy the shares right now at 136.26 or so, and I could sell a January 3rd call for 875. And if I did the quick math on that, I buy for 136.27, take away the 875 covered call. That brings me to 127.52. Get it called away at 130 in 2 weeks. I make $2.48 a contract. So if I'm in for 100 shares, I get $250, $248 by January 3rd on an income trade. That would be for my margin accounts. I'd have to fork over about $6,500, so $250 out of $6,500. I'd make 3.8% return on risk in about 2 weeks, which isn't a bad play. But like I said, I've got a ratio spread already running. I have a credit spread out to next Friday already running. If Nvidia goes up, I just make income on those, and it's going to be like $550 or so. If Nvidia goes down, I'm still willing to take on the shares, and I've got protection and maybe lower my cost base a little bit more. So I don't want to triple up on a trade that I've already got a double up on, but I'm watching that closely. It's been a nice little comeback on Nvidia. I'm looking at a level on Nvidia this week that we ripped through the 135, which would have been my liquidity strike I was watching for this week. The next order would be 140 if we continue to head up this week. Also, SPY 610 and QQQ 540. Those two levels, those two strikes, I'm looking to see if price will poke those. I put in some Santa Rally debit spreads today. And I did end up taking a small win on the SPX. But I guess it's this conversation that we're all thinking. It's like, what's the Fed going to do? Is it possible, Nick, that the Fed doesn't really give the market the catalyst that it wants to get higher by Christmas Day or by New Year's? I mean, it's an either or. But I think the market has had so much momentum. It's position bullish. The path of least resistance is bullish. I don't know if today's announcement is going to do anything to really disrupt that, because I doubt Powell, we'll listen to the press conference, but I doubt Powell's going to really want to harp on how bad inflation's become or how much warmer it's getting the last 3 months. He probably won't say a word about it.
Well, here's one perspective that I'm curious about, Chris, which is, today we get something different than your standard FOMC. We get the dot plot. Right?
Yep.
So what if with the dot plot shows us where committee members are voting, where we're going to be with interest rates next year? And what if that dot plot shows that a lot of committee members feel like we're not going to cut rates very much at all next year? If that is more hawkish in terms of the straight, what I love about the dot plot is, because like you said, when Powell gets up on stage and he says a whole lot of nothing, like he talks in both directions, that can be very frustrating. What I love about the dot plot is just like an economic release, like a CPI or an NFP, it's just a straight number. What I love about the dot plot is we get a better hard line idea of where they are voting, where they're going to be. Just like we did recently, our forecast for 2025 as a team, the A1 Trading, Discord, we shared our forecast for next year. I think that we like that stuff, right? So the market is going to actually get some answers potentially today, as long as it's not exactly as kind of already forecasted. That to me is interesting. What I would also add to that is that if that number of rate cut kind of averages in at less than expected, it's possible that when Powell, as the spokesperson for the Fed committee, has to get up there and talk about it, he feels the need to maybe justify it. So I think actually if you get a dot plot that's more hawkish, Powell might step up to the stand and say, look, basically the votes are in, inflation is not going away, and we might get a little bit more of a hawkish surprise. I'm not saying that that's like what is absolutely going to happen, but I think it's a very much a possibility that with the dot plot kind of showing a number, Powell might have to kind of stand on his position a little bit as spokesman of the Fed. So that would be my kind of one side possibility here. And also just because you were talking about NVIDIA, I also have some trades going on. I have shares that I own down at, what is my average cost? Down here, 10 something. But I also sold puts to add shares a while back. This is expiring soon, the end of December. I've got calls and puts, so I put a strangle on for NVIDIA, which is going really well. So just really small, just one contract on both sides. But wouldn't mind if it does continue to drop towards that 200-day moving average. I'd be really interested in maybe adding a little bit to my NVIDIA. I only have 42 shares. Wouldn't mind getting full 100 or maybe even 200 shares of NVIDIA total. That way I could do something similar to what you're saying, doing some income plays on NVIDIA. But long story short, that was my answer to your question about the Fed today as well as NVIDIA.
Yeah, that's that makes sense. Dude, good thoughts on the Fed. It would be interesting if Powell has to basically justify the consensus. I mean, I've from what I've read, I think that this is going to be mostly a neutral cut or a hawkish cut. Simply because the market is already prepped for less cuts next year. From what I'm seeing, March would be a potential cut of 2025 and maybe July of 2025. That's about it. Now, a lot of the good from this final rate cut has been priced in. The market's not necessarily going to be able to run hard on Fed monetary policy for 2025, but the market also is wanting to run hard on pro-capitalism, pro-USA, pro-corporate growth, pro-tax rates. But if we have mass deportation and tariffs in 2025, and this is what did make me a little nervous about 2016, is that everyone got excited about Trump being president in 2016, but he led his first year as president with building a wall and xenophobia and leading with like deportation threats and cutting back on immigration. And so like on the social side, we took a step backwards. And I just wonder if we're going to lead this new administration with the same type of thing. So if his first order business in January of next year is tariffs and deportation, I don't know how well that's going to be. Like the market reaction might be a little sour, but if it's like tax cuts and, we want the strongest economy and pro crypto, it's like, then just, if you keep it in the arena of like the stock market right now with like stocks at all-time highs or trying to get to all-time highs and crypto at 100K and maybe drifting up higher, then maybe there's just more of that sentiment that still just lingers and it's positive for longer. I spent a lot of time this week and weekend just like tapping into all this macro stuff. And I get it. Like there's so many like macro themes that are so bad. And one of the guys that I follow really closely, I know I share some videos with you, Nick, but Darius Dale, who runs Macro 42, the guy has some of the craziest like charts and he puts it all together. And he also runs like one of the simplest portfolio plays. It's like, I think he has 3 ETFs that manage an entire portfolio. It's called KISS. Like it's a KISS portfolio. It's like 3 ETFs. And I'm pretty sure it's just like, I don't know exactly what it is, but I'm pretty sure it's SPY, GLD, and maybe IBIT right now for like a small
Oh,
allocation,
interesting.
or it might be SPY, TLT, GLD, and then now adding in like a 10% allocation to IBIT. So it's 3 to 4 top ETFs, and it's just a way to balance, and it's always like rotation of percentage allocation and dollar amounts and things like that. So very cool stuff to keep it pretty concentrated. But macro wise, I mean, he's talking about a zero landing or no landing or a soft landing. The threat going into 2021 would be the unknown of the Trump administration. The debt ceiling is going to be January 1st, and so if we do drift higher and the S&P does crack a 58th all-time high, the Nasdaq cracks new all-time highs again, I think those are great through the end of the year. But when we have a debt ceiling debate January 1, it's not like Democrats are going to roll over and say like, yep, Republicans win, so we're not going to fight this at all. It's like there's always going to be a power struggle in DC, and nothing is bipartisan anymore. So that could be a whole new thing that is just like a knuckleball coming into 2025. So I don't think the market really cares right now. It's holiday. I mean, look, man, I don't know how your fills are going, but I'm trading options and I'm looking for mid prices. Dude, some of my fills are crappy. Like literally today, I tried to put on a butterfly spread on the SPY, and I was up 2, 3, 4 cents on the SPY higher than the bid or the mid price, and I still didn't get filled. And so I canceled the trade. I'm
Yeah.
like, I can't believe, and it's not illiquid, but it's like, it's not liquid. It's not super liquid like it usually is when you can get filled on the mid price or at the penny. So it's different. It's definitely lower volume, lower liquidity.
Well, the other thing too, Chris, is we have a little bit of an insider indicator at A1 Trading, which is we can see view counts. I'm sure you can as well. And that's always a really good indicator, truthfully, because when there's a lot of views on the videos and it feels like everything we put out gets a lot of attention, we generally are like, okay, market volumes are high. And then when views are really soaking up, you can definitely feel it right now. People are winding down for the holidays. People are, pulling money to go spend on gifts and things like that. It's a seasonal thing every year for, the industry.
Sure.
And it also, I've heard you mention earlier, maybe the same reason the market kind of drifts higher is because there's no major, fear factor thing. Market can kind of just drift higher. I saw something that really changed my perspective on indices, which is generally speaking with indices, if there's no major catalysts or news coming, the market kind of just defaults to doing what it's been doing. And recently that's been ripping. So, when you have nothing on the radar, it just kind of continues to drift to the upside, at least right now. And in 2022, it was the same way. There'd be like nothing going on, but it would be moving lower, just, and then you'd get a pop in the morning on something, it would sell off in the afternoon. So right now I feel like we are in that very euphoric state where the market is just rallying on everything or even rallying on nothing. So we'll see. I heard you also talking about earlier the possibility that this could just take us right to new highs here today. If there is actually, confirmation that rate cuts are still coming, there is that possibility. But that's why this is a key event, is that there's a lot of uncertainty around it. We don't know what the Fed is going to say or what their dot plot is going to do. My best guess is that I think that they're going to point at the rise in inflation recently as a little bit of a cause for concern, but we'll have to see.
Yeah. I mean, look, man, they haven't acknowledged it for 2 or 3 months. That's what's stupid, is like we literally watched our third print in a row of higher CPI, higher PPI, higher PCE, and we're going to see another PCE on Friday. If they don't acknowledge it, I mean, clearly there's been, it's the same like very crafty wording that Jerome Powell is always great at. It could be mentioned in passing, but say like there's resiliency, blah, 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 like risks look control, they look under control, like nothing that I don't know. They're not saying that inflation is running rampant. They're not saying it's transitory. Like he's probably not going to have a big slip up like he did back in 2022. But I will say this. I think that the important price action for today and this week is that price by Friday has to be sitting near these all-time highs to possibly drift up into the end of the year. The only other reaction I could see would be if we fall during the FOMC and then rip through the rest of the week. That's about the saving level that I'd say, 61 or 6,000 or so, just over 6,000 on the SPX, 600 on the SPY. If this level acts as support, then I could see the market just using it as an excuse, fill up some buy dip levels, and then take this thing back up to all-time highs. But that's going to be a very volatile reaction. I think that the cleanest price action and probably the easiest path forward for traders right now is that we get a little bit of noise to the 2 p.m. rate decision, and then Powell comes in and says something, and the market just drifts higher today, and Thursday, Friday doesn't fade it. Because if we don't fade the Fed, then getting into Christmas, which only has like 2 to 3 full trading days next week and 2 to 3 trading days during New Year's, we get to all-time highs by the end of the year. That finishes the market and the highs with, the S&P is going to be darn near up 30%. The Nasdaq's over 30%. Gold's still up 20 plus percent. Bitcoin's up 100%. I mean, you've got some amazing milestones this year that are breaking. Now, correlation wise, we haven't talked about this. We haven't been in a live session together in a while. Look at like equal weighted S&P, equal weighted Nasdaq, equal weighted, like the Russell 2000 has been getting smoked. The Dow's been crushed right now. It's like, we don't have everything running in tandem. We don't have a healthy, a healthy market breadth bull market. It's like we're right back into Mag 7 flows, which I think I took a screenshot on my phone. This is kind of nuts. Let me see this. It's either on my computer or my phone. Let me check. But I want to say S&P for the last 2 weeks is up because everything else is down. Like literally, if you look at every other index in the world, it's pretty much down against the S&P. And you've got AVGO up, which is now $1 trillion stock with Broadcom. You got Tesla up, Amazon up, Apple up, Microsoft up, Google up, Meta up. All these Mag 7s up to stretch to all-time highs. Let's see here. And I mean, I did the sentiment stuff. I know it's like crazy bullish. But UnitedHealth Health Group is one of the bigger holdings in the Dow that's been down. The RSP is down like 11 or 12 days in a row. So disconnect is pretty obvious. Do we have like the catch-up trade? Is equal weight going to catch back up? We get another kind of rally in market breadth, or is it not that, Nick? Like thoughts on that between the disconnect?
So here, I love that conversation because it's been so important to this market right now. I've got RSP pulled up on my screen if you want to show that, Chandler. But I mean, you look at RSP, that is a very different story than, NAS or Mag 7. And what I think is important here with that story is that if you've got the divergence here, you asked me an indie question that I want to answer and also hear your thoughts too. The question is, these things are generally longer term, pretty correlated, right? Tech, most sectors over the long term are relatively correlated, right? The S&P 500, the RSP, the Qs and NAS, et cetera. Generally speaking, they move in the same direction. Right now, you've got most stocks performing actually poorly, selling off, and the NAS continuing higher. That's what Chris is pointing out for the audience. My opinion to this question, is the rest of the market going to catch up to NAS, as in Mag 7, or is Mag 7 going to catch down to the others? If I had to pick a direction right now, I would say the Mag 7 is going to come down to meet the others, which is not been the correct call in the last few years. It's been everything else kind of catches up, still trails it while the Mag 7 goes up again, and then kind of it's been playing catch up over time. But I think that right now, if the Fed comes out and they come out swinging with any signs of inflation's not in the right direction, if they know their history, which if you and I are talking about it, Chris, we know that inflation, typically when it has a big uproar, most times in U.S. history, it has a second big uproar. If we can hope that they're doing their job correctly and they know their history and they know their stuff, then they're aware of that and may try and get in front of it if they want to be smart about it, meaning let's not rate cut anymore or let's slow those rate cuts. And if that sobers up the market a little bit, I think you may still see an overall net selling even in the Mag 7 and other industries continue to sell. I also heard you say something on the Dow earlier. I kind of feel the same way. I mean, the question is, the way I can answer that with, I think it's going to catch down, is I heard you say this earlier. You were pointing out Dow Jones is down, not quite ready for me. I'm the same way. I would need, if you give me 42,000 on the Dow, you give me a little bit more of a downside move. And I think that stems from my bias of, I think tech is a little overdone and has room to come down. And when it comes down, since it's led everything on the way up, I think it's going to continue to lead it down. That's my thoughts. What are your thoughts to that question?
I agree. Look, man, it can be this easy. Every moving average that I'm looking at for dynamic support, it's not good enough yet. I want the 100, the 144, the 200. I'm looking for some legit bar counts to be hit. I'm looking for some legit balance to be found. Now, I realize on my DIA that I'd look to get long. Nick, if we were talking about this right now and we're at the 144 to 200, I probably put in some trade on the
Yeah.
DIA. It's
Yeah.
pretty simple, but we're sitting at the 50, and maybe the Nasdaq makes new highs, maybe the SPY makes new highs, maybe the DIA does catch a bid here, and what does it do? Maybe it goes back to the highs and gets sideways again. But I don't think this thing's going to blow the tops off. And so if tech is overcooked and we start to come back a little bit, maybe it's not for the next 2 weeks, maybe it's out to Q1 next year. But I do think that I would like to see this and probably 100 stocks that I'm interested in trading pull back to more appealing levels. It's that simple. That's why I'm not taking more trades on NVIDIA right now. That's why I'm not getting long with fresh positions on Mag 7. That is why I just looked at this. I just added this into my watch list. Taking a look at the S&P stocks above the 50-day moving average, we only have 37% of all S&P stocks above the 50-day. Like, we're not really hanging into bull trends and buy zones on most of the stocks. You got 63% of the stocks right now in the S&P that are below the 50 period. So they're not death crosses, but it's like if you're below the 50 period, next up is the 100 period. And then, we're starting to cross the 21, we're starting to cross the 50. And where's the correction at? Probably the 100, probably the 144, probably the 200. So look for those dynamic support levels. And as we've talked about a lot the last month or so, if you've got cash, and I will say this, I am way better prepared for if 2022 were to happen again in some capacity, like a nice healthy bear correction. I've got way more cash at the ready than I did in 2021. Like when I was in 2021 getting ready for 2022, 2022 early on was a pretty good inflation trade for me. So I was up like through April, and then May to December was just fighting the market the rest of the year. And Forex is what kind of got me out to cling to break evens or better. Net positive on the year, but it was a really, really difficult year to be positive. Point is, like, I had 100% invested in everything. Like, I kept all my 2020 gains, 2021 gains. And yeah, I did some collars and I bought some puts and I had some protection, but dude, I wasn't ready for a, 25 to 35% correction in the market when I was fully invested. So this time, 40 to 45% sitting in cash, ready for some deployments, watching prices. If I miss out on some more upside, that's great. Not really. I'll be annoyed, but I think that we're probably due for some type of correction that I'm just going to be waiting on. I've got some income plays. Let me ask you a question for next year. I know we have 2 minutes for the Fed. Next year, are you getting more diversified in your opinion, or more like concentrated in incorporating like maybe some more options, maybe some more sell puts? Like I'm just curious, like if you're going more stocks or less going into 2025.
Yep. So we just have about 1 or so minutes, so I'll be quick and come back to this a little bit more because I love that question. I am definitely more leaning towards the diversified side, and just I've played a lot of tech stocks this year. I've made a lot of money on the Qs. I've traded semiconductors really well, but there's just some stuff out there. This is JP Morgan's. We're working on the stock box more and more every day. This is a cool chart that we're working on. It's the price to earnings ratio relative to price. You got things like JP Morgan, and what you can see here is the price to earnings here rising. So you've been seeing this earnings multiple expansion for a lot of key names here recently. What that means is that the price has gotten more expensive relative to the actual earnings of a lot of companies. So that's been a big component to what has contributed to this rally. So to me, things are expensive, and that just to me means wait for some of the euphoria to die out. That might mean pullback soon. It might not. It might mean, we're sitting here waiting for a little bit, Chris. And in my view, that's okay because I can look to diversify. I've been playing some emerging market stocks. I've been trading commodities, right? I've got sell puts on GDX, on gold, on silver, so, and I've got some currency trades. I'm short Aussie yen. So I've got just other things that I'm focused on and staying busy with. In the meantime, guys, we got about 10 seconds here to go. What we'll do here is just pull up wherever we can. Chris and I will do the same, just whatever we can find headline wise. And if you guys see something with the Fed here in just a second, please share it with the class.
Stock market. Initial reaction down on the SPY. Nick, you have your like 8 charts up. Let's just see those like kind of 1 minute reactions.
Let's do that.
Yeah.
Yep.
Okay. Let me get real time news. I can chime in here. I've got Financial Juice up and running. So let's see. Nick's got all of his stocks there.
Yep.
Let's see. I'm assuming they just cut. 4.5. Wait, did they had to have cut? Did they not cut? That'd be crazy. I'm seeing 4.5. It should be a 4.25 to 4.5.
They did cut. Yep.
They did cut. Okay, they cut 25 basis
25
points.
basis points.
Okay,
Yep.
as expected. All right, that's fine. Yeah, it's weird because the CME watch tool shows like 4.25 to 4.5. It's that, that odd like 25 bips window. But anyway, okay, they cut as expected. All right.
Yep.
Market is, I've got SPY down. SPY's down about $1.60 or so right out of the gate. I think that, I don't know, I'm watching for that potential bounce off of like this week's lows, or the 603 to 602 level SPY, or that 600 level is really a key past resistance to become support. We could have some, like, I don't know, just some initial reaction, and then the market Fed is notorious for that. We have this big reaction at 2 o'clock, and then the Powell move from 2:30 to 3 o'clock, or from 2:30 to 4 o'clock can completely come back and be a bounce. So
Yep.
I don't know, I might look at some short-term trading opportunities, but I've seen a big fade off that 610 that I was watching for this week. Still not done, but we'll find out. I'm looking
Dollar
to see
index
if
is moving higher. That might suggest rate
Yep.
cuts.
Okay.
Again, audience, let us know if you find some headlines. I know Fed median rate forecast for next year is 3.875, 3.625, 3.375. So it seems like the initial reaction here is slightly hawkish. I mean, that's not a ginormous drop in the stock market, but the dollar index is telling you, hey, look, there's a move there. Silver and gold also down would suggest a little bit of hawkishness there. Oil not really moving too much, but again, that dollar index is really interesting here, just to see dollar index crossing up into just about 107.5. I mean, that's back near the highs here.
Yeah, 108 was like the PMI, Eurozone PMI highs were 108 on the DXY. So if it gets back to that level, that's a potential resistance zone, but that's about it. I mean, if it breaks through 108, Nick, I mean, we're able to run to 109. The dollar could be surprisingly strong until it's going to be like forcefully talked down,
I mean, take a look at yields, Chris. We got yields, 10 years, same kind of story as the dollar, making a move towards that 4.45. Yeah, yields up here. So maybe slightly, little bit of hawkishness coming in.
Yeah. We had said, like, I think this is there's the dot plot. I got a picture of it. Okay. So dot plot, everyone's at, pretty much consensus. We'd stay at 4.5 where we are. By 2025, the consensus is right around 4%. So, I mean, you're looking at, if you're lucky to get 2 cuts next year, you're going to get 2 cuts out of the Fed. That's where everyone's sitting. I'm going to take a screenshot of that. Are you seeing that on Financial Juice? Dot plot image, they just posted that. It's 2:03 p.m. Eastern time.
Yep, I've got your screen pulled up so we can see it.
All right, yeah, perfect. So if I zoom in, or just you can follow here on the news, but I'm looking at this right here. So everybody, as far as like the consensus of the Fed, 2025, most everyone's sitting right around that. Be 3.5. This would be 3.75. So between 3.75 to 4%. So that's where everyone's looking at, like, more than likely 2 cuts for 2025. That was already forecasted the last 30 to 60 days. But if Powell backs that and says why, is his comment going to be skewed towards more neutral to hawkish? Maybe. 2026 is a big question mark. Like, everyone's kind of scattered in between, additional cuts, maybe no cuts. Well, I guess additional cuts, but only a couple, maybe 25 to 50 basis points through 2026. I'll ask you this: unless the Fed has to react to something that's breaking, I think that investors might just have to realize, like, we might never see sub 1% Fed rates ever again. Maybe. Like, unless something, again, if something breaks, sure, the Fed will use monetary policy. We'll cut to 25 basis points again, but that's like full-on crisis happens, and that's the only tool the Fed keeps playing with, which is cut near zero, and then it sucks, and it's a weird, like, cheap money. $1 trillion debts keep climbing. Our deficits keep climbing. But I think the new normal is, I don't know, man. I think we have to basically sit on, okay, if core PCE is at 2.8% or 3%, I don't think the Fed can really afford to cut further than like 3.5 to 3%. That might be the lowest we see in a while if we can't really push inflation down towards 2%.
Well, you've got just, a ballooning national debt too. And I know I sound like a doomer YouTube channel, but it's true. I mean, you have this ginormous debt that the US has to administer, that has to deal with. And, when you have that giant debt, people aren't as willing to lend to you. It only makes sense. Do you want to lend somebody would you, Chris, you and I, this is an obvious rhetorical question. Everybody knows the answer to it, but would you lend money to somebody who's like a drunken spendaholic, shopaholic monster? Then the answer would be no. And that's kind of the US government. They spend a ton of money beyond what they, really should, quote unquote. I mean, I guess that's debatable, but in my opinion, and probably most of us would agree, the US government probably wastes a little bit more money than they should. That being said, here's Nasdaq down 0.6. Chris, there's been something that terrifies me lately. I've been hearing a lot of people who have been saying that the quote unquote new norm is that the Fed's going to save the day every single time. I know you and I have ranted about that 1,700 times, but is there a possibility that the Fed tries to step in at some point, it doesn't work? And I can answer that question really easy. In 2008, the Fed, in 2020, that's a recent memory for a lot of us who were trading during 2020. Like, hey, look, the Fed stepped in, saved the day. The second they announced rate cuts, the market started ripping. But this same sort of scenario happened in 2008. The Fed stepped in to save the day, and it was unable to do so. They started stimulus way before the market bottomed. So, that's the question. What kind of catalyst actually gets us to break lower on a more sustainable basis, right? That's the question I have. Like, what kind of catalyst should we be looking for to actually know, okay, yeah, we might actually have a true bear market? In 2022, it was inflation. Is that the same story? That, is that the big thing that topples, US stocks right now? I don't know.
Yeah, well, I think that the first sign of a real threatening bear market would be that the Fed is becoming very reactionary and the market's not taking it at all. I mean, I do think that if we do have a correction, it's going to be nasty and fast, similar to what we experienced with that vol event in August. That late July, August weekend that rocked a lot of accounts and a lot of markets this year. That pretty much looked like it paralyzed the Nikkei for the entire year, because after that was done, it was just still left like its head spinning. The Nikkei hasn't done anything but find equilibrium. I'm actually looking at the SPY right now, Nick, and I'm thinking if we come down to like this 600 level, I'm probably going to look at a long call. Try to make it cheap, or maybe do like a quick debit spread and see if we get back by the end of the week. This is, to me, this price action is not indicative of how the rest of the day or week is going to play out, right? I'm already seeing the chat, gold's dropping, no Christmas rally, cancel it. Price is already showing its hand. It's like, that is not true at all. Like, this could be the setup to get the market to buy this dip and then take it right back to these recent equilibriums at 605 or 610 plus. This is not done, right? Now, again, why would I do define risk? Because I could be dead wrong and this thing can drop well below $600, and all the hedges that I've been putting on for the last 2 months can maybe pay me, Right. So either way, it's like I could take a trade right now and be fine and make a little income. If this thing drops, I am hedged very, very nicely for the end of this year and end of January as it stands right now, which could be pretty profitable if the thing is really, really ugly.
Guys, gold is dropping. You got NAS dropping, S&P dropping. Everything is dropping because the dot plot came out a little hawkish. I saw a headline just a second ago that I wanted to share with everybody. Fed cut rates for the third time and points to only 2 reductions in 2025. Fed signaled that it is likely to cut rates only 2 more times in 2025 based on the widely followed dot plot matrix. So again, I think market is just sobering up here a little bit to the idea that, okay, you might not get many rate cuts. I mean, let's think about something, Chris. In 2024, turn of the year, we were forecasting 6 rate cuts and we got 3. The Fed gave us 3. We got 3, right? So let's re-engineer this going into 2025. Now we can play this game again. Of course, U.S. economic data was way more upbeat than the world thought it would be. That may have played a key role. But let's just say we repeat last year and we go into 2025 and say, look, the market might have been thinking 4. I don't know exactly what it was. I don't know what it was priced for, but The Fed's giving us 2 now. What if we do only actually get 2? What if we get, you know what that does to me, Chris? 2 rate cuts next year tells me, okay, we've got a bunch of corporate real estate expiring in the United States. I know that's a big story that a lot of the perma bears love to pull up, is you've got a bunch of empty corporate real estate that a bunch of banks have to administer. But truly, if a lot of banks need rate cuts because they're operating at a difficult kind of leverage level with their existing bond holdings, things like that. So question is, if you're not going to get as many rate cuts next year, does that increase risks for rate sensitive parts of the market? Like, for example, regional banks. Let's just take a look and see if my theory on that makes any sense with regionals. And regional banks have already been selling down another 0.8%. So the KRE is a regional banking ETF. These are smaller companies. A lot of their portfolio are tied up in corporate real estate, which has been a really tough part of the market. So, I think what would be happening to is, just for context, for people who are a little more, sorry if I'm going out, it's not great. The Fed coming in and cutting rates just one time today, with the possibility of only cutting 2 times next year, definitely raises risks for certain parts of the market more than others. That being said, the Nasdaq is leading the move lower here, at least right now. I don't know, Chris, what this could be too is, look, Powell comes out and has to defend this concept of 2 rate cuts like we were talking about. Maybe that actually is going to be the case, and that's why the market is selling off here. I would say it's not because they cut by 25 basis point that the market is selling off. It's the dot plot showing just 2 rate cuts next year that's got the market a little bit uncertain going into the press conference.
Yeah, I think this is also just a very typical FOMC manipulation where price does what it does. We still have a line in the sand, in my opinion, and this is why I'm pretty happy about how I'm positioned. If this thing bounces right here past resistance to become support, and today's first, we're 12 minutes into the FOMC and this market's already dropped 5 or 6 points. If all we do for the rest of the day, Nick, is come right back where we started, I'm putting in a pending order right now for 46 cents on a debit. I'm going to do a quick, I'm doing a 601 by 602 bull call spread for 46 cents. I'm not getting filled yet. I'm looking to see if price will maybe tap that 600. I could obviously take it down to like the 600 by 601. But if I don't know, I'm looking at like 600 is a pretty strong level. It's going to be tough to get the price that I want. So I'll settle for the 60, 601, 602. Because if we come back to 605, 606, I'll get profit on that trade pretty easily. So I'll see. I'm going to take a stab at that, but I'll say this: if we drop hard through 600 and there's more, gap filling, then my hedges are really all I'm going to focus on. I've got hedges out to end of December, end of January. Now, what I thought was interesting, I've not seen this happen before, but when we came into trading on, I think it was Monday morning. Yeah, Monday morning, we saw that huge gap up in futures. So this is my ES chart, and I'm circling that Monday open. We were all the way up here in futures, and the S&P was like $1 lower. Usually, if you see a big gap up in futures, you're going to see the S&P pre-market higher. It was not the case on Monday's trading. So it was really, really weird. And notice how futures market is coming right back down to fill the entire gap. So for anybody that's a Forex trader, you can quickly become a pretty savvy futures trader because it's a 23-hour market every single day. There's a closing from like 5 p.m. to 6 p.m. But man, the price action in futures is pretty darn pure. And you see a lot of like gaps like this that usually they don't, they don't mess around. Like this gap on Monday is getting filled today. Yes, it's a news catalyst, but I'm not surprised to see that because the SPY didn't gap with it. It was a weird outlier. Like, I don't know why the futures market gapped up like nearly 1%, but the S&P was down, and we haven't gone to new highs. And so I think there was some heavy amounts of manipulation in the futures market going into this weekend and into Monday's open. But here we are, like almost filling the entire gap. So crazy stuff, man. I'm gonna see if I get filled on this. Yeah, I'll be watching that 601 by 602. But yeah, go ahead. Sorry.
No, you're good. I think there's a little bit of a delay. That's my fault on the internet side. S&P 500, I just wanted to kind of follow up your idea there with SPY, SPX 500 coming down to this level of support. Watch it close, guys, because I think that if you do get this break, we may see a little bit more slide here. If that does happen, again, this could bounce real quick, real easily off this one. Take a look at the daily chart, this is also a really key daily level. And again, you start breaking this level, I think you start unlocking maybe a bigger move here, perhaps over the next few weeks down to maybe 5,900, 5,850. You guys know I lean a little bit cautious right now. I'm not looking to short. I'm just looking to kind of stay cash and not jump into too many positions. So again, if there was going to be a bounce here, I would imagine Chris is probably going to be in this area, right around that 4-hour chart of support around 6,000 that we talked about.
Yep. I just got filled on my 601 by 602 bull call spread. So that trade is out to Friday. If that, all I need price to do is be above 602 by Friday. So if this market's going to hang on to any of this, if this is like catching the market on its heels or it's caught, back-footed, then cool. I'll get like a quick income grab. But like I said, man, if this thing is right now in the daily chart, we're below the 21. If we stay this way, if we close below 600 in the SPY, you have to remember, the S&P was up nearly 30% this year. The Nasdaq is up over 30% this year. There is the ability for there to be heavy amounts of profit taking at the end of this year. The Fed looks like they ruined the whole Santa rally and they ruined everything for 1 or 2 weeks. But this market's still going to hang on to like 20+% gains. So I mean, from the benchmark itself, this has been a heck of a run since Q4 2022 to now. And this week isn't over, Nick, and this year isn't over yet. And so I don't know what we're going to do. But watch it. Just like Nick said, he's got it up on his chart. It's very clean. 600 is a key level. If we bounce off of that, and I would say FOMC is such a noisy day that I wouldn't be surprised if when Powell starts talking that we're back up to like, 604, 605. I wouldn't be surprised if we get there. If it's not today by close, maybe by Thursday, Friday, this market doesn't really do any major breaking below 600. I just think there's a lot of inefficiency in price right now. You can just look at intraday, right? I mean, this market didn't do anything today until the last 10 minutes. And it looks like all the volume's coming in. Is this like, that's it, profit taking, everybody? I mean, I don't think the market thinks like that. If anything, this is a chance to maybe buy the dip. Like I said, this could be the last ditch effort to, throw the kitchen sink in, get a little discount. I mean, what's our previous discount for the last 3 weeks on the S&P? We are down about 1.4%. All year, we've survived on like less than 2% pullbacks. Like 1 to 2% pullbacks all year has done pretty well, with the exception of April reached 5% and August reached 10%. Other than that, it has been 1 to 2% pullbacks all year, and this market has gladly bought every dip. So anyway, look at that. Phantom says Canadian dollars get destroyed. That's why I'm long dollar CAD. So I might take profit on that dollar CAD. We're up to 43.88.
What's interesting too?
That thing's taking off, dude. That's good.
S&P 500 stuff is that you just got so much strength there every time it does dip that perhaps there's still that.
Oh, we lost him. All right. We'll let Nick jump back into the stream here, and okay, we'll let him come back in. Maybe we just cut down his video, or I'll go off video so we can reduce some of the bandwidth. But we've got Powell that's getting queued up here in about finally gave out. Yeah, he'll come back in. We got about 10 minutes before the press conference starts and when Powell gets to the podium, so we'll stream that. And Chandler and you guys, let me know if you can just like throw in the stream, but I'm sure Nick will pop back in. Testament to Starlink. My buddy has a cabin in Northern California up in like Weaversville or like the Trinity Forest area. It's like 4 hours north of Sacramento, and it is in the middle of nowhere. It is quite remote, and Starlink does a pretty good job. He manages to play some Fortnite at the cabin on Fridays, which is pretty impressive. So anyway, alrighty. I'm looking at that trade at the 601 by 602 is trading for 43 cents. I want to see what the 600 by 601 is trading for. I didn't want to get filled at 50 cents. So I'm happy with the trade overall. It gives me 54 cents on the dollar if I'm right. But I need to see if price is going to pull back in any way. What was I about to say what were we talking about, Nick?
Sorry, I was making a point and then my internet, I switched over to my personal hotspot.
Okay, cool.
Hopefully it's a little bit better for the rest of the stream. So S&P 500, I was just going to make the point that I have a little bit of a difficulty in terms of trying to see a massive sell-off here into the end of the year. Yep. I think that the tax advantages of people not wanting to sell could be a major reason for why, there's a lot of people who want to make it to January, right? Before they can realize those losses to push off the taxes. There is a serious tax implication to closing stuff right now.
Man. Yep.
So that's a major reason why, in terms of downside potential, I don't see too much. That being said, it could be pushed off to January 1st. I don't know. Again, like I said, I'm still cautious. I'm not looking to aggressively buy anything at this time, but I do think that is a serious bull case scenario. That is a very fair point, something that index traders should watch here as we go into the Powell moment.
Agree. And look, I put a chart alarm at 6:04. Between 6:04, 6:05, we'll just chalk it up as experience. If we come back to that level, that is a very classic FOMC trade day. A lot of reaction right out of the gate, a lot of rebalancing by the end of the day, and the market's left right where it started, and all traders are doing is either making a ton of money in a short amount of time or losing everything because they gamble and they get filled and everything. So when it's all said and done and the dust settles, that is why I continue to trade defined risk. If I was dead wrong today, I'm going to lose, 46 cents. If I'm right, I'm going to make 54 cents of profit. And I've got trades that are up and trades that are down, and I'll watch and see how things play out. My hedges are what I'm watching the closest to see if we do end up having downside. Let's see how those hedges pay out. Otherwise, that's a great point, Nick. I mean, think about how many traders in 2024, bought leaps. How many traders went long the S&P, and how many traders are long anything Mag 7. And it's like the flows. I mean, I don't know if you heard the stat this week. Interactive Brokers reported that 70+% of their order flows this year were Mag 7.
Wow.
That's insane, dude. Like, you've got 7 stocks, whether it's trading just by the shares or trading options on those shares, 70% of their trades, commissions, and everything that's come from their trading side, whether it's, and Interactive Brokers is institutional. I mean, the hedge fund, we had Interactive Brokers as our master account, and they're huge, right? I mean, that's a broker that sits on $100 billion in cash. So if you ever wondered, like, what broker should I put my money with, they're good, right? I've got Tasty. I've been Interactive Brokers. Schwab is big. Anyway, point is, that's a lot of concentration, as we know, but the dents in the market, I mean, today, for example, is anything been said to create and justify this fall other than, well, Nick and I think that it's overbought. I think that it's a little bit, narrowly concentrated. Or it's very highly concentrated in very few stocks. These are all things that we've been talking about for months. None of it matters because the market still carves out all-time highs. So I think what we're looking at today is, this is price manipulation coming back to like a $600 support. This is going back now 1, 2, 3, 4, 5, 6 weeks. This is post-election rally. What a beautiful spot post-election rally to see a top that can offer up some support at 600. And if it holds, we're right back where we started, where we maybe don't get to 610, but we don't necessarily crash below 600. But like I said, if this week by Thursday, Friday, we are sitting probably closer to the all-time highs, that means that whatever happened with the Fed or post-Fed, it didn't break the market's spirit, right? Yeah. And because it's the holiday time, let's get into the spirit of the seasons and the holidays. But if the market spirit isn't broken and we're sitting up near all-time highs with Christmas and New Year's rolling around, that is the classic 2-week Santa rally. And if the market still produces higher highs, all this is noise. And I'd say that's probably my highest probability to trade right now is 600 safe. We're going to see what price does during Powell's press conference. I don't think this guy wants to talk it down, because what's the first thing that's going to happen out of Trump's mouth if all of a sudden the market's down a quick 5% going into 2025, right? Trump's going to try to talk it back. He's going to try to, he'll troll the Fed and he'll troll Jerome Powell. And it's like, the guy is the most vocal. Nobody asked for your opinion, but he's going to tweet it anyway. It's like that's what we're dealing with as a president. Yeah. 2025. Look, I don't know if anybody just took the Men in Black amnesia tool or whatever the heck that thing was to scan your brain. 2016 to 2020 was not super awesome. Like, it was a lot of chaotic volatility and a lot of chaos, and nobody knew what was going to happen. 2025 is probably going to be more of that, and the next 4 years are probably going to be more of that. So that doesn't make things like super awesome and easy to navigate, but guess what? We're going to do it anyway. We're going to figure it out.
Yeah, no, I think I do think that the probability that you just get the same kind of year next year as this year is very low. That being said, to be fair, I thought that about 2024 when we went into it from 2023. I was still bullish, but did not expect us to have 25+% rallies year to date. So we'll see. Market is clawing back just a little bit here from the sell-off. Same thing. Well, actually, gold, a little bit of a bounce back in gold, silver. These things are just kind of rebalancing. This is something that we talk about almost every single Fed meeting, is that usually you get kind of the first wave at that 2 o'clock drop of information, whether it be the rate cut, or in this case, rate cut and the dot plot. But then it really comes down to what Powell has to say. Is he gonna defend how strong is that just 2 rate cuts going to be? Is it going to be really strong, or is it going to be, that's what we've got right now, subject to change? That's really what we're going to wait and see here from Powell. We've got the stream loading. We will have that stream pulled up for you guys. We have 900 people watching between Twitter and YouTube. If you guys could do us a big favor, hit the thumbs up button. I also wanted to show you guys something just as we go into this. Part of the bearish reaction that can be so quick, so violent about the market right now, I would argue, is because of where we are with the put call ratio. We've talked about this a lot. Put call ratio is really, really low right now, which is telling you a lot of people are on the call side. Doesn't mean that the market can't keep going up, but it does mean that if you get something bearish that comes into the picture, it largely can shake the boat really quickly. So I just want to point out that we're sitting at a very low put to call ratio right now. I personally like to look for longs when we're more, kind of a little bit more balanced, a little bit higher on the put call ratio. Right now, everybody seems to be so bullish. So I'm just a little bit cautious on that. That being said, there's a lot of reasons to be bullish, not to take away from the really strong, catalysts that we've had this year, right? We've had really strong earnings, Fed cutting rates, inflation falling. I mean, it looks good. But I personally just still think that sentiment is a little too stretched one side. But if you give me these pullbacks, right, I'm still very much in the bull territory. I would just like to see that put call ratio. It's one that I use very frequently. I'd like to see that swing back the other way. Also, just to drop a link also, by the way, if you would like to get access to this indicator, the EdgeFinder, we're doing half off trials this month. You can apply for a trial using the link being dropped in the chat if you want to use our sentiment data tools, seasonality tools, economic data tools, and much, much more. We'll drop the link here in the chat. You can take advantage of those trials, get 30 days access to the EdgeFinder using that link. Chris, what else? I mean, outside of indices, anything else you're watching? Bitcoin's down 2.26%, not too much of a move. Like I said, gold bouncing a little bit. What else are you watching?
I just pulled up the currency strength chart. The dollar got a big rip right out of the news. So I mean, that's really the big jump. Is dollar super strong right now, continuing to push the Aussie New Zealand lower. Everything else is hanging out clustered at the baseline today with very little volatility, but the dollar's the big shining star. The dollar index may be screaming towards that 108 handle on the DXY. Aussie New Zealand just not getting a lot of love. We're not getting any commodity strength right now. Oil still, treading water. China still an uncertainty until probably March of next year, until they announce some type of more definitive stimulus measures. So yeah, I mean, again, does this get faded? We'll find out. Does the dollar continue to get stronger? I don't know. Nick, you had mentioned earlier before I came on. I've been obviously talking about this for the last several weeks, but I'm watching that 10-year yield like a hawk. I think that is the one thing, as a consumer, I just don't think that this is a good thing for the market. If the yield market is basically saying, Fed, you guys are messing it all up and we're going to prove it. If that 10-year yield gets higher, it has the potential to break the consumer, or at least pause action. Like, there will be a slowdown in mortgages. There'll be a slowdown in cars. There'll be a slowdown in refinancing. There will be, or you're going to be forced to finance at much higher costs. And that's just going to be, then what do you do to save money? Fire people. I mean, there's going to be something that's like, there's gives and takes in the economy, and you can only stretch consumers so far before they break. You can only stretch businesses so far before they break. And look, I know AI is awesome, but it's also, unless you plan on the future looking like you have zero workers and everything's AI and humanoids, I mean, that might be great for corporate America with Teslas and such, but business as a whole, it's probably not a good environment to be in. So again, that's down the road, but I just think that 10-year yield is something very important to watch, because it's really the anti-Fed play. If the 10-year yield's going higher, it shows that the bond market right now, and they're called bond vigilantes, they're essentially betting against the Fed. And you have some big names in there. You've got Paul Tudor Jones, which is expressed about being short bonds, long yields. Stanley Druckenmiller, another one. These guys are like, they don't chime in very often, but when they do, I mean, markets tend to pay attention to them. So they're long yields. Like they're saying that's one of the easiest trades is be long
Yeah.
yields and be short bonds. And it wouldn't surprise me if they're right. But yeah, it's going to be something to watch.
Interesting too, because again, you've got Nas taking out the lows here for
Yep.
now. We've got Powell speaking. That is my bad. Let's pull up the stream right now.
Okay, cool.
Sorry about that, guys.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has moved much closer to our 2% longer run goal. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end, today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 173,000 per month over the past 3 months. The unemployment rate is higher than it was a year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.2% at the end of this year and 4.3% over the next few years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September. Thereafter, the median projection falls to our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 4.25% to 4.5%. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market, while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year and 3.4% at the end of 2026. These median projections are somewhat higher than in September, consistent with the firmer inflation projection. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. On a technical note, we lowered the offering rate on our overnight reverse repo facility to align it with the bottom of the target range for the federal funds rate, its typical configuration. Technical adjustments of this kind have no bearing on the stance of monetary policy. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Gina Smilik with the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit about why officials think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year. And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does a pause next month seem more likely?
Well, so let me start by saying why we cut today and then move to 2025. So I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals: maximum employment and price stability. We see the risks as two-sided: moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. And on balance, we decided to go ahead with a further cut, and I'll give you some details on why. Downside risks to the labor market do appear to have diminished, but the labor market is now looser than pre-pandemic, and it's clearly still cooling further, so far in a gradual and orderly way. We don't think we need further cooling in the labor market to get inflation down to 2%. Job creation is now well below the level, or certainly below the level that would hold unemployment constant. The job finding rate is low and declining, and other measures such as surveys of workers and businesses, quits, things like that, broadly show a much cooler labor market than we had in 2019. It's still quite gradually cooling. So we keep an eye on that. Inflation, we see that story as still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%. 12-month inflation has actually been moving sideways as we are lapping the very low readings of late last year. Housing services inflation actually is steadily coming down now, albeit at a slower pace than we might like, but it has now come down substantially, and it is making progress slower than hoped. And we've had recent high readings from non-market services and some bumpiness for goods. So I'll just say so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. That's just a general sense of what the committee thinks is likely to be appropriate.
Sorry, just one quick follow-up. Why, I guess, would you make those cuts? Like, what would be the trigger to cut?
So we're to cut further after this point. I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts. And all of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
Howard Schneider with Reuters, and thanks for the opportunity. So this does seem towards the dynamic in 2016 during the last transition to a Trump administration, where the committee saw slightly tighter policy, in part in expected anticipation of the fiscal policy stance that was seen evolving over the year. Some of it was a data mark-to-market exercise, and some of it was anticipation of fiscal. What's the split on this one? How much of this was accounting for inflation data that was coming in, and how much of it is expecting that there will be inflationary fiscal policy next year?
I'd say I'd point to 5 or 6 things, and let me start by saying that we think the economy is in a really good place, and we think policy is in a really good place. Let's remember that the economy is growing 2.5% this year, that inflation has come down by 50% from 5.6% to 2.6%. Headline inflation is 2.5% on a 12-month basis. We're actually in a really good starting place here. But since, so what's really driving the slower rate cut path? First thing is growth is stronger, right? The economy grew faster in the second half of 2024 so far than we had expected, and is expected to be above what our expectations in September next year as well. Unemployment is lower, and in the SEP you'll see that participants think that the downside risks are less and uncertainty is less. So that's more strength, right? Inflation is higher, as we talked about. Inflation's higher this year. It's also higher in the forecast next year. I'd also point out that we're closer to the neutral rate, which is another reason to be cautious about further moves. But then getting to your point, there's also there's uncertainty. Uncertainty around inflation, I pointed out, is actually higher. It's also in the case of some people, the way I'd say it is this. Some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecasts at this meeting, and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation. The point about uncertainty is it's kind of common sense thinking that when the path is uncertain, you go a little bit slower. It's not unlike driving on a foggy night or walking into a dark room full of furniture. You just slow down, and so that may have affected some of the people. But as I said, there's a range of approaches on the committee.
If I could follow up on that, you mentioned the risk and uncertainty indexes toward the back of the document. The upside risk to inflation jumped quite substantially. The only thing really that's happened, you mentioned that the disinflationary story remains intact. yet the risk weighting has jumped to the upside. The only real thing that's happened is November 5th in the meantime. Is it fair to say that that's what's driving the higher sense of upside risk on inflation?
Actually, that's not the only thing that's happened. What's happened is that our forecasts for inflation for this year, I think, are 0.5 higher than they were in September. So you had 2 months of higher inflation, September and October. As I mentioned, November is back on track. But once again, we've had a year-end projection for inflation, and it's kind of fallen apart as we've approached the end of the year. So that is certainly a large factor in people's thinking. I can tell you that might be the single biggest factor is inflation has once again underperformed relative to expectations. It's still going to be between 2.5 and 3. It's way below where it was, but we really want to see progress on inflation to as I mentioned, as we think about further cuts, we're going to be looking for progress on inflation. We have been moving sideways on 12-month inflation as the 12-month window moves. That's in part because inflation was very, very low measured in the fourth quarter of 2023. Nonetheless, as we go forward, we're going to want to be seeing further progress on bringing inflation down and keeping a solid labor market.
Chris.
Thank you, Chris Rugaber at Associated Press. Thanks for taking the question. In September 2018, the Fed staff in the Teal book discussed a policy of looking through any new tariffs as long as there were one-time increases and inflation expectations remained anchored. Could you comment on if that analysis remains effective and any other thinking on tariffs generally that you can share?
So I do think that the September 2018 Teal book alternative simulations are a good place to start. I happen to have brought them here with me today. I'm sure you have them too. They're a good starting point, and I would just say, it's 6 years old analysis, but nonetheless, this is still, I think, the right questions to ask. And there were two simulations. One was seeing through, one was not. And I'd point you. There's some language in the see-through paragraph that says, that considers situations in which it might be appropriate to see through inflation, and then names some conditions that in which it might not be. In any case, this is not a question that's in front of us right now. We won't face that question. We don't know when we'll face that question. What the committee's doing now is discussing pathways and understanding, again, the ways in which tariff-driven inflation can affect tariffs can affect inflation in the economy, and how to think about that. So we've done a good bit of work. All of us have, each of us has, and it puts us in position when we finally do see what the actual policies are to make a more careful, thoughtful assessment of what might be the appropriate policy response.
Great. And just a quick follow. Given the recent bout of inflation that we've been through, with consumers seeing how prices can rise and businesses seeing that they can raise prices at least for some time, does that make it a little bit riskier to look through tariffs? I mean,
interesting to see him acknowledging the tariffs
to inflation threats, given what we've seen in the past few years.
So
and the inflation.
And this is also a point in these alternative simulations is there are just many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? And so we just don't know really very much at all about the actual policies. So it's very premature to try to make any kind of conclusion. We don't know what will be tariffed from what countries, for how long, in what size. We don't know whether there'll be, retaliatory tariffs. We don't know what the transmission of any of that will be into consumer prices. To your point as well, I wouldn't say that we know whether the last episode is or is not a good model for what happened. You pointed out we've just been through a period of high inflation. We've just gotten through that period. That's a difference. There was also quite a bit of diversion of trade away from China to other countries since that. That may have effects. I don't know. I just think we need to take our time, not rush, and make a very careful assessment, but only when we've actually seen what the policies are and how they're implemented. And we're just not at that stage. We're at the stage of doing what other forecasters are doing, which is kind of thinking about these questions, but not trying to get to definitive answers for some time.
Nick.
Gold 2,600, pretty close.
Nick Timrose
My
of the Wall
goodness.
Street Journal. Chair Powell,
Metal's
just so I
selling off hard.
understand, participants today revised up their core PCE inflation projection for 25 so that the central tendency runs from 2.5% to 2.7%. And as Howard noted earlier, most of the committee sees the risks to those projections to the upside. So if inflation only declines next year from 2.8 to 2.5 to 2.7, what would compel the committee to be cutting in that situation?
Let me find these numbers. So we have inflation coming down, core inflation coming down to 2.5 next year. That'd be significant progress. You see a slower path. I think that does take on board that we want to see real progress, but we'd be seeing meaningful progress to get inflation down to that level. That wouldn't be all the way to 2%, but that would be better than this year. This year will be 2.8 or 2.9. That would be meaningful. We also have to think about the labor market, and while we have the labor market forecast as being in good shape, we are also mindful that it is still out there very gradually cooling so far in an orderly, gradual way. But it's also something we need to keep our eye on.
I guess if I could follow up, if somebody looked at these projections and also the insertion of the extent and timing language in the statement, which has been used at times in the past when the committee thinks maybe it's going to be on hold for a while, and they said, gee, this looks like it could be the last rate cut for some time, would they be mistaken to infer that?
So that's not any decision that we made at all. Let me explain extent and timing. So the sense of that wording is to make clear that if the economy does evolve about as anticipated, we're at a point at which it would be appropriate to slow the pace of rate cuts. So extent, that just relates to how much further we can reduce our policy rate consistent with getting to a neutral stance. Clearly, that distance has shrunk by 100 basis points, so significantly smaller. So that's the extent question. And we're going to be looking for further progress on inflation as well as a strong labor market to make those cuts. Timing just suggests, again, that we're at a place where we assuming the economy develops as expected, we're at or near a level that will make it appropriate to slow the pace of adjustment. So that's what we mean by that. We're not trying to make decisions about the longer run. We're trying to make sensible policy as we go. And, I just would emphasize the uncertainty, which is it's just a function of the fact that we expect significant policy changes. There's nothing really unusual about that. I think we need to see what they are and see what the effects they will have. We'll have a much clearer picture, I think, when that happens.
Mike.
Michael McKee from Bloomberg Radio and Television. Even though you've cut rates by 100 basis points this year, we haven't seen much change in mortgages, auto loan rates, or credit card rates. You say you're significantly restrictive. Are you running a risk that the markets are fighting against you and the economy could be more at risk of a slowdown than you anticipate?
So the rates that you talked about are really longer run rates, and they are affected to some extent by Fed policy, but they're also affected by many other things. And longer rates have actually gone up quite a bit since September, as you well know, and those are the things that drive, for example, mortgage rates more than short-term rates do. So we look at that, but we look at all financial conditions, and then we look at what's happening in the economy. So what we see happening in the economy, again, is, most forecasters have been calling for a slowdown in growth for a very long time, and it keeps not happening. So we're now well into another year of growth that looks like it might be 2.5%. Second and third quarters were right about at the same level. So the U.S. economy is just performing very, very well, substantially better than our global peer group. And there's no reason to think a downturn is any more likely than it usually is. So the outlook is pretty bright for our economy. We have to stay on task, though, and continue to have restrictive policy so that we can get inflation down to 2%. We're also going to be looking out for the labor market. We want to keep the labor market pretty close to where it is. We're pretty close to estimates of the natural rate of unemployment. Job creation is a little below the level that would keep it there, but nonetheless close. And so that's what our policy is trying to achieve.
If I could follow up by asking about your formulation for beginning rate cuts, included the phrase "we need to have confidence that inflation is moving down towards our target." Given the fact that you've raised your forecast for next year, do you have confidence, or are you uncertain about the path of inflation going forward?
So confidence was our test for raising rates, and we've made look at the broader suite. We've made just a great deal of progress. We're well into the twos in core inflation, and around 2.5 or even lower than that we have been for headline inflation. So I would say I'm confident that inflation has come down a great deal, and I'm confident in the story about why it's come down and why that portends well. And I'll tell you why. You do see with housing services inflation, which is one that we've really worried about, it really has come down now quite steadily at a slower pace than we thought 2 years ago, but it's nonetheless steadily coming down as market rents start to equilibrate better with new leases that turn over, not new tenants, but new leases. Market rents is new leases. So that's happening. That process is ongoing pretty much as we expect. Goods inflation, which is another big piece of it, has returned right to the range where it was before the pandemic. Just for some months this year, it kind of moved up in a bumpy way because of used cars and things like that. But we think overall that should generally be in the range it was in. That leaves non-housing services, and market-based non-housing services are in good shape. It's non-market services, and those are services that are imputed rather than measured directly, and they don't. We think they don't really tell us much about the about tightness in the economy. They don't really reflect that. A good example is financial services, which is really done off of asset prices. And that's how that inflation works. So the overall picture, the story of why inflation should be coming down, is still intact. In particular, the labor market. Look at the labor market. It is cooler by so many measures now, modestly cooler than it was in 2019, a year when inflation was well under 2%. So it's not a source of inflationary pressures. Not to say there aren't regional and particular professions where labor is tight. But overall, you're not getting inflationary impulses of any significance from the labor market. So what's the story? The story is still just we're unwinding from these large shocks that the economy got in 2021 and 22 in, for example, housing services, and now also in insurance in particular, where costs went up, and those are now being reflected later in housing insurance. It's real inflation, but it doesn't portend persistently high inflation. So we and most other forecasters still feel that we're on track to get down to 2%. It might take another year or two from here, but I'm confident that that's the path we're on. And, our policy will do everything it can to assure that that is the case.
Colby.
Thank you. Colby Smith with the Financial Times. So the unemployment rate as of November, while still very low, is within spitting distance of the level that generated a lot of concern about the labor market over the summer in the lead up to the 50 basis point cut in September. Hiring has also narrowed to just a handful of sectors. But now the committee appears comfortable skipping cuts at upcoming meetings. So what has changed about the committee's assessment of the risks confronting the labor market? Is there just less concern now on that front, or is it just about there being more upside risk to inflation that now needs to be accounted for?
The unemployment rate is now the same as it was in July, 4.2%. It's moved up and down, but it's now the same as July. And job creation is lower than it has been, but it's been steady. It's not declining. It's steady at a level which, as I pointed out a couple of times, is actually below the level that would hold the unemployment rate constant, but it's not so far below. So you might, if we have the break-even level right, and if job creation continues at that level in the establishment survey, then you would get a tenth maybe every other month kind of thing. So gradually declining. We don't have that kind of precision in this. So you're right, though, and I read out some of the reasons. We do think the labor market is still cooling by many measures, and we're watching that closely. It's not cooling in a quick or in a way that really raises concerns. I think, you pointed out, participants in the FOMC really thought that the risks and uncertainty had improved relative to the labor market. And it's because things have just gotten a little bit better. It doesn't, the unemployment rate flat and things like that. Nonetheless, we're watching it closely.
If the idea, though, is that no additional kind of softening the labor market is welcome here, what's to prevent that from happening if rates are still restrictive?
So what I said is we don't think we need further softening to get to 2% inflation. That's what I'm saying. Not that it's not welcome. We don't need it, we don't think. If you had a situation where inflation's moving around by a tenth every few months, that's, we'd have to weigh that against the fact that inflation has in recent months been moving sideways in the 12-month window. And so we've got to weigh on both. And at this point, for a while there, we were only really focused, mainly focused on inflation. We've now gotten to a place where the risks of the two are we think are roughly in balance. And so that's how we think about it.
Steve.
Mr. Chairman, I did not hear you use the word recalibration today. And I'm just wondering if the recalibration phase is over and what you might call this new phase and whether the criteria for changing rates is somehow different and higher than it was before. Thanks.
We're not renaming the phase yet, but we may get around to that. But no, I would say we are, though, in a new phase in the process, as I said. So, and that's just because we've reduced our policy rate by 100 basis points. We're significantly closer to neutral. We still think where we are is meaningfully restrictive. And I think from this point forward, it's appropriate to move cautiously and look for progress on inflation. We've done a lot to support economic activity by cutting 100 basis points. And, that's a good thing. I support the decision, and I think it was the right decision to make. I think from now, we are in a place where the risks really are in balance, and we need to see progress on inflation. And that's how we're thinking about it. So it is kind of a new thing. We moved pretty quickly to get to here, and I think going forward, obviously, we're going to be moving slower, which is consistent with the SEP.
I wonder if I could follow up and ask you how much you or the committee are looking through some of the high numbers we've had in the recent inflation numbers. For example, cars being up maybe because of the hurricanes, eggs because of the avian flu, that kind of stuff, and then looking forward perhaps to housing inflation coming down as it did in the recent report.
So we always try to be careful about not throwing out the numbers we don't like. It's just an occupational hazard is to look, those high months are wrong. What about the low months? We have a very low month potentially in November. It's estimated by many to be in the mid-teens for core PCE. So that could be idiosyncratically low. We try to look at not just a couple or 3 months. We shouldn't have our position shouldn't change based on 2 or 3 months of good or bad data. We have a long string now of inflation coming down gradually over time. As I mentioned, 12-month headlines 2.5, 12-month core is 2.8. That's way better than we were. We still have some work to do, though, is how we're looking at it, and we need policy to remain restrictive to get that work done, we think.
Neil.
Thanks, Chair. Chair Powell. Neil Irwin from Axios. Financial markets have been very buoyant really all year. Is the committee comfortable with where financial conditions are, or do you see a risk that looseness in financial conditions could undermine progress on your inflation target?
So we do look carefully at financial conditions. Of course, that's part of what we do. But we really look carefully at is the performance of our goal variables and how are we affecting the economy. So what we've seen over the course of just take the last year. We've seen inflation, over the last couple of years, come down a lot. We've seen the labor market cool off quite a bit. That suggests that our policy is restrictive. We can also look more directly at the parts of the economy that are affected by that are interest sensitive, like particularly housing. Housing activity is very low. And that's partly significantly because of our policy. So we think our policy is working, it's transmitting, and it's having the effects on our goal variables that we would want. A lot of things move financial conditions around, as you know, and we don't really control those. But I'd say we see the effects we're hoping to see on the goal variables and the places where we'd expect to see it.
So if I may, speaking of assets that have been buoyant, do you see any value or benefit in the U.S. government building a reserve of Bitcoin?
We're not allowed to own Bitcoin. The Federal Reserve Act says what we can own, and we're not looking for a law change. That's the kind of thing for Congress to consider, but we are not looking for a law change at the Fed.
Andrew.
Hey, happy holidays, Mr. Chairman. Thanks for taking our questions. I was wondering if you are satisfied with the way 2024 is ending, if you're confident that we've avoided the recession that forecasters were predicting as inevitable a couple years ago.
I think it's pretty clear we've avoided a recession. I think growth this year has been solid. It really has. PDFP, private domestic final purchases, which we think is the best indicator of private demand, is looking to come in around 3% this year. This is a really good number. Again, the U.S. economy has just been remarkable, and it's when in these international meetings that I attend, this has been the story: is that how well the U.S. is doing. And if you look around the world, there's just a lot of slow growth and continuous struggle with inflation. I feel very good about where the economy is and the performance of the economy, and we want to keep that going.
The other thing I just wanted to ask about was the you guys have noted that the unemployment rate is still low. However, employment rates have fallen rather quickly. The prime age employment rate has fell by about half a percent rather recently. The question, I guess, is, do you think there's maybe more downside momentum in the labor market than the unemployment rate alone is signaling?
I don't think so. No, I think overall, if you look at it, prime age participation is still very high. What's going on in the labor market is that the hiring rate is low. So if you have a job, you're doing very well, and layoffs are very low, right? So people are not losing their jobs in large numbers, unusually large numbers. If you are looking for a job, though, the hiring rate is low, and that's a signal of lower demand. It has come down. So we look for signs like that, and that's clearly a sign of softening, further softening. I didn't mention it earlier, but I think you can see an ongoing gradual softening in the labor market. Again, not something we need to see to get 2% inflation, and that's part of the reason that explains why we moved ahead today with the action with an additional cut. So, but you take a step back, the level of unemployment is very low. Again, participation is high. Wages are at a healthy and ever more sustainable level, wage growth. And so the labor market, this is a good labor market, and we want to keep it that way.
Thanks. Amara.
Thank you, Amara Mokway from Bloomberg News. I just want to put a finer point on the labor market. Can you keep the labor market this way in the strong position that you have described without further cuts? In other words, do you still view the labor market as needing support to protect against the further cooling?
We can't know that with any tremendous certainty. I will say that we think that our policy balances the risks. We think the risks are roughly in balance as between the two mandates, and we think the labor market is in solid shape. And when I say it's softening or cooling, it's a very gradual process. Job creations are meaningfully positive. Wages are, if anything, still a bit above what would be sustainable if productivity were to revert to its longer run trend. If you take into account the high productivity readings we've had, then wages are already at a sustainable level relative to 2% inflation. So I don't want to overstate the downside in the labor market, because the downsides clearly appear to have diminished. Nonetheless, it's one of our mandate goals, and we pay close attention to it, and it's worth noting that it is still gradually cooling, and in an orderly way. And that's how I would characterize it, and that's why we're paying careful attention.
Elizabeth.
Thanks so much, Chair Powell. Elizabeth Schulze from ABC News. As you've noted, the Fed is now forecasting higher inflation next year. High prices are still a burden for so many households right now. Why do you think it is that inflation is proving to be more stubborn than you'd expected?
It breaks down into a long answer if you want, but it just has been a little bit more stubborn. I think if you go back 2 or 3 years, many people were saying that to get this far down, we would have had to had a deep recession and, high unemployment by now. Well, that has not been the case. So, the path down has actually been much better than many predicted. We've managed to have the unemployment rate remain essentially at its longer run natural rate, while inflation has come down from, core PCE inflation has come down from 5.6% to 2.8% on a 12-month basis. So that's a pretty good outcome. Why hasn't it come down? One reason is that just a technical issue around the way we calculate housing services, and that process has been slower than market rents are showing up more slowly in that measure than we might have thought 2 years ago. So that's part of it. I think there are other parts of the story, but what I think people are feeling right now is the effect of high prices, not high inflation. So we understand very well that prices went up by a great deal, and people really feel that. And it's prices of food and transportation and heating your home and things like that. So there's tremendous pain in that burst of inflation that was very global. This was everywhere in all the advanced economies at the same time. So now we have inflation itself is way down, but people are still feeling high prices. And that is really what people are feeling. The best we can do for them, and that's who we work for, is to get inflation back down to its target and keep it there so that people are earning, big real wage increases so that their wages are going up, their compensation is going up faster than inflation year upon year upon year. And that's what will restore people's good feeling about the economy. That's what it will take, and that's what we're aiming for.
And as we look ahead to next year, what do you see as the biggest challenge to the economy under the next administration?
I feel very good about where the economy is. Honestly, I'm very optimistic about the economy, and we're in a really good place. Our policy's in a really good place. I expect another good year next year.
Edward.
Thanks, Chair Powell, for doing the questions. Edward Lawrence from Fox Business. So you say that we're closer to the neutral rate. What percent do you see and the committee believes? Where is that neutral rate?
So I'll say a couple of things. First of all, when we write, the thing we write down in the summary of economic projections is the longer run neutral rate, which is the neutral rate at a time when supply and demand are in balance, the full economy is in balance, and no shocks are hitting the economy. That is not where we are right now. So when we're making monetary policy at the Fed, that's not the question we're asking. So you can't do a straight read between those longer run numbers that we write down and what we think the appropriate policy should be. So basically, at any given time, various shocks are hitting the economy. And so what we're doing in real time is we're looking at our policy stance, and we're looking at the way it's hitting the economy. And particularly, we look at the effects it's having as we try to move the economy toward maximum employment and price stability. And the answer can be, there are things that affect the economy that are lasting, but not permanent. And the ones that are permanent are the ones that would be in our star. The ones that could be lasting, but nonetheless go away over time, they could actually affect what's sort of technically the appropriate neutral stance in near term. So we're looking at that, and we don't know exactly where it is, but as I like to say, we know it by its works. And I think what we know for sure is that we're 100 basis points closer to it right now. There are many estimates of where that might be, and we know we're a lot closer to it. And I think we're in a good place, but I think from here, it's a new phase, and we're going to be, cautious about further cuts.
But I think that the markets are looking for a little more clarity. I mean, I've heard estimates from 2.9% to 4%. I think the markets would like to see a little more clarity about a year out, 18 months out, as to where that goalpost, for lack of a better term, is, because at the moment it looks big.
Yeah, I mean, honestly, there are countless models of what a neutral rate might be at any given time. There are empirical models, there are theoretical models, there are things that combine them, and they have as many different answers as you'd like. So there is no real certainty. And I mean, it's actually a good thing to know that we don't know exactly where it is. So you're not tempted to think, oh, I think this model or this estimate is right. You just have to be open to, the empirical data that are coming in and also how it's affecting the outlook. And it's not made any easier by the fact that, that our policy works with long and variable lags. Nonetheless, that is the job we have. And so I think it's appropriate for us now to proceed cautiously now that we're 100 basis points closer to neutral, and we'll do so. Meanwhile, the economy seems to be in good shape, and these cuts will certainly help to support economic activity and the labor market while we can still make progress on inflation because policy is still meaningfully restrictive.
Victoria. Hi, Victoria Guida with Politico. I just wanted to make sure I understood what you were saying at the beginning about inflation. Are you saying that progress on core PCE counts as progress on inflation, even if headline inflation ticks up? And then also, since that's what's projected in the SEP, I was wondering what accounts for that? Why do you all see core PCE going down and potentially headline inflation ticking up?
So, and as I imagine the goal overall is headline inflation because that's what people experience. People don't experience core inflation, they experience inflation, and that includes food and energy costs. So that's the overall goal. But as we know, headline inflation contains energy and food, and those prices can fluctuate for reasons that are not related to tightness in the economy and therefore are not really good predictors of future inflation. So it turns out that core inflation is a better predictor of overall inflation than overall inflation is. So we look at core inflation because it's a better measure of what future inflation is likely to be because it's a better measure of what inflation pressures exist. So it's complicated, but ultimately our goal is headline, not core. So your second question was what?
Why do you all see core going down, but headline potentially ticking up?
So headline can be affected. You're talking about next year.
Mm-hmm.
Yeah. So headline can be affected by energy prices and food prices. So that there will be things in the headline forecast that are to do with forecasts of energy prices, whereas core will be, if you look at core going out a full year, then it'll be much more driven by things like tightness in the economy. So that's why the two can go in different directions. Headline has been lower, as you know, most of this year, but that's because energy prices have been coming down, which is a great thing for people, but energy prices will come down and then they will go up, and it won't really be telling us anything about how tight the economy is and how future inflation will perform.
Do geopolitical risks factor in at all to how you're thinking about energy prices?
So we monitor geopolitical risks really quickly, but really carefully rather. But I would say so far those risks nothing has come out of those risks that has really been important for the United States economy. The single thing that you would look to is the price of oil, given that we're talking about the Middle East and Ukraine, but that is a good summary statistic for the kind of thing that could go wrong with global turmoil. But the price of oil has been coming down, and because of global supply conditions. So the U.S. is not feeling really the effects of geopolitical turmoil, but we are certainly at a time of elevated geopolitical turmoil, and it remains a risk.
Kelly.
Thanks, Chair Powell. Kelly O'Grady from CBS News. I want to go back to something that you said a minute ago, that wage growth is outpacing inflation now. It wasn't the case for some time, of course. It's partly why Americans haven't felt much relief in their wallets from prices yet. But with inflation ticking up, how worried are you the progress in closing that gap could go away?
Yeah, so inflation, again, we don't react to a couple of months of higher readings or a couple of months of lower readings. And what we had was we had 4 months of really nice readings, and then September and October were higher, but then November is much lower. So I don't really think the public is experiencing that as a surprising upside risk to inflation. I think inflation is much lower, What the public is feeling, and they're right about it, is that prices are just, the price level went up because of the past inflation. And it's going to take some time for real wages to recover over a period of years in which your real compensation is growing. And in other words, your compensation is growing meaningfully faster than inflation. That's exactly the kind of economy we have now. And we just want to hold on to it. That process will probably take some years, but that's what's going on right now. And I don't think that a couple of months of higher inflation really signal that anything of the nature you're suggesting.
And just one follow-up. Let's look more long-term. You previously predicted hitting the 2% inflation target in 2026. It's now been pushed out to 2027. You said you're focused on enabling further progress on inflation. That's not necessarily progress in the right direction. Are you confident that target isn't going to move further out?
We're talking about when you're projecting the economy, 3 years out, 2 years out, you're talking about high uncertainty. Very high uncertainty. We really, at that point, it's not possible to confidently predict where the economy is going to be in 3 years. So what we're doing is we're looking at what's happening now. And we're kind of projecting that the same kinds of things are happening. So we keep a strong labor market. Housing services inflation comes down. Goods inflation settles down, and non-market services return to their prior level. All of those things should happen over time. And those pieces come together. There's every reason to think that they will. The timing of it is highly uncertain. But you're not wrong, though, that, it's been a bit frustrating because while we've made progress, it has been slower than we had hoped. Nonetheless, we're still on track. And, I think if two years ago you'd said we were at 4.2% unemployment and 2.8% inflation, people would say, I'll take that. I mean, that's a pretty good interim place to be. Job's not done, but I think we're feeling good about where we are and where we're headed.
Go to Nancy for the last question.
Hi, Chair Powell, Nancy Marshall-Genzer from Marketplace. You said a couple times inflation has been moving sideways, appears to be settling in around, 2.5%. Do you think the Fed is just going to have to settle for that and accept that you're not going to get to your 2% target?
No, we're not going to settle for that. I think we certainly have every intention and expectations that we'll get inflation back sustainably to 2%. That is, and I am confident we will achieve that. It has taken longer, but you have to be, we are making progress. We have made a great deal of progress, and we'll continue to do so and get back to 2% inflation. That's what we owe the public, and we're committed to achieving it.
In that case, can you rule out a rate hike next year?
You don't rule things completely in or out in this world. That doesn't appear to be a likely outcome. I think we're at 4.3%. That's meaningfully restrictive, and I think it's a well-calibrated rate for us to continue to make progress on inflation while keeping a strong labor market. So, thank you very much.
Oh, baby. Unmute there, Nick.
Okay, sorry about that. I wanted to show you guys this just as a quick reaction. I created a stock list called Retail Stocks, and these are some of the retail favorites: Hood, Celsius, Affirm, Coinbase, SoFi, MSTR, PayPal, Reddit, Palantir. Just a couple on my list. Following the Fed meeting, I mean, look at the bloodbath in some of the most popularized stocks here. Doesn't mean it's all over, but just the ones that rise the fastest, you got to be careful, because when high risk stuff gets pumped up, it can also fall very, very quickly. Nas down 2.2%, Chris. That's a big move.
That's a big move. Yeah, I mean, I'm just staring at the chart here. Go to the 15-minute, compress my last few weeks of trading. Look, the previous high at 600, we're well below it. Now, that doesn't mean that we can't get back above, and maybe that's the dip. But honestly, I kind of like this election gap. We came back and found it. That to me is in play for this potentially to be, a bit of a bear flag selling. It's going to be hard to climb back to 605 by Friday. It can happen, but I don't see PCE being something the market's going to get excited about. So yeah, I mean, honestly, I think Nick, you and I are probably close to doing the same thing. It's like, find some stocks you like, find some indexes you like, find some ETFs you like, set your levels that you want, set some chart alarms. And if you got cash ready, I think there's times to take some trades. So be aware, be alert. I mean, honestly, through Christmas, New Year's, I may be a little bit more active than I thought if I'm taking some trades, but a lot of them are already pending. I posted in the chat, MSTR, dollar cost average level got filled. RSP, dollar cost average level got filled. And I mean, I told Nick on Discord that, my NVIDIA trade might still get me a ratio spread. I've got a ratio spread in where I actually own some shares this Friday of NVIDIA at 125. I'm okay with that. I'll sell the premium. That saved me from forcing another trade. But if we end up coming to the downside, the trades that are working very, very nicely is I have a hedge on MES. I have a hedge on MNQ. These are all, trading to the bear side. I have a bear put spread on SPY. I also have some long puts if we get like a vol event. I've got plenty of trades that pay me really, really well on SPY. I've got a hedge on the Q. That's a bear put spread. And I also have some bear trap trades on all my Mag 7s. So to the downside, I mean, my hedge is working out nicely. They look better today. Obviously, there's a big, kind of gamma move to the downside. Option prices changing very quickly. My protective levels, like collars on stocks that I own, right? I sell a covered call and buy a put for protection. Those are also looking pretty good. So again, it's not like this is not discussed. Like, we knew that a correction could be happening. Is this a correction? Sure. How nasty does this get?
It's a good start. It's a good start. I mean, you're
it's a
talking
great
about
It's a
such an
great start.
insane year this year that the market had some. You talked about this, Chris, earlier in the week. Market has plenty of room to just sell off and still end out on a remarkable
And be fine.
year.
And every financial advisor can say, Mr. and Mrs. Smith that never pay attention to their markets, but yet Mr. and Mrs. Smith, you're up, 22% for the year. Congratulations. What a great year. And meanwhile, they don't realize that they were up 30% and they just got an 8% haircut unknowingly.
Right.
But that's the thing, is like passive investors, like, is today going to matter for most people? I don't know. They see it red in the market and maybe they spot check their accounts. Are like, holy crap, but probably not. Most of it's like, where am I at for the rest of the year? Where did I start this year? Where am I at for the end of the year? That's where most people are at. Look,
Chris, I might get
good.
saved on my my covered call on Tesla. I did not expect this to happen. I sold 420 out of the money calls way back here. Market ripped every day for the last month. And there's a small possibility, this is out till December 27th. So if the market continues to digest some of this, pulls back a little bit more, I might actually get to keep my Tesla shares and the gains. I mean, this would be great. I have a bunch of things here. Chris and I were talking just off air or on Discord. I've got some strangles put on some stocks that I like. I wouldn't mind if the market continues to pull back. Also, I never in my life would have thought I would be celebrating a down 3K day, but I'm only down 3K, which is a 0.29% move in my account, which I will take any day of the week when you've gotten S&P down 1.7, NAS down 2.5. I am cash heavy, so in a weird way, I'm losing money and happy about it right now.
Dude. That's great. I just did the numbers on mine. I'm down 0.96%, Nick.
All right, that's good. See,
I'll take
that's what for everybody listening. When the market's going up every day and you feel like, oh, well, I'm up 0.3%, and the NAS is up 0.9, that is really frustrating on the way up. But it is a lifesaver on the way down. If the market pulls back, diversification and cash in the portfolio means market's down a lot more than you are, theoretically, and hopefully, as long as you are spread out decently and have some cash on the sidelines. I'm very cash heavy right now. Chris and I talked about that earlier. I'm ready to build into this dip if it happens, but in no hurry either. I still think even at these levels, NAS has some room to pull back. S&P, we talked about narrowness in the market. We talked about, we kind of called that. I'm not going to lie. I didn't know that was what the Fed was going to say, but we pretty much exactly talked about what the Fed did. Committee points to not too many rate cuts. And Powell one-upped what I thought he was going to say. I thought he was going to say, yeah, inflation's, we're significantly restrictive. That was one thing he said. After cutting rates, he said, we're significantly restrictive where we are. We don't see, basically, he said, we're good where we are. Market didn't really like that. Also, market did not like hearing commentary on the tariffs. Last time around, when asked about tariffs, Powell kind of dodged the question entirely. This time around, he was a little bit more vocal on, we're mapping things out. We're watching things. We're a little bit, it being in their mindset is going to impact their votes. It's going to impact their decisions. And him acknowledging that, I thought was really interesting. He also acknowledged the potential uptick in inflation if they cut rates, the same stuff as always. But if you noticed, Chris, very little about jobs market. Let's focus. I bet you if you took a transcript of that conversation and heat seeked the word like inflation versus heat seeked the word jobs data or some variation of jobs, he was way more focused on inflation. There was not a lot of commentary on jobs, which is exactly what we were talking about prior to the meeting. Is the focus is on inflation. It's no longer this kind of we're in the middle, we're good where we're at, everything's good, we're going to watch both numbers. It was way more focused on inflation this time.
Yeah, I honestly, he was a little loose with commentary. I mean, I thought he let a lot more fly than I expected. I thought he'd be very tight to not really disrupt the boat and let this market just kind of digest whatever it is. Narrow concentration, market can't do anything but go up. Look, man, I think this is a great day for being ready for things to come. It obviously can get a little bit messier and uglier. I'm probably going to be proactive in protecting some of my hedges. My 608. It's a 608 by 590 is my SPY bear put spread. And then I have a 533 by 510 on the QQQ. So if we hit 590, I'm probably taking most of that profit. If we hit, let's say 515 or lower in the Qs, I'm probably taking some of that profit. My futures trades are in profit. So yeah, I mean, I'm not looking at this as, Nick, I got to hang on to these hedges all the way down. This is the crash. It's like, it doesn't seem like a crash to me. What comes in play, in my opinion, is, look, we had an election gap and there's a lot of structure right in there. I could see this market, testing. I'd be a little bit more concerned if we took out the pre-election low, but if we came all the way back down to this level here and tested it, maybe even filled it, but don't take it out. Look, we're just finding the 100 moving average. And we're doing it maybe fast, but look, man, how are we for the end of the year? As far as gains go, let's say that we get down to, I'll put 580 on there. I'll say if we're at 580. Okay. So for the end of the year, going into January of this year, there was our little start right there. And let's say we end at 580. The market ends on a terrible note and we get all the way back down to, 580 or so. We're still up 21.5% on the S&P. We could still cling to 20+% gains. I'm wondering if 25%, that's never happened in the history of the market, if that's debunked this year, because it was gold and SPY. If they've never both performed at 25% gains for the year, and I'm pretty sure both of those are now in jeopardy of doing that. So everything's down, man.
Yeah, I also did a couple things just during that. I sent out an alert to members. I didn't think it was going to be this quick, but the drop off in Aussie yen, I took that as just a chance to go ahead and lock profits. Took a short Aussie yen earlier today, rode that down here off the risk off sentiment. Took 56 pips out of the market. I know that's not massive, but I don't want to pay the triple swaps today. Whenever you're shorting yen, you got Wednesday triple swaps. That's an expensive carry. It wasn't meant to be a day trade, but I'll take the money and I'll look for an opportunity to re-enter on some of my currency crosses that I'm watching. I liked the yen right now. It paid off really well here today. So got some things working. Got some things just kind of on the sidelines. Crypto's taken a little bit of a beating here today. Bitcoin down 4.5%, Doge down 8%, Ethereum down 5%. You got crypto digesting this move too. It is a risk asset, whether people want to admit it or not. It moves very much. It's basically a call option on the Nasdaq, in my opinion, until further notice, until something really truly decouples on Bitcoin. I don't see a lot of diversification because right now, it's a good exercise. Everybody who's watching right now, if you want to talk about diversification or correlation, all those things, today is a good example. Pretty much everything is down. correlation massively increases when markets sell off. We see that case in point today. Look at the Russell down 3.6%. If you thought you were diversifying in any way across these indices, they're all moving in unison. Not only that, you got Bitcoin moving down. Everything is moving together. This is why personally I've been sitting on a good bit of cash, as cash truly is, there's no gain to cash. In fact, it's a guaranteed loss over time. But when markets are pumped up, it can be a great opportunity to prepare yourself for something. By the way, Discord channel, if you guys want to join it, we'll drop the link here in the chat. You can join our Discord channel, apply for free down below in the description. We do also offer a couple services. If you're interested in doing the paid version, you can get access to Chris Pulver and I's trade alerts inside of the VIP group. We have the Pulver alerts where you can see every trade Chris has taken. You can also join our VIP service as well. A1 Trading offers it, and you can see all of our trades being shared in real time. You want updates anytime we take positions. All of it is shared inside of the Discord. We trade indices, commodities, FX, stocks, options. We trade everything. So come join us if you have not already. And look at that. Nas taking out the lows here today, Chris. 2.9%. Wow.
Yeah. Dude, US 10-year climbing 2.5%. We're getting right back up to the mid-November highs. Like, I'm telling you, man, these bond vigilantes, call them what you, I don't know if that's the thing or not, but it is an anti-Fed play going on in the bond market. We've got yields ripping higher. We got bonds dropping, TLTs down to some fresh lows, IEF down to some fresh lows, SHY, just getting smoked to the downside.
Bond market did it again, Chris. They call the Fed's bluff so often. It's why I call it the smartest market. Bond market is the smartest market.
Well, if you listen to a bond expert talk about it, it sounds like the smartest market. I just think it's I don't know.
Doesn't mean they always make money or that they're the
no,
best
it doesn't. I mean, it's the
money.
same thing as you've got you've got to sit for years and justify positions, and eventually you're proven right. It's kind of one of those markets. But dude, when they're right like this, I mean, this is why you've got Druckenmiller and Paul Tudor Jones and some other massive hedge fund heads that are just short bonds for this exact reason, because they think that look, I think today's FOMC had way more inflation narrative than I expected. I thought Jerome Powell would just kind of lightly mention it. I mean, he had mentioned like things are under control and it's been stable, but when he started saying, look, it's higher this year, it's like we're expected to bring it down to 2.5%. It's like, okay, that's an improvement, but man, that's sticky. Like we're at 2.8, maybe Friday with core PCE, it's going to be down. For him to say that, core CPI is a better reading than regular CPI, it's like, I mean, so what do people pay attention to, man? It's just like everything has proven to be more expensive. The yields are showing it. It's going to get interesting, man. So look, we're still sliding. This market has another 23 minutes to go. It might just be a full-on bloodbath, and the market picks itself up tomorrow. Don't be surprised if the future market runs with this. We still got a whole night of futures that could run with this, and I don't know, man. We could see a big fat weekly candle to the downside, where all of these levels we've talked about wanting to see could happen within 3 to 5 trading days. No joke. So just be ready. Crazy stuff.
I'm watching my Tesla. I can't believe this is.
Dude, if you don't get your shares called away, that's pretty awesome, because I'm sure you got a nice little premium on that. Yeah,
Chris, when I put these on, I said 420. Like heck, it's going to go to 420 this month. Yeah, and it went to 490 or whatever. So Tesla is an absolute animal. If I get called away, I was just looking at what it would take to roll out my call further out and just stay in the trade. But to be honest, I think I'm just going to let Tesla decide. I mean, Tesla's down 9% in one day. So, we just looked at the retail list. I got to add this to my retail stocks list. You got to have Tesla on there. That is the most retail stock in the world. Tesla down 9%. Look at the retail, and this is the thing, Chris, that I have to kind of come back to. We talked about euphoria. We talked about extreme optimism in the market. When something shakes the boat, look how fast those same people rush for the exit door. I mean, this is your people. These are the people that, when they rush into stocks that are new to this stuff and they just hear the market's going up every day, they rush for these things. They rush for cryptocurrencies. They rush for nothing against Reddit. I mean, these companies not necessarily bad. I'm not a hater of these companies, but these are the exciting names. These are the people that rush into these kinds of names. And again, if you bought these things when they were low, great. But if they're up and away and you're chasing them, it's also the same crowd that buys them late that rushes to sell, pounds the sell button in down days.
It is a fire exit where everyone's going the same way, and it's
Yep.
the same door. There's one door, right? So look at how wide your bid asks are getting right now. I'm actually putting in profits right now on some of my hedges. So my $18 max credit for December 31st, I'm putting in a profit at $15, which would give me $10.25 of profit in the hedge, which I'm totally happy with. To do that in a day or two would be pretty nice. So yeah, I'm just going to get some of these profits ready. If I've got, look, if I get a SPY and a Q hedge played out, that will be, let me see, that would be roughly 2 times. That's going to be a $22,000 gain in hedges. Now, I might look like I'm sitting in some drawdown, but $22,000 in hedges with a $29,000 downside. I just went from, having a $20,000 to $30,000 drawdown to now $7,000 or $8,000. So, I mean, it's all about having cash
My
at the ready.
goodness.
And
Everything's
honestly, these should
just
run really, really
everything's
nicely.
just so violent right now.
Yeah, I mean, I kind of love it.
3.6% down on the NAS. My goodness.
I kind of love it. But like I said, I'm not a bear. It's just like I just put on hedges for reason. And you know this, Nick. I mean, you heard me have some public service announce type sessions where I'm just like, I'm just hedging because I know I have to. But it's days like this where I'm like, this is why I'm glad I do it, because it makes me feel a lot better that this is a reality check for the market, and we are getting some pullbacks, and there are more attractive levels than all-time highs. And so I want to make sure that I'm doing my best to protect a lot of these gains. So, man, this is crazy. If I get profit on this today, that would be insane. That'd be a massive, massive swell in gamma to push these things to the downside, and just have this whole move could be so exciting. It's a little crazy.
Yeah.
All right, I'm just putting these in for
Yeah,
the
dude.
SPY. Do the same thing on the Qs. Give me a spot check on the Qs. Are we at like a 5? What's our level
We
right
are
now? What's the
looking
price?
at 516.55 on the Qs.
Damn. So 510 is my level that I want to get to. And since I've been typing in my chart or my take profits, I'm already up another 40-50 cents in credit. So I mean, dude, if we gap lower tomorrow, I might hit my SPY hedge levels right away.
Tesla down 11%. And in a weird way,
Wow.
like I own the shares, but I want them to go down so I don't get called away from my shares because I shorted calls against my existing shares. If you're new to options, don't worry too much about it. But basically, I get to I will get called away from my shares if it keeps going up. But with it coming all the way down like this, then I will potentially get to keep my shares plus up to a $7 profit. But anyways, I mean, you got everything just really melting down here. 3.5% on NAS. S&P's down 2.5%. Dow Jones didn't need to go down anymore, and it certainly did. Look at that, 2% further for the Dow. It was sitting at support to start the day. And again, look at the Russell, 5% almost on the table for the day. This was a clean looking setup to me to start the day and completely washed through those lows. Kind of crazy out there, Chris. I mean, this is just something where look at gold down 2%, 3.5%. And Chris mentioned it a second ago, I'm not a bear either. I'm not shorting the market. It just feels nice to be a little vindicated to say, look, I stayed out of the way. And that ended up being a very good call for me. I missed out on a lot of losses here because of that.
Agree. Okay, I'm going to go back into my Qs. I'm going to get some of these profits set up on my bear put spread. My even what's crazy, dude, is my out of the money like 10-cent puts are up like 5x right now. So I mean, those are the ones that surprisingly can get like really profitable really quickly if this market just has like a pure meltdown. And I don't know what happens next week over the holidays or the week after, but if there are flows to just like dump and run for safe haven, who knows? And just think about the numbers here. We've survived this whole year on 1 to 2% pullbacks. We're already looking at 2 to 3% pullbacks. If there is like 3, 5, 7, 10, those are pullback levels that the market might show some resiliency. But dude, if we just burn through 3%, 5%'s on tap, 7+%, like double digits could be the thing. Look at this. If you pull up, well, I can pull up a chart. The S&P. Let's see here. The S&P, or just go to the SPY or the SPX. It's the 200 moving average, man. I've been talking about this all year, even through the election. I'm like, that's great. But if this starts to make its way down towards finding the 200 moving average, I wouldn't be surprised to hit that before we have some type of, higher highs need to happen, or if they happen, it's going to be after some type of rebalancing where we hit the 200. Nvidia is another example. This is why I made that claim that we're going to hit the 200 moving average before we hit all-time highs. And here we are at 129. I might take assignment on Nvidia, quickly work my cost basis down into the 200 moving average. And from there, Nick, I'm going to try to repair this thing for like $10+ of profit, because it might take me 2 to 4 weeks to get $10 of credits on this thing. But I will make this an income trade on Nvidia because the premiums are so good. But dude, this is nuts. I need to get some trades in on the QQQ.
Yeah.
These profits could be running fast, man. This is wild.
Yeah, I was gonna say, Chris, maybe we just call the stream. I literally got to go place a bunch of trades off of this too.
Okay.
Let's call the stream, but also, guys, come join us. We're going to be trading and sharing everything we're doing in the Discord. Come join us right now. We'll drop the link in the talk to, or to the talk to, if you want to join the Pulver alerts, if you want to get the access to the trades I'm taking. Everything is getting called out in our Discord channel. Do not wait. Come join us. It is a great time. We're going to be trading right into the Christmas close. Looks like Santa Claus rally could still be on the table, but I don't know, man.
He's going to get stuck in the chimney, dude. There's no way he's getting stuck in the chimney.
I think
we're
Santa
getting
Claus
all-time highs.
might have ate a few many 2 cookies. Anyway,
he's going to oversleep. Yeah.
Guys, thank you for tuning in. This was a 6.5 hour stream for us. We had a lot of fun. Make sure, come join us. Subscribe if you're new. If you want to join the VIP room, we are about to go trade our minds off of this. I know I'm about to take a couple trades. So stay tuned. Come join us, and we'll see you in the Discord. Thanks very much, guys. Have a great rest of your day. See you, Chris.
All right. Thanks, Nick. That was fun. See you.
Yep.